While the U.S. tariffs on Canada won't take effect until the new year, the Canadian actions announced on Tuesday are set to go into effect on September 8th. And SpaceX on Tuesday announced plans for a new $100 billion launch facility in Louisiana, which will eventually serve as the main launch site for the Starship program. In a video posted online, SpaceX CEO Elon Musk said the facility would create 10,000 jobs. The company says the site will support thousands of launches annually once it is fully operational. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that, Julia. But here is some opinion now that is coming in from Nathan Sheets of Citi on Treasury's recent buyback plans and the state of U.S. economy.
Druckenmiller was right, and it was an effort to bring down those longer-term interest rates. The problem is that those rates, as Druckenmiller emphasized, reflects some deeper challenges in the U.S. economy. I think number one is we have a fiscal position that's just absolutely out of control.
Moving on, and now getting you the latest on Trump-related developments this morning. First up, the trade fight between Canada is escalating fast, and this is after the talks collapsed on Friday. The U.S. slapped around a 50% tariff on select Canadian goods over the weekend, and on Tuesday what happened is Canada hit back with its own tariff of 15 to 50% on roughly $20 billion of U.S. goods, hitting steel, dairy, appliance and electronics effective September 8th. Now, U.S. President Donald Trump responded with a whole host of Truth Social posts accusing Canada of ripping off the U.S. for decades and declaring it will be entitled no longer. That's a word coming in there. He also floated renaming Lake of Ontario to Lake America amid the trade war with Canada. Meanwhile, President Trump also reiterated his call to scale back the joint military drills with South Korea, citing his rapport with Kim Jong-un of North Korea and calling the exercise costly and hostile, signaling towards hostile signals actually going towards North Korea. Now, he also says that he has already told Secretary Hegseth to substantially reduce them as well. This is something he's spoken about before as well. And this is all triggered why? Because South Korea was turning down the request to help denuclearize Iran, and that is the reason all of this started. Now, that's the update that we have coming in this morning in terms of Trump Watch. But on that note, we're going to slip into a very short break. After the break, we'll come back and tell you all about India's Airport Economic Regulatory Authority cutting the user development fee for domestic passengers at Hyderabad Airport. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now, India's Airports Economic Regulatory Authority has cut the user development fee for domestic passengers at Hyderabad Airport. Now, this comes just days after a similar cut in Bangalore Airport and the regulatory implementing a new tariff framework. Madhya is here to give us more details on this one. Madhya, good news for passengers. Will we see more UDF cuts in other airports as well? What's your thought?
Quite possibly, because that is the model that ERA, the tariff regulator, is now taking forward. High user development fees, or UDF, have increasingly become a concern for air passengers as it adds to the airfare. Like you mentioned, the UDF has also evolved from charging just departing passengers to charging arriving passengers as well. And Bengaluru Airport was the first in the country to charge those arriving at the airport. Then came differentiated UDF, with Delhi becoming the first airport to charge international business and economy passengers differently. And now ERA, the tariff regulator, has changed the tariff playbook, and under this model, it has reduced the UDF at Bengaluru and Hyderabad airports, and I'll explain why. Airports have large capital expenditure plans, new terminals, runways, aprons, and other infrastructure projects. And these investments form an important part of an airport's aggregate revenue requirement, or ARR, the revenue that the airport is allowed to recover through charges like the UDF. ERA is moving from a model where airports recover projected costs upfront through passenger tariffs to an approach where passengers pay when that infrastructure is actually ready for use. This is also reducing the risk of over-recovery if projects are delayed or not executed. So last week, Bengaluru was the first airport to come under this new approach. ERA reduced the domestic departure UDF from 550 rupees to 300 rupees, while international departure UDF is reduced from 1,500 rupees to 997 rupees. And today, Hyderabad is the second airport to follow this model. The airport had sought an aggregate revenue requirement of 27,800 crore for the 2026-31 control period. And ERA has approved a baseline ARR of 11,600 crore. That's the reduction. And that has translated into lower UDF for departing passengers, with domestic UDF falling from 750 rupees to 515 rupees and international UDF falling from 1,500 rupees to 1,030 rupees. The important point here is that airports' future infrastructure investment has not disappeared. What has changed is when passengers pay for it. So in Hyderabad, for instance, future projects, including the Northern Runway, have additional tariffs attached to them. But those additional charges will kick in only after the respective assets are completed, commissioned, and put to use. So the principle here is simple. Passengers should not pay today for infrastructure they cannot yet use. And that's the model that ERA is now following.
Thank you so much for that, Madhya. But let's move on. And in some somber news, as we wind down the show, legendary country music star Dolly Parton has passed away after a battle with cancer. She was 80. Parton's six-decade career produced hits including Jolene, A Coat of Many Colors, and with that, we're going to wind down this edition of Power Breakfast. Thank you so much for tuning in. Up next, Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. And before we go any further, I want to wish my colleagues Nigel and Reema a very happy Onam.
Happy Onam. Happy Onam.
And Eid Milad,
Well,
yes.
absolutely.
Happy Onam. Have a good one, Prashant. I hope you're not leaving early today.
I am.
Have a super
For a
day.
nice, sumptuous Sadhya.
Sadhya.
Yummy.
Well, wishing all our viewers a very happy Onam as well. It's a joyous occasion and a happy Eid, of course, as well. So actually, money markets are shut.
Yeah,
so there's no settlement in that sense today, but would be a functioning. Equity markets are working. Lots to talk about today, so let's, I guess, get on with it. And I think the top of the mind thing, of course, is what's happening with oil prices, or what has happened with oil prices. Optimism once again. Yesterday morning, we were at 93, and this morning we're at 86, 87. So there's basically been about a $6 drop in oil prices morning to morning. And why has it happened? Before that, by the way, what happened on oil going into close, US market close, was pretty interesting. Oil fell 2% in the last 15 minutes going into the US market close. And the reason was pretty simple. Actually, it was not simple. It was basically speculation that there is an interim potential US-Iran ceasefire. Remember, the last ceasefire expired. And there is talk that perhaps we are close to another ceasefire being signed. Which gives kind of a longer rope to both sides, at least to publicly be able to kind of sort of say that we're within the ceasefire period and we don't have to escalate, and all sorts of things follow on from that. So it happened right into it. The reason I'm mentioning specifically this is because that fall happened because markets are thinking something will happen soon. If something does not happen soon or soon enough, I mean, you got the tendency for these things to reverse. Now, Iran and Oman, but there are other things happening on the side as well. So, news agencies out of Oman, state news agencies out of Oman as well, are reporting that Iran and Oman are going to hold talks to discuss an interim framework at resuming shipping through the Strait of Hormuz. The problem is we don't know whether this means, collecting a toll, collecting some kind of fee, or this is, passage without a fee like it used to be before the 28th of February. We don't know it. There are also news reports that US, but this came through towards the end yesterday. And I think, and I'll talk about what happened to our market yesterday in the last 20 minutes of trade. But, there were reports that US is starting to return diplomats to Middle Eastern embassies, which in a way is also a clear signal that the US does not think that there will be, escalation military-wise. In any case, I mean, the wars, as the US itself has put it, it's an economic war, it's economic D-Day. So in terms of military action, perhaps they are not anticipating much from here on. Anyway, as I said, we'll need to see something soon for prices to remain where they are or drop even lower. I'll sort of look at what happened as a result of the fall, the $6 fall in oil prices. Treasuries, bonds rallied, yields fell. The 30-year was down 6 basis points to 5.16%. And actually on the 5-year, the 10-year, the 30, I'm just mentioning 30 because that's been the most in focus. Equities reversed a little bit of Monday's losses. The Nasdaq, after being down 0.8, was up about 0.6% yesterday. Lots of single stock action, but, in terms of data ahead, you have the PCE, the consumer price inflation number, which will be coming out as the Fed's preferred inflation gauge. Lots of debate about what the Fed should do, whether it should stay pat, a hike is warranted, etc., etc. Nvidia will report numbers after the bell today. That is tonight, basically. The stock was up. It actually is up about 5% in the last 2 trading sessions now going into the results. Now, I'll just sort of wrap up the levels here. But before that, just look at what happened in the cash session, the closing auction session yesterday. There were change. The Nifty was up 74 points in the closing auction. The Nifty Bank moved up 60 and the Sensex moved up 120. The reason I'm mentioning this, and you may wonder, well, what happened? It's kind of difficult to differentiate, right? Because a lot of what was happening with regards to US-Iran especially with regards to reports coming through on Bloomberg and other wire agencies that, there was this news flash that US is planning to return diplomats back to embassies on the ground in the Middle East. I mean, all that was trickling in. And it's possible that some of the change that you saw, and is larger than what we've seen over the last many sessions, perhaps can be attributed in part to those headlines as well. But in any case, we saw a move this morning, because the news is positive, we most likely build on top of it. But some of this move has happened in the final few minutes, which is now the closing auction session. The levels will come up on your screen before we go any further. The breakout point is 24,240. So ideally, we should now not be falling below it, which is 24,240. And the resistance is 24,500. Remember, 24,500 was the level that we were talking about last month. We actually briefly took out 24,500 last month and then fell below it, fell down under it, and we're back in the range, struggling to get past once again. So 24,500 in that sense back in the reckoning. And the support on the downside is 24,130 or so. So first 24,240. Ideally, we don't come down below it. And then 24,130 on the upside. 24,500 is the level. GIFT Nifty, I think, is indicating another bump, about 90-odd point change as the indicative starts. So, let's hope oil stays down and we're able to sort of build on to some of what we saw yesterday and some of what we are likely to see this morning as well. Nigel has walked across to the wall with the F&O positioning, the cues, the data. Nigel, take it away.
Well, we had a good end actually to the August series, and the last hour action that we saw for the bulls, well, it was as much as action as we saw in the entire series, because in the last hour, the Nifty went up by close to under 180 points. You put the cash session together as well as the move from around 230 to around 315 or thereabouts. And for the full series, the Nifty moved up by roughly around 200 points, and that's as much as we moved just in the final hour itself. So it was a good series actually from a bullish perspective, because the Nifty went home with some mild gains. We are up close to around 1.5%. Most of it came in on the last day. But the broader markets, that's where the money is being made. Both the mid and the small cap indices, they continue to outperform. And that could very well be the case even going forward from here on. Historically, September has been sober for the markets, that is, because markets haven't moved too much. 50% of the times, September series has given negative returns. So that would mean, we have some positive returns as well in there. Moving to the rollover, positioning, well, as much rollovers are more or less in line. The rollovers that we saw getting into this series in comparison to the 3-month average, both on the Nifty as well as market-wide rollovers, mostly in line. Let's take a look at how heavy is the Nifty futures. Remember, last series was relatively lighter in comparison to what we saw at the start of the July series. And September is as light, a little heavier than what we saw at the start of the August series, which is par for the course. The FI short positioning as well, yes, they are short, as has been the case over the last few series. But in absolute terms, the short positioning is a little bit lower at around 1.8 lakh contracts, which compares with around 2.05 lakh contracts, which is telling you 21,000 contracts less on the short side at the start of September in comparison to August, but in percentage terms, it's more or less in line. Even client positioning, well, they have, in fact, maintained that short positioning at around this 20% approximately. In terms of long positioning, well, it's at around this 1.57 lakh contracts. Moving to stock futures, that's where both of them are actually on the same side. The FIs as well as clients, they continue to remain net long on stock futures, and they just build on to that position at the start of September in comparison to the August, both the FI longs, the client longs as well. So stock specific action is likely to continue. Looking at the options data, looking at the technical levels as well, you got a broad band. The 20 DMA, that's the first level that you're looking at in terms of a bit of a resistance mark. And then you're looking at the 200 DMA. So that's going to be the broad range you're looking at in terms of an up move. That's where resistance comes in at. I think the bias is still on the positive side. And I say that though the flow of paper is keeping a bit of a lid and sucking out some liquidity, but the FIs have turned buyers. And this is for the second month running that we're seeing them buying, which is good news. And that's what's helping some kind of participation as well. So the institutional flows have been pretty good. The domestic liquidity has been good. Some part of that is getting sucked out. But now the FIs that are coming in there and participating. The top cues that you're looking at, Jackson Hole's speech will be tracked later this week. GDP number, US inflation as well. So normally September has been sober. This time as well, I think going by the cues that we have, I'll be tilting towards the positive side.
All right, thank you very much for that. And the cues just for the day, we also have NVIDIA, Salesforce reporting numbers and the QS Q2 GDP. Asia started off on a positive note, so you've got green across the screen. The Korean markets are up close to about 0.5%. The Taiwanese markets have opened up with a gain of, Korea is up 1.5%, while the Taiwanese markets and the Japanese markets are up close to about 0.5% on hopes that perhaps some arrangement, some deal may be struck which allows free passage through the Strait of Hormuz. That's the reason why crude prices too have taken a leg down, and that's the big cue for the Indian markets. Sorry. Let's get in our guest on the show. Cameron Brand, Director of Research at EPFR Global, is here with us. Cameron, thank you very much for joining in. Well, for the Indian markets in July and so far in August, we've seen a trickle of FI, FPI inflows into the equity markets. Is the data at EPFR supporting this evidence? I mean, supporting this, what are your numbers telling you?
So the numbers are showing that certainly the redemptions have bottomed out and that foreign investors are starting very cautiously to look at Indian equities again. But it's sort of a one step forward, two steps back kind of pattern at the moment. And the sort of sentiment really hasn't coalesced around getting back into India in a meaningful way.
But, this cautious investing into the Indian markets by foreign investors, is it a part of the broader EM portfolio? Are we seeing an increased weightage as money is flowing into EMs, or is this India dedicated? Where is this money? What's the origin of this money?
Well, so the origin of the money, the foreign money, is certainly going to dedicated India funds, but we're also seeing a pickup in a more consistent pickup in flows into the diversified global emerging markets bond funds, not bond funds, equity funds, and those, usually on average send 8, 9, 10% of the fresh money they get to India. So there's very cautious support through the dedicated India fund channel and a bit more of a pickup through the diversified global emerging markets funds.
What's India's weightage in the diversified emerging market funds now? How has it changed compared to the start of the year and perhaps in the last 2 months?
It's ground lower, but again it shows signs of bottoming out. Obviously at the beginning of last year, India was riding high, and the average allocation was at record highs. So it's come down a fair bit, but it seems to be, as with the flows, bottoming out, certainly among active managers, which is what we would regard as the more compelling clue to sentiment.
Cameron, your data also says that redemptions from SK Hynix related funds have hit a record high since EPFR started tracking the funds in late 2024. This is a group of all the funds that invest in SK Hynix. And even Korea, Taiwan, for instance, has also seen 2 consecutive weekly outflows. This is, again, not happened in a while. Has the froth come off the Asian market inflows? Some numbers here?
Yes, I think it has. We saw the first outflows from Taiwan dedicated funds in a while. But interest in AI is far from dead. In the Asian context, we're seeing some of it migrate to smaller, less frothy, as you put it, markets. Dedicated Philippine equity funds have been doing very well recently. And that, I think, is in part due to the fact that though it doesn't get much publicity, around 1/5 of that equity market, the market capitalization is attributable to companies that certainly bill themselves as AI plays. So the froth, yes. Broad interest in AI, no.
Hi, Cameron. Good to see you again. Cameron, what about gold? China has returned back to the buying basket with regard to gold. Last few months, if I look at it, the tonnage has been moving up. What is the flow picture into gold? Because that's given a good 15% move from sub $4,000, closer around $4,700. Backed by flows?
Yeah, backed by flows. The physical gold funds that we track, flows bottomed out there for a while. Bottomed out's probably the wrong way of putting it, but they certainly leveled off in June and July, but they've really taken off again. Chinese buying is obviously helpful, but a persistent worry that some of the major central banks, including the Fed, are repeating the post-COVID mistake and getting behind the curve on inflation is also helping. And we've seen an equally solid pickup in flows to cryptocurrency funds as well, that from what we hear is certainly tied to this fear that inflation could start to accelerate and the Fed might have to act with more aggression later in the year or early next year.
Yeah, absolutely. Cameroon, a great conversation. And I think to that last point, as someone said, right, the Fed is, maybe they're not committed to getting inflation under control. They're committed to their forward guidance. And that perhaps is the problem which they kind of faced in 2021 when they were too late, and perhaps even now as well. Great chat. Appreciate your time here. And thank you very much for being here. Well, I think we'll just quickly run you through the interactions which are lined up here on the program. So 8:35, we've PL Capital's Amit Anwani to discuss the Defence Minister's approval for DRDO missile technology transfer to the private sector. 9 o'clock, we have Bernstein's Nikhil Negania to focus on the power space. Sanjay Mukhem of JP Morgan will join us at 9:20 on markets. 9:35, beg your pardon. We have Chalet Hotels to talk about the road ahead for the company, 27 outlook. MTAR Tech is an interesting management with us at 9:45. And we'll have Srinivas Reddy talk to us about business prospects and essentially the momentum that they're seeing in Bloom and elsewhere. And Lata speaks with Velayan Subaya, chairman of Cholamandalam Investments and CG Power on the semiconductor, power finance, and a lot more that the group is involved in.
Time to slip into a short break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I'll run you through the list. SBI Cards, Varun Beverages, United Breweries, Cyient, all of them will be reacting to positive news flow. Welspun Corp, Billion Brains Garage Ventures, Honasa, Gujarat Themesis, as well as Cipla will be reacting to negative news flow, while you have a mixed reaction coming in on GMR Airports.
Welcome back. You're watching Bazaar Morning Call. It's a Wednesday morning. It's time to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, both of you. Vivek, why don't you go first? Tell us the news on Welspun Corp and Grow.
Well, that's right. It's a deluge as far as equity supply is concerned. And today, it's the turn of Welspun Corp as well as Grow, Billion Brains Garage. So in Welspun Corp, the promoter entities, two promoter entities, which is Welspun Investments and Commercials, and Vipul Mathur, who's the MD and CEO, are looking to pair up to 2.4% stake of the total company. The total offer price or the floor price for this particular offer is at 2,250 rupees a share, indicating a slightly over 4% discount to yesterday's close. So this means that the total size of the offer works up to a little over 1,410 crores, going with the red on the back of the equity supply. The other stock on the radar is Grow or Billion Brains Garage. One more block deal is expected here within the last fortnight itself. The seller here today is expected to be Ribbit Capital. The offer floor price is at 195 rupees a share, and close to 1.6% of the total equity is expected to change hands, implying that the total size of the offer is a little over 1,900 crore rupees. There is a lockup of 30 days on further sale of shares from Ribbit Capital.
Okay, all right. Thanks a lot for that, Vivek. Welspun Corp, why that block, as Vivek said, 1,450 crores for that 2.4% stake. I'll tell you what, 6 years ago, the entire company's market cap was around 1,500 crores or thereabouts. So that's the kind of, big wealth created it is. And that's a promoter entity now taking some money off the table. But Vivek's a busy man this morning. He's also here to tell us about GMR Airports. Vivek?
Well, that's right. So an important development coming in as far as, airports in India is concerned. Last week, you saw the tariff structure coming in as far as Bangalore Airport is concerned. Yesterday, AERA has gone ahead and given a press release indicating and talking about the tariff structure as far as the Hyderabad Airport is concerned, which is operated by GMR Airports. So AERA has determined the tariff structure for the period of the control period of 2026 to 2031. The UDF or the user development fee has been kept at 515 rupees a share. It is down from 750 rupees currently, and GMR, remember, had proposed a fee of close to 580 rupees. The UDF for departing international passengers also has been brought down to 1,030 rupees from the 1,500 rupees currently, and GMR had proposed close to 1,150. Now, along with that, there is also landing charges that has been fixed. This is per metric ton for domestic flights as well as for international flights. Jefferies has gone ahead and spoken about this particular development. They're saying that the tariff order is largely in line with the estimates. They're also saying an important development that AERA's new incremental tariff framework defers tariff recovery on large capex. Remember, GMR along thermal utilities actually gets an ROE as far as capex is done. So they will now get the return only post commissioning. So this is an important development as well. The recovery mechanism remains intact. Only recovery timing changes, going with a largely flat expectation, given that it's largely in line with what the street was anticipating.
Okay. All right. Vivek, thank you very much for that. So that's GMR for you. Let's talk about SBI Cards. Sudarshan is here with details. So good morning.
Good morning. So we have the credit card data for the month of July, and it's looking largely healthy. If you talk about the net card addition, we have seen addition of more than 12 lakhs in July. It's the third straight month where the net addition is more than 10 lakh. Especially talking about SBI card, it has outperformed the industry. For company spending growth was 22%, while industry has registered growth of around 8% if you talk about YOY. Talk about the volume growth, it was steady at 7% YOY with stable outstanding shares. Cards outstanding for SBI card was at 2.28 CR with 1.83 lakh cards added just in the month of July. So overall, it's looking largely positive if you talk about SBI card.
All right, thank you very much for that. Mangalam joins in with the latest on why you should be watching FMCG companies today.
Well, a bunch of companies that we're tracking today. We spoke about Sober September. Can't say the same for Varun Beverages because they've gone ahead and incorporated a 100% owned subsidiary called Kiva Spirits and Company, and that's likely to enter ready-to-drink alcoholic beverages and allied products. Remember, the company earlier got into a beer distribution arrangement in South Africa for Carlsberg, and the street was anticipating something like this to happen in India as well. Well, they formalized this, and Prathamesh Mishra, who's the ex-COO at Diageo India, has been named the CEO and MD of this arm, so this is a positive. Additionally, they've also gone ahead and made a joint venture in Tunisia for production, distribution of carbonated soft drinks, juices, water and dairy. So all things Varun Beverages doing to diversify beyond its core strong business of Pepsi. So that's a positive. Alongside that, I'm looking at United Breweries as well, because Heineken Silver, their premium beer offering, will now be available in Kerala, Odisha and Madhya Pradesh starting from August 25th, 2026, in time for the second half of this year and festive season as well. The premium business has been doing well. The company is targeting doubling of their premium business from the current level to 20% of sales over the next 2 to 3 years. So this is in line with that, seeing some green for United Breweries as well. And finally, Honasa. A mild red on that one, because remember, the stock had seen a bit of a rally when the company went ahead and announced an acquisition in the form of Fluence Pharma, which was in the business of nutraceuticals. They've called this deal off largely because of non-fulfillment of closing conditions. But the company has also said that they are committed to the nutraceutical strategy and will continue to evaluate right opportunities, both organic and inorganic, in this space. So this deal not going through may have a bit of a decline on the stock price today.
Right, Mangalam, the interesting one was Varun Beverages in there. They are moving to Alco Bev. I wonder whether or not sometime before I'm out of CNBC TV and before we're done, Mangalam, with this career, whether or not Mangalam will sit across the table and have an extra large scotch. Wow. Will be the day.
Won't be an extra large scotch, Nigel, but I'll tell you, for celebrating with you, maybe a sip. Yeah, for sure.
All right, great. And we have Sonal's birthday coming up as well. I don't know whether you want to have a sip on that day. Thanks a lot for that, Mangla. Well, Cyient had their investor day. Vinny joins us to run us through, all the data points out there. Vinny?
Hi, morning. So for Cyient, key takeaways that came in from their investor day. First up, in terms for the ER&D sourcing side, they have expanded their TAM. Now, first they had a $100 billion TAM that they were saying the addressable market. That's moved up to $2.4 to $3.2 trillion. So they expect a lot of opportunity coming in here. The digital engineering as well as technology side, the EBIT margin, we saw it improve and come up to 13.2% in Q1 FY27. What is the company aspiring? It will reach around 15% by FY28 in terms of EBIT margin. That's the outlook there. For FY28 to FY29, the management overall is aspiring 15% plus EBIT margin and double-digit order intake growth as well as revenue growth that is going to be ahead of its peers. So that will be key to watch out for. Cyient Semiconductor side, they've outlined their first standalone target this time. 4 times in terms of revenue growth by FY31 with 40% gross margins as well as more than 20+% EBIT margins is what they're talking about for Cyient Semiconductors. As well as the growth over here mainly was supported by Kinetic Technologies acquisition that's come in and increasing in terms of traction that they've seen for ASSP as well as ASIC businesses as well. And we're expecting green here coming in from the commentary. Most of the brokers have managed to hold on to the ratings that they've given post this as well.
Okay, all right, Vinny, thank you very much for that. Well, we have Gujarat Themis, which is where there's a QIP launch, Nigel?
Well, that's right. Gujarat Themis, they launched a QIP of around 400 crores or thereabouts. And it's at a sharp discount in comparison to the SEBI-derived price. SEBI-derived price is around 373, but it's at a bit of a discount of theirs because they have that option. So the issue price is a 12% discount in comparison to yesterday's close price. So expect the stock to start off in the red, but it's a 400 crore issue. They have a green shoe option as well. We have to understand how demand is. Sources indicate to me that in all probability, they have been scouting for an overseas acquisition. So once they get the money, we'll track that as well. I believe there could be 2 possible small acquisitions out there. So that's a stock on the radar. But going back to Vinny, she's here to tell us about Cipla. Vinny?
Hi, so for Cipla, some not so good news coming in. So we'll expect red here as the US FDA has conducted a follow-up good manufacturing practice compliance inspection in their Pritampura plant. Now this was between 17th of August to 25th of August. And post this, we have a Form 483 that's come in with 7 observations. Do not forget the inspection. The company had spoken about this before as well in its disclosures, which were made on Feb 18th, before that in November 18th, 2023 as well, August also last year that's spoken about this as well. So the company has said that it will work closely with the US FDA to address this observations. Now do not forget this facility was already under warning letter, and if they do not comply with these observations and all of it is not met properly with the US FDA, then that compliance status is going to be unlikely to be resolved at this plant, and that could be a bit of a worry, but we'll watch out for this one. As of now, we'll expect some red here.
All right, look at you on top of tech news and pharma news. Vinny, thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are SBI Cards, Varun Beverages, United Breweries, Cyient. Stocks with negative news flow are Welspun Corp, Grow, that's Billion Brains Garage, Honasa Consumer, and Gujarat Themis and Cipla. So it's a mixed picture. Mixed view coming through on GMR Airports. But that's equities for you. Let's talk about commodities, currencies. Manisha joins it with a complete roundup. Manisha, waking up to a sharp decline in crude prices.
Oh, absolutely. 2% decline in the markets yesterday and 2.5% decline in the Asian markets right now. So if you look at last 24 hours, it has been more than 4% of a cut coming in for the crude oil prices, all the way from $92 to $86 a barrel therein. It's a third day of decline. The inflation concerns now seem to be easing. And there are a couple of things to watch out for. One, Iran, Oman discussing temporary joint maritime corridor in Strait of Hormuz. So you perhaps could see the oil supplies come back. On the other side, while there has been a lot of rhetoric from U.S., but the markets still are awaiting clarity on the U.S. secondary sanction on Iran's trading partners. So that is what has eased some bit of a crude prices there. But we also are looking at very steady moves otherwise in precious metals and base metals as well. And this is ahead of the U.S. PCE data that comes in today. And then you have the Fed Chair Wash speech at Jackson Hole Symposium on Friday. I want to make a quick mention of zinc as well, because we are trading at over 4-year highs onto this one at $3,800 a ton on LME right now. There are disruptions at several major mining operations. LME inventories have declined quite sharply. And while China has enough inventories, but key markets outside of China are very tight. And that has made zinc really an outperformer when you look at the last 24 hours.
Thank you very much for that, Manisha. Get into a break. On the other side, PL Capital's Amit Anwani will talk about Defence Minister's approval for DRDO missile technology transfer to the industry. Welcome back. Now let's put the spotlight on the defense manufacturing space. The government yesterday cleared the transfer of DRDO developed missile technologies, which is the research arm of defense to the Indian companies, to eligible Indian companies. And the aim is to strengthen, defense manufacturing. So DRDO used to develop the prototype, do the R&D, and now you want to transfer and, pass on that technology to companies to enable production at scale and increase participation. To understand which companies benefit, how significant is this, Amit Anwani, Vice President, Institutional Research at PL Capital Group, is now joining in. Amit, what is the implication of this? 2-3 important points to begin.
Right. So I think, Rima, this is a very clear-cut direction by the government to localize and to have an industry scale production. So especially they're talking about the transfer of technology, and that will ultimately lead to the industry scale production. We have seen export for the country growing massively. We are at 38,000 crore export and 1,80,000 crore domestic production for FY26. The government is targeting massive exports, and we have seen in the Independence Day speech by the Prime Minister that we should go global. So I think the industry scale production for, let's say, missile, drones, and many other important warfare platforms would definitely also enable the exports to a large extent.
Can you first tell us what is the difference from how it was done so far? Because from what I understand it, anyway, DRDO used to transfer technology, right? I mean, to companies like HAL. I mean, I remember clearly in other public, BEL, for example, it always used to be technology transfer. So, and I think for the private sector as well. I mean, it was not like a strict no-no. So is this like an explicit, on-ramp in that sense now for this to happen? Like a clear signal, or is this actually a policy change? Something which was not happening is now being allowed?
So I think, Prashant, many platforms in the past, the developmental stage takes a lot of time, and DRDO used to, and even today also, they collaborate for development. For example, they have done for AMCA with many players. So I think the developmental stage, and then what typically happens is whoever is involved in the development stage typically is a favorable candidate to win the orders. Now, what this change can bring problems. So they're talking about technology transfer, and they're talking about industry scale production. So many private companies also who have been in the fray in the past.
Amit, I'll tell you what, we'll try to fix that line a little bit. Let's do one thing. Slip into a short break, come back. We'll get Amit's view on the defense sector. We'll also be joined by Deven Choksi. He'll help us out with some more fundamental analysis. Stay with us.
Welcome back. Amit Anwani is with us. We talk about defense and the DRDO technology transfer news which came yesterday. Amit, we had you on a bit of a scratchy line, poor audio. Couldn't hear you. So let me just repeat by where we left off. I was asking you what is different now compared to what used to happen earlier. And is this, just a signal from the government that this now can happen in a more institutionalized way, or this is opening up this transfer? And this is something new, which was not happening earlier. Go on.
Right. Hi. So I think what I was explaining is that earlier the developmental stage used to be quite long, and the players involved in the developmental stage of, let's say, a missile or any other platform were kind of more favorable to get the orders. With transfer of technologies, they're really opening up the commercial scale doors for a lot of private sectors also. In the past, specific to missiles, we have seen few private companies really involved and have developed the manufacturing capabilities, including solar industries, L&T, apart from the PSU companies like Bharat Dynamics. So I think this broad base develops a very strong vendor base on a manufacturing side once the technology or the developmental stage is clear. And broadly, this will lead to the mass production and export opportunities. That is what I think.
So this shortens the development time. So companies will simultaneously develop on their own, but they were taking too long. And now with this transfer of technology, we will see shortening of developmental cycles. In the past, go ahead.
Yeah. So I think development cycle may not shorten too much, but there were, for example, the fire control system, propellant systems, or the RF seekers, which goes into missiles. And many of the private companies now can, who have this kind of systems and technologies, can really beat for the main orders which might come on the missile system. So broadly, this creates the public plus private involvement in the tendering process also going forward, apart from the limited scope currently with the few nominated orders with the PSUs.
So currently, who enjoy the benefit of getting this technology transfer from DRDO? Which PSU companies?
So if you see, the upcoming missile programs includes QRSAM, which probably will go to Bharat Electronics and BDL as we speak. The tender is yet to be out, and there are many other platforms. We saw Agni 4 missile, and there would be one program called as Akash, Next Generation Missile Systems. So all these systems, broadly, Bharat Electronics, PDL, solar industries on the private side has done Pinaka missiles. If there are more orders for the higher range, definitely they'll be beneficiary. And then we're talking about Akash missile, few areas. L&T has also worked on the Pinaka and some kind of work on the Akash side. So I think the upcoming platforms, including Akash, Agni, Pralay, there will be more participation from private players like L&T and Solar. And there's a lot of companies working on the subsystem side, including Extra Micro, Apollo Microsystems. These guys have been working on the fire control systems, propulsion systems for the missiles. So they could also be beneficiary if the scale goes up.
Yeah. Okay. So let's zoom into what you like from here, because stocks have done quite well, right? They're building in. I mean, lots of names are building in a lot. What are your top ideas here across the market cap curve?
All right. So in my coverage, I'm preferring Bharat Electronics at 35x 2-year forward. Seems attractive to me. The stock has been sideways. QRSAM order is on the radar. Apart from this, on a broader horizon, I believe that the defense electronics space, where the Extra Microwave, Apollo Micro, and Paras, these companies have been talking about much higher growth and probably trading between 40-50x. I don't see major derating happening to the PE because of the opportunities which are coming up over the next 5-7 years. So I think these are not under my coverage, but this companies definitely will be beneficiary of the announcements which has came recently.
One final question. You also recently visited Atlanta Electricals. I know it's not a stock in your coverage, Amit, but it's a stock which has done very well. The IPO was towards the end of December at 754. Now the stock is closer to 1800, 1900. It's been a doubler in a span of few months since listing. What was your key takeaway after meeting the management and the facilities?
Right. So I was able to visit the 30,000 MVA new transformer facility in Vadod, and the facility which they acquired, 765 kV facility in Anki. So I think broadly the discussion was around that there's a massive demand for 400 kV class and 765 kV class transformer. Atlanta Electrical has developed capabilities for at least broadly 36 to 40 units in the Vadod plant. They can do roughly about 400 kV class transformers, and in the Anki plant they can do roughly about again 30 plus units of 765 kV. So what they're looking at is they have one private order for 400 kV. I think the major breakthrough can be when they start receiving the PGCL order. They have applied for the prototype under vendor development program for 400 kV with PGCL, and it may take at least 12-18 months to get the prototype ready. And I think end of next year or probably F29 may still see very strong 400 kV orders also coming into them. Currently, the 220 kV plus which they're doing is also giving the impressive growth. The company has grown at more than 30% per CAGR. They're talking about very strong growth for next 2 years. The valuation, as I can see, consensus, the stock trades at about 33x. I believe that with 400 kV and 765 kV approval, the convergence of P multiple with to some extent with larger player is possible if that happens for the next 12 to 18 months. But currently, I think, as you rightly pointed, the stock has doubled, but all these transformer companies are talking about at least 4 to 5 years of very strong cycle basis the addition of capacity and renewable integration, which is on the anvil. That's it.
Got it. Amit, always good to hear your thoughts. Thanks a lot for joining in. Wishing you a good remainder of the day, and we'll chat up rather soon. Well, that's the word coming in on defense. Let's welcome Deven Choksi, the MD of DR Choksi FinServ, who joins us on the show. Hi, Deven. Good morning. Good to see you, Deven, I wanted your view on Welspun Corp. Big outperformer. We're waiting for a large share to take place, and what I understood was that it was likely to take place in pre-market, in the block window. So let's see whether or not that happens. We'll wait for Welspun Corp. But the news is that the promoter entity and Mr. Mathur, they are looking to sell closer on 2.4% stake in the company, which means they're raising closer around 1,450 crores approximately. Now, around 6 years ago, the company's entire market capitalization was around 1,500 crores. So, how do you read this news flow? Because the EBITDA number from here is going to compound gradually, going by the kind of order book that they have. And we pushed Mr. Mathur as well last week, whether or not they can do 5,000 crores of EBITDA. He said probably yes. How would you approach the stock? It'll likely to pull back a little bit. Will you be a buyer, or do you think the best is in the price?
Yeah, Nigel. Good morning. Well, I think the stock is not under my coverage, so I think wouldn't know exactly how I think this particular news to be interpreted. But I think we'll take some time, I think, and study and then come back on the subject.
Got it. All right. And as, indications were that it's happened in the block window, it just took place as just mentioned that what I understood was likely to happen, and that's precisely what's happened. We'll wait for the buyers, but I believe demand was quite good. So let's see, let's wait on that front. Let's talk about a few more stocks then. We have Cyient. There was an investor call that took place yesterday. They've been quite optimistic with regard to scaling up the margins as well. Your view on this counter?
Yes, I think the company looks extremely convincing from the perspective of, I think, the two things. One, the US-based order book, I think, which they are basically now expanding. At the same time, I think till last year, they had some amount of impact on the margin because of some amount of restructuring which was taking place, including in US. I believe, I think this is where probably the corrective course has happened and the margins are likely to improve from here on. The undertone has been extremely bullish from the management side, and I think the larger amount of the market that they are catering to is definitely helping them, particularly engineering R&D companies like Cyient. They definitely have relatively better profit performance to talk about going forward. So we remain cautiously optimistic about the possibilities, though I think fully understand that I think certain amount of executions that they are carrying out currently may yield the benefits in subsequent quarters and not immediate quarters. So, but yes, I think the downside risk is protected, and maybe the current levels are suggesting a good entry points also with the current valuations.
Okay, let's talk about SBI cards then. What's the view on that one? The credit card spend, in the month of July, that moderated to around 7% for the industry. In the previous month, it was northwards of 9%. For SBI cards as well, the spend, the growth was 22%. In the previous month, it was around, it was around 34% approximately. And their share in the spend actually came down a little bit to 19% from 20%. This has been one of the underperforming stocks, actually. What is your view at current reckoning? Because they have said they're getting their books in order, ratios will improve from here on, the product mix as well will improve for them. Your view on the stock at these prices?
In general, I think the credit card companies, I think we are not so very bullish about, I think, the prospects going forward for them, because elsewhere the consumer is getting the loan at a comparatively cheaper price. And that's where probably, I think, particularly in the e-commerce space, where the relatively the availability of loan on the fly is easy for the consumer to buy. And I think relatively it is available at a cheaper price because of the subvention pricing followed by some of the manufacturers, OEMs, as well as the retailers. So we like, I think, the proposition to go with the retail company vis-a-vis, I think, credit card company. As far as I think the outlook is concerned on the business, yes, I think on consumption side is increasing. That is always a positive point. But as I said, that alternative products are relatively found better with the consumers, and that's where we see the higher amount of spending coming in from that side.
Okay, well, that is the SBI cards and, of course, the credit card story in that sense. We've got oil, which is down in a significant way. Once again, it's not a new one, but it's down a lot. The oil sensitives always get bid up. At least, it lasts a day, 2 days, sometimes more, depending on, what happens to oil itself. But anything you like from that space, that, oil sensitive space, Devin?
Yeah, Prashant, I think the real challenge is that with this kind of volatility, neither you are in a position to predict the basket for next 1 month. Forget about, I think, next 3 months. I think even 1 month also, I think it is difficult to predict the kind of volatility that you have. And as a result of which, neither the refiners that we feel very positive about, nor we are confident about the derivatives of oil products, because ultimately some of the pipeline inventories may hurt some of the users, particularly the people who are basically using the derivatives. But say, for example, the paint industry. So we find ourselves, I think, very uncomfortable with this kind of volatility in the oil prices. And certainly, we don't carry immediate view on any of these companies. We feel that I think the things should settle down first and become more predictable before I think you take any such kind of view on these companies.
Devin, the other story, which I don't think is going to go away, is this entire sugar story, right? We had Jay Bala yesterday on Closing Bell. He was talking about international sugar prices. He said, well, in India, because it's such a sensitive commodity, there could be some caps, etc., which may come. But internationally, he thinks sugar prices are breaking out over the next 1 year plus in a significant way. Prices are 65 rupees a kilo, right? And you got 3 months more before the next season begins, the next sugar season begins, and you got a actual demand-supply gap, and that's why prices are higher. Your view, anything there in that space?
Most of, I think, the sugar stocks have also started run-ups, and I think they're justified also, because the inventory in the warehouse has come down to half from what it used to be. 6 million tons of inventory for the industry as a whole has come down to around 3.3 million tons of inventory. So obviously, I think the amount of pressure is getting built up on the prices because of the lower inventory that the most of the sugar mills are carrying in their warehouses. Well, I think the prices in the retail market, they are quite steep. I think they're upwards of 70. whereas I think the realizations may be around 60, 65 in some cases. In my viewpoint, I think whatever the smaller inventory stock that most of the sugar companies are carrying today, they tend to get advantage out of it. Not too sure whether I think we can play out on this particular subject in a manner for next 1 year or so. Ultimately, we'll have to see how the supply situation starts improving in the global market, particularly the Brazilian sugars which comes into market subsequently. I think that's where probably we'll have to wait and see. As of now, I think it's more of a positive upside which the stocks are offering. So I think trade as the tailwind remains strong.
Devin, just one last quick response to this one. I don't know if you track it. Rashi Peripherals, right? Sold off 10% yesterday. There was that letter from an independent director, basically saying a bunch of things. M&A sort of mandates given to firms where some of the independent directors were partners, etc., etc. Any thoughts here?
Well, I have had the opportunity to see this particular company when they went public. I think thereafter I haven't seen in detail, but I think the model per se is not very exciting to me. So frankly, I think not looking into any detail as far as I think the business developments are concerned in this company.
All right, Devin, we'll leave the discussion here for now. Thank you very much for joining in. Get into a break. On the other side, pre-opening rates coming up, and we'll get chatting with Bernstein's Nikhil Nigania to focus on the power sector. And then, as always, technical trades coming up with Sudarshan and Mitesh. Stay tuned.
Welcome back. Well, let's welcome our technical experts. Then we have Sudarshan Sukhani as well as Mitesh Thakkar who join us on the show. Good morning, gentlemen. We kickstart a new series, and I was looking at the data for the past 10 years. September seems to be sober. That's for the market. But what's the view? Mitesh, you go first. Yesterday, we had a bit of excitement in the final hour of trade. We had, I think, from the lows yesterday, we were up 180 points. I think for the entire series, we were up 180 points. So, put that together, that's how we got the 350 point, 400 point uptake. From here on, what are the levels you're looking at on the Nifty first?
So I think, Nigel, one important thing which happened was that we, or the Nifty other, again managed to get past and close about 24,300. Now, that's been a hurdle. If you look at the high on Friday, it was around 24,284, and then Monday was 24,313, but the closing happened on the lower side. So I think closing about 24,300 does suggest that the upward momentum could continue. While there is a mild intraday pivot around 24,450, but I think 24,600 is the more logical near-term target if you look at the 2-hourly, 3-hourly chart. So I'll be entering the market with a slight positive frame, expecting that yesterday's closing can be built upon.
Okay. Sudarshan, morning. If you have a gap up opening, would you be bullish?
Good morning. Well, the view is almost the same as Mitesh. 24,300 was a minor resistance level or a range boundary. That range boundary was crossed yesterday, and the chances are it will at least open above that. As you said, it's a gap up, significantly higher than 24,300. Now, do we buy there? I think yes. Wait patiently for a minor dip. Post expiry, there is almost always a small dip or consolidation. Look to buy there. Keep a very tight stop at 2400, 200. If 300 is breaking, then we want to get out as soon as possible. So with a stop at 24,200, buy a small dip today.
Got that. Where do you think markets are headed if you buy the dip at 24,300? What's the upside, Sudarshan?
Well, the upside could be, as Mitesh said, 24,600. It's a question mark whether at all there will be an upside, because Nigel was correct in saying September is sober. September and October are usually seasonally weak months. So we just have to keep a stop and trail it rather than look at an upside.
Anyway, markets have been so range. We aren't seeing big moves on either side. So what about stocks, Sudarshan? What would you go with this morning?
Well, I'll go with AB Capital. And AB Capital is a buy with a stop under 405. Swiggy has had a small correction and is resuming its up move. It's a buying opportunity with a stop under 280. Now, HDFC Bank, we have all given up on that, but it still exists. That's a buying opportunity more as an investment idea or a positional trade rather than a small swing trade. But keep a tight stop at 710 and look to buy HDFC Bank. And Motherson is the only short sell with a stop above 170. But today, basically, I would focus on the longs.
Okay, all right. And Sudarshan, it's a sober month for the markets. Personally, it's the most exciting month of the year for me, September. I'll tell you why later. Mitesh, you want to give us a couple of picks?
Yeah. So on the stock side, I have 3 longs to a sell. On the buying side is CDSL, which I would recommend buying with a stop below 1370 for targets of 1450. Yesterday, both Idea and Indus Tower had a price breakout, so I've chosen Indus Tower. That's a buy with a stop below 380 for a first target of 400. A buy on UPL with a stop at 576 for a short-term target of 605. And Federal Bank is the solitary sell call. Keep a stop around 354, look for targets of 332.
Okay, all right. Well, we'll speak again, gentlemen. Thank you very much for joining us. Appreciate your time here on CNBC TV 18. Those are technical trading ideas. Well, I think a currency market is shut, as I said, right on top of the show. I mean, so RBI, our Forex brethren are taking a breather, the fixed income, Forex, etc. They're all out. The settlement-wise, there will be a bit of a change. But, I mean, we continue, of course, our markets. Nikhil Nigania is with us, and let's talk to him about a bunch of things. So power, of course, is the hot area, especially, of course, because of, the demand to build out transmission and all kinds of infrastructure because of this humongous AI build-out we're seeing. It's visible most clearly, of course, in the US, but I think it's showing up here in India as well. Nikhil Nigania, Director and Senior Analyst at Bernstein. Nikhil, good morning. Good to have you with us here. Thanks for joining us. I'll get to the power names and that AI story, etc. in just a bit. But you put out a note on PFC REC post-earnings where you say both have kind of been underwhelming sort of earnings, and there isn't a quarterly call now post the merger announcement. So talk to us a little bit about, update us your views with regards to PFC REC, and we'll move forward.
Good morning, Prashant. So Yeah, so power sector actually continues to do well. We are seeing 10% volume growth even in August, and last 3 months went 10-11%. But on PFC, REC, the challenge has been loan book growth, number one, and second challenge has been forex. They have a lot of forex borrowings, which are hedged by options and not via swaps. So they take a hit on that. But the bigger challenge has been loan book growth. So banks were not targeting the power sector till now. They were absent given they burned their hands in the last power cycle. But what we are seeing since the last 1 year is both public sector banks and private banks are very actively chasing renewable project lending. And we have heard rates as low as home loan mortgages, right? 8% or so for a renewable power plant. So which is becoming a challenge for the loan book growth of PFC, REC, whose loans are getting refinanced. They are still, cheap stocks. So we have an outperform rating. But the loan book growth challenge continues. Asset quality is good, but loan book growth is a challenge.
Are you saying yields are going to come down? Have already come off?
Sorry, I missed that.
Are you saying yields have come off?
Renewable, yes. So renewable projects were borrowing at about 9% or so earlier. Now, as I said, 8%, 8.5% is what they can borrow.
And for PFC, REC, to what extent will loan growth come down? Because now increasingly it's cheaper to go to a PSU or a private bank for a renewable plant to get the financing rather than PFC, REC being the only shop in town. So to what extent will loan growth come down, and is it priced into the markets? Because you said the stocks are cheap now.
So loan book growth, earlier they were printing early double digits, even in teens. Right now we have started to build mid-single digit loan book growth for them. And we build in mid-single digits for them. But yes, stocks are cheap, but given the situation of the market, without growth, re-rating is a challenge.
Got it. So that is PFC, REC out of the way in that sense. Cheap, but there is increasing competition and pressure there. Okay, let's talk about power demand per se, right, Nikhil? Again, the conditions for this data center construction, I think there is about 6, 7, depending on how you count and who you ask, worth of funded data center projects which are already out there, right? And perhaps more in the pipeline, but I'm talking about the funded projects. This is coming up. How are we placed with regards to power in terms of electricity supply? And how is this having any impact on power rates, further construction, renewable, thermal? Just talk to us about this.
For sure. So the data center story in India is actually yet to play out at the ground level. Unlike the US, where you can see hard money being put and the kind of growth across the value chain, utilities, equipment, asset owners, data center owners. In India, while it's still early, but we have a strong case why data centers should come in India. Reason number one is cost of electricity. We have one of the cheapest solar power in the world. Thermal power also, we are not that expensive compared to other peers. Second reason why data centers will come is transmission. So if you look at the US, the biggest bottleneck is setting up transmission lines there. It takes them 8 to 10 years to set up a high voltage transmission line. In India, despite all the noise we hear, we still do it in 3 years. We can set up a high voltage transmission line, which is quite good. So the grid constraints in India, while there are much lesser than the developed markets of US and Europe, which is the second reason to come. And third reason, of course, is the customers, right? For OpenAI, many of these guys, India is one of the biggest markets already after the US. So customers, cheap power, and faster transmission is why we think data centers will come. The quantum estimates vary at its early days, but the bigger players we have seen do hard tie-ups with companies like Google, etc.
And what does this mean on the power side?
Absolutely. So on power side, for US, it's been a complete inflection, right? US power demand was almost flat for a decade or two. And hence, even a 1 or 2% upswing is a big impact on them. In the case of India, the way we model it, so our base case power demand growth, if it's 5.5% CAGR, this is a 0.5% bump up to that. So 5.5 becomes 6% demand CAGR. So it's helpful, but not game-changing from a power demand perspective.
This is structural uptick in growth of about 0.5%. What's the best way to play it? Because in terms of the large hyperscalers setting up data centers in India, most of the recent announcements seem to be tying, say, a Meta is tying up with the CleanMax. Is CleanMax the cleanest way to play the data center power opportunity on account of the CNI contracts that it's signing up with these global tech majors?
So clean max we don't cover, so won't be able to comment on that. But broader, to play it, you can play it via three ways, right? You can play the asset guy setting up the data center, someone like Reliance or Adani Enterprise, which we don't cover. You can play the equipment suppliers to the value chain, which could be an optic fiber player, which could be a transformer player, because the grid capex goes up because of this. And electrical equipment players, many MNC companies are there. Or you play the utility, the guy is going to supply power. Where we think the right to win will be with people who have substantial amount of land and transmission. So companies, the two companies who have the most land to generate renewables is Adani Green and Reliance. We don't cover Reliance, but Adani Green we do. And we think they are in a good position to supply power to data centers.
Got that. What is happening specifically on power rates? I mean, I think, with so much of renewable sort of capacity which is being set up, right? But a lot of it still doesn't have PPAs, etc. And you have more, as you point out, more tenders, etc. coming in. So what's happening there? And just tie that to what it means for investors in the space.
No, absolutely. So what is happening in the sector on power rates? If you look at the spot power market, there's a very clear demarcation. Whenever the sun is out in the afternoon, spot power prices fall to 1 rupee, 2 rupee per unit of electricity, extremely cheap. We have abundant power when the sun is out. But as soon as the sun is setting at 5, 6 p.m., that's when the spot power prices shoot up to 10 rupees per unit, which is the ceiling the government has set. And the last 1 month or so, it's almost staying at 10 rupees till the sun comes back up in the morning. So that's a spot power indicator, which is telling you that the demand-supply situation in the non-solar hours is still quite tight. In the tendering route, what we saw is recently a renewable tender happened, which was to mimic the profile of a thermal plant, where the tariff discovered was 5 rupees 25 paisa, which is almost a landmark tender for the sector because new thermal plant itself come at 5.5, 6 rupees. So for a renewable plant to supply a same profile at a lower cost than thermal is what was the talk of the town when I was in Delhi last week. So that's a big event for us.
A renewable tender came in at was at 5.25 and lower than a thermal tender.
Absolutely.
Okay. So what does it mean for renewable people who are setting up renewable capacity? I mean, is this going to happen more and more? And will this get done, you think?
Good question. I mean, we find the rates on the lower side. Our maths suggest the rate should have been higher. So it's a very competitive tender that way. But we are seeing serious bidders. So high likelihood these capacities will come in our view. And you're absolutely right. We'll see incrementally more and more of such peak power or, thermal mimic profile renewable tenders going forward. No one wants just solar. People want non-solar supply more than anything. And the big beneficiary of that would be battery storage or even pump storage for that.
Across your coverage universe, Nikhil, what are your top ideas?
So in terms of the themes we still like transmission as a theme. We like coal-based generation still to some extent, although this tender was a big event. Nuclear for the long term as well. So the stocks we like to play the entire spectrum from a capex perspective, L&T is one we always have liked and still continue to do. On the generator side, we think JSW Energy on some correction could be a good beneficiary given the thermal plants they're adding at very attractive rates. And even NTPC, which is a value buy, which we think has corrected off the earlier highs. So it's quite reasonably valued and well positioned for thermal, nuclear, and renewable. So these three names are the ones we like.
Nikhil, this has been such a great and helpful conversation. Thank you very much for joining in. Just counting down to the open. So let's quickly get in Sudarshan for the brokerage call of the day.
So first one is on QSR space. Macquarie has upgraded Jubilant Foodwork to neutral and target price is 520 rupees per share. It says channel checks point to Q2 same-store sales growth to be higher than Q1 and it expects 20% plus FY26-29 EBITDA CAGR across the space. Now, Gujarat Energy Morgan Stanley has downgraded the stock to underweight and target price is 240 rupees per share. It says risk-reward is unattractive despite inexpensive valuations and also potential non-core investments further raise risks of lower returns. Vedanta Aluminium Motilal Oswal maintains buy call target price 540 rupees per share. It says companies entering a strong earnings inflection point and EBITDA is projected to expand at 18% CAGR over FY26-28 and valuation gap between company and peers provide an opportunity for structural re-rating.
Well, Sud, thank you very much for shining the spotlight on some of the brokerage calls of the day, and we'll see how these stocks open up. We've got the first rates on your screen anytime now, and 24,340 on the Nifty. The Nifty Bank is up about 1/3%. And the Sensex and the small cap and the mid cap indices, all of them will come up one by one. Remember, the Nifty, by the way, went up 70 points, 75 points in the last cash session, the closing auction session, and some of those headlines were coming in. So you got to account for that. When you look at why is the Nifty flat, you got to look at that, the fact that we did move up 75 in the last 15 minutes or so between 3:15 and 3:30. So it's for now a 10-point change at this stage. Nifty Bank is doing much better, about 0.5%, and the Sensex will come up. The Sensex, by the way, also had a 120-point pop. That is still up, though, about 1/3% or so. And the small cap index is doing much better with a 0.5% change right now. So that is the overall sort of lay of the land for now. Nifty heat map on the 50 stocks, how things starting. We've got ICICI Bank, I guess, which is the reason why the Nifty Bank is doing very well. But there is State Bank of India as well amongst the top gainers. There's Ultratech, there's Asian Paints, Indigo, Adani Ports, Axis Bank. So you've got about 15 names which are higher. And on the other side, Max Health is the top loser. Tata Steel, Cipla, ONGC, Infosys are some of the other names which are starting down. It's a 5-point change, absolutely flat in the Nifty, but on the Sensex, it's looking better. About 0.25%, I think, the last I looked, as far as the Sensex start goes. Rima.
Well, some of the beneficiaries of a decline in crude prices are inching up. So you've got an Asian Paints with a gain of 1% and an Interglobe Aviation higher in trade. But as a sector per se, it's banks stealing a lead. The Nifty Banking Index is up 350 points with an ICICI Bank up 1.5%, SBI and Axis following with a gain of 1%. On the mid-cap end of the screen, you've got green. There is a little bit of a bounce back taking place in Rashi Peripherals after yesterday's fall, so that's up 4%. MTAR Tech is higher in trade. Oil marketing companies are seeing a lift on the back of crude prices. Cyient came out with their investor day, and the company is now gunning for a double-digit growth for this year, and then FY28, FY29, they want to at least get back to quarter-on-quarter revenue growth. So they're looking for growth consistency, and the street likes the messaging from it. You've got, these are some of the stocks on the way up. Genesis International is higher for the second day in a row, so keep your eye on that. And NetWeb has rebounded. On the way down, VR Scientific, there was a large block which took place in pre-opening, so that's under pressure. Grow is weak in trade, Billion Brains Garage, so that's lost close to about 3%. All in all, it's a flat start on the Nifty and the Sensex. It's the Nifty Bank, which deserves mention because it's running away.
Well, that's right, Riman. There are a few stocks that are making their entry into the F&O market, and they have been quite stocks of interest. You have Aether Energy. That's made its way into the F&O market, so tricky times ahead for that one. Maharashtra Bank as well, that's the other one that's making its entry into, the F&O market. So I don't know whether we're getting any kind of reaction on that one as well. That as well will be coming in. And the other one is Sagility. So we keep an eye out on all of these stocks in today's trading session. Gujarat Timisis, that one, in fact, I think has opened up on the back foot because they have that QIP that's at a sharp discount. So we'll keep an eye out on that particular name. It's down 1.5%. The book seems to have a fair bit of interest. 400 crores is what they're looking to raise. Hindustan Zinc moves up because silver prices have firmed up a little bit. And Jefferies, they have come out with the note. They have scaled up their estimates as well for the time ahead. So that one is up. Jubilant FoodWorks up close to around 2% or thereabouts. Shriram Finance on the flip side, that's down by close to around 2.5% or thereabouts. Rubicon, I think we should get that stock up for you on the screen. That one as well, there was a large trade out there. So let's see how that's reacting. But I don't know whether it's time for a beer, but United Breweries, that new launch, Street likes it, 1.5% higher. Prashant.
Okay, well, NetWeb is the biggest gainer. It's got large volumes on it for now, 3.5%, almost back to about 5,500. BSC is up 2% and 3380 or so on Bombay Stock Exchange. I think we mentioned Hindustan Zinc, which of course is up and about 3%. There is Sigma Advanced, which we put out yesterday as well. There was that Rolls-Royce news. 5% yesterday, 5, and today about 4.6 for now. Balu Forge has had a bit of an up and down kind of a move last few days, but basically it's been up. If you cut out the one down day, it's basically moved from 450 rupees on the 20th of August to 640, 200 rupee move coming in basically a week or so on Balu Fort. So that is, it's kind of rocketed higher in that sense. What else? I mean, some of these defense names like Paras and data patterns, etc., had corrected a little bit yesterday, but I think they're coming back up. And, you know, Manipal Hospitals has been doing well. From the recent lows of 700 is almost at about 800 rupees right now. 3:1 advances to decline at this point. So more up than down. But this is the initial kind of picture. For the Nifty, it's absolutely flat. 8-odd point change down. 24,330 is where we are at. Sanjay Mukim is with us now. He's head of India Equity Research at JP Morgan. Sanjay, good morning. Great to have you with us here on the program. Thanks very much for joining us. Run us through your stance on the market. Is it a market set up for meaningful upsides from here at an aggregate level, small upside into the end of the year, or you think, we're not going anywhere? What's your sense?
I think it's great to be on. I think it's a slightly complicated question. If it were only dependent on my local macro, the local economy is actually doing well. In fact, we know 1Q numbers have been materially better than expected. And of course, you've seen valuations come off, especially in the large cap space. So if you were only isolated to looking at what's happening locally, you would be reasonably positive. The value trade is probably on in Indian equities better than it has been for the last 3 years, to be honest. The challenge, of course, is more global macro, right? You have these uncertainties. You have the challenge of oil possibly being volatile, going up, going down, depending on the resolution of the Middle East crisis. And you also have the issue, which I think is underappreciated, of very high bond yields in the US, right? So when 10-year bond yields are at these levels, you're not going to get EM assets do very well, right? It has been a historical pattern and logically so as well. So the risks, I think, are more external to the market. I don't think that there's that many challenges that the economy faces locally for now.
So the stance that JP Morgan took at an Asia level in April, when you downgraded India to a neutral, while at that time you all upgraded Taiwan to an overweight, that still stays. So India is going to be sort of sideways from here on for the next 6 months, balancing stronger domestics and weaker global cues?
Our base case is 27,000 on the Nifty. So we do expect that there should be some upside to the index. But that in the context of our bullish stance on Asia and EM as well, I think that kind of fits. What we're starting to see, of course, is renewed interest from long-only investors in India. And I think there's two drivers of that. One, of course, the volatility in tech stocks in North Asia, but also the fact that people are looking at India coming more in the value territory. Large caps look very decent. So yes, there had been a sort of fatigue in Indian equity interest, but that started to turn as well in the near term.
Hi, Sanjay. Good to see you. And, Sanjay, from the morning, for the last 30 minutes or so, our ticker has been saying this large trade got taken place, the other large trade got taken place, this fund has sold, this promoter has sold, So a lot of liquidity actually is getting consumed. The other way to look at it, though, is that, the FIs actually have turned buyers. So some part of the supply is what is finding interest from them, whether you look at IPOs, QIPs, or even large trades. Do you think that, the worry is not that much with regard to the supply that's coming in there? Because you have domestic liquidity, which is holding on to its own. And now the FIs that have gradually been creeping in, if I got the number correct, it's more than $2 billion of inflows in the last 30 days.
I think, look, that is an issue that we must monitor. There is a very, very large pipeline of issuance, and that is what is known. And what we get on a daily basis is unknown issuance as well. Blocks can come up overnight. And my estimate, rough back of envelope, is that whatever inflows into domestic mutual funds you get on a monthly basis, more than that is being absorbed by paper that is issued. So there is no, we used to talk about surplus of liquidity and how there's so much money in India. I don't think that you can repeat those state sentiments anymore at the moment. What I think is healthy, of course, is the development of the market. That all this paper broadens the equity market, it increases options for investors, retail and institutional to participate. It provides better liquidity. And what it does, most of this issuance also keeps valuations in check. So if you are a medium-term investor and if you're looking for earnings compounding over a 3-year period, then this supply actually creates enough opportunities to find such sort of instances.
Got that. What's the most non-consensus view within the India JP Morgan team, Sanjay?
Well, we have a whole bunch of them, but I cannot talk about individual stock situations as of now. I think the most consensus view, which we've held for a while, to be honest, Prashant, is that we like the financials. I think everybody now will agree that the valuations and growth outlook for financials.
No, I mean, thematic non-consensus view. Doesn't have to be stocks.
So what we've been arguing is that the RBI will probably hold its rates flat. I think we're starting to see a lot of chatter that there may be a rate hike coming in India, but we don't think that, at least in our base case forecast, we don't think that that's going to happen anytime soon.
Okay. In terms of a unloved space or a much loved space, I kind of sort of was trying to veer you to one of those things. Yeah.
I'd be surprised, Prashant, if I can find a sector that is not already discovered by somebody in the market.
No, I mean,
given the depth of investor base that we've had.
It can be an ignored space. I mean, what about IT? It's
I'm not non-consensus on IT, Prashant. So I obviously it pops up as a sector that's come off quite a bit, but I don't think that this is an opportunity for us to get very aggressive about it because the future does remain uncertain. Yes, valuations look easier, but so does the growth outlook, to be honest. So, I mean, it doesn't fit the answer, Prashant. It's not non-consensus for us.
Okay, no problem. Don't have to be consensus, non-consensus for the sake of being non-consensus. I think that is also important in that sense. Rima, you had a question.
Yeah, I just wanted to ask you, you said one of the most underappreciated risks is the rise in global bond yields. And seldom will you see emerging markets do well when yields, 30 or even 10-year yields, are at these levels. So, tell us a little bit more about this. What does history tell us? If yields stay around these levels, 4.7%, 30-year at 5% plus, 5.25%, what happens from here?
Well, most other assets will look overpriced if opportunity cost of capital, the dollar opportunity cost, remains elevated. In fact, mathematically, there's a lot of people who've done the work to show that the implied equity risk premiums in the US equity market is at all-time lows. And you could argue that in EM equities, if you DCF it using that discount rate, the equity risk premium would also have shrunk quite a bit. And for investors, risk-adjusted returns are not very elevated. As a symptom, if you will, Rima, in the first 6 months of this calendar, despite the strength in technology stocks, you've had net outflows from EM funds, right? I think all Asian markets have lost about $120 or $130 billion of investment, FII. So this is a symptom of the fact that there is easier returns, risk-free returns to be made in hard dollars. And therefore, the impulse of money coming into EM is much lower. And also the other problem, Rima, is that if you look at growth momentum and the delta in growth, EM economies are doing better. EM ex-tech is not doing that well at all. From a growth point of view, outside of India and outside of EM tech, there is not much happening. So there's not much sort of pull, if you will, with the cost of capital, with the growth differential to bring money into EM assets just yet.
So in the past, when we asked people what will get FIs back into India, India was always seen as a hedge, as an anti-AI trade, more like a hedge. But now that growth is picking up, is the interest from long-only funds, because India is now slowly emerging as a growth player? We've seen some very strong numbers from the entire consumer side in the Q1 FY26, FY27. So are we moving away from the tag or narrative of being a AI hedge to maybe a growth market once again? Or too soon?
Not entirely, I think. People are still, if you have momentum in tech spending and AI spending globally, and these are extraordinarily high numbers that we talk about, right? Then there's a lot of interest still in the tech and tech derivative names in Asia. But what is happening is people are trying to risk manage to say, look, I can't have a majority of my fund in one single theme, so I do need to look for hedges. So that appreciation is improving. Plus, of course, that India is on an absolute basis done better than expected in the June quarter. I think nobody disputes that India will be a structurally growth market over the next 3 to 5 years. It's the relative growth momentum, right? For now, there are other parts which are growing faster temporarily. So I think, yes, interest is improving. But I doubt, I will not hold my breath for a flood of FI money coming in the next quarter or so.
Okay, all right. But where are you in terms of the AI trade? Boom or bust? Do you think it's, that's elastic has got stretched a little bit too much, or do you think there's still plenty of interest there and it still has a long runway?
Well, different answers for different timeframes, to be honest. If you look at the planned capex in the very near term for, let's say, 2026, 27, there is a lot of visible capex on the table. In fact, you argue that 27 capex will likely exceed 26 capex if things go where they are. I think there's enough commentators online who will question the ROI of all of this spending. and whether AI companies can recover or make returns on all this, which is a fair question. I don't think anybody has the answer to it at the moment, but there will probably be a day of reckoning when that question on ROI comes into focus. But if you focus on the capex, I think the momentum appears to be sustainable for now.
Sanjay, consumption has been the standout sector of the earnings season. What's the JP Morgan call? Is this a 3-year play?
Okay, I wouldn't broad brush the whole thing. I think the challenge we're seeing in certain pockets of consumption is the derating of multiples. If you see, multiples had gone up for many of these, let's say, staple stocks quite linearly from 2015 to 2023, 24, and we're starting to see a plateauing and of that coming off. So that is a phenomenon that people should keep an eye on, even if the growth numbers are fine. And this is because Indian staples are looking at a significant premium to their peers in EM, right? So that premium is not justified by the growth differential, to my mind. So I think, yes, growth might sustain, but that derating is something that we need to be a little bit cognizant of. I think if the underlying momentum continues, then discretionary, in theoretical terms, tends to do better than staples. Staples, one tends to buy only if you want to be defensive or if you think there's downside to the market.
So we're not behind the phase of derating for consumer staples. Consumer discretionary is a better pocket along with our financials. What are the other top bets for JP Morgan?
Well, we like the pharma healthcare space. We like defense as a theme. We like certain power and power equipment sectors. Of course, the promise of growth and momentum is reasonably strong. So there are pockets of stocks that we would pick along these lines.
Okay, all right. We'll leave it there. Thank you very much, Sanjay, for joining us. It's a pleasure having you here and appreciate you sort of coming on this morning as always. So that's the picture with regards to the JP Morgan view right now. 10 points, by the way, on the Nifty, 24,350. And, it's basically what 10 is to 1 in terms of advances to declines. More than that, actually, 11 is to 1. So, yeah, is there new stuff? Hindustan Copper is up. It's moved up to, I think, the high point of the day. And, that has seen a bit of a pop, right? So, closed yesterday at about 531. It opened at about 527, so slightly lower. And it's moved up to about 545. Yeah. So that is got large volumes as well. Apart from that, Hindustan Zinc, which is up 4%, is the other one. So metals and miners are having a bit of a day, at least morning. Cyient is up about 5%, and you've got LIC Housing Finance and Chola Finance, and actually lots of stuff coming up, new stuff coming up, which we've not addressed from the morning. There's Rashi Peripherals, by the way, which got smashed yesterday, 10%, which is coming up with about a 2% gain, and it's got some volumes behind it as well. Guys.
Okay. Let's invite then Chalet Hotels. That's the next management on the show now. We have with us Shwetang Singh, MD and CEO at Chalet Hotels. And we'll talk about 3 main points: demand trends, hotel opening pipeline, and the real estate business. Mr. Singh, thank you very much for joining in. We spoke post the Q1 numbers, so just wanted to get a sense of how Q2 has panned out. Have we seen an improvement in occupancy vis-a-vis Q1? What is the current run rate for July and August? And even in terms of the average room rents, are they inching up?
Hi, good morning, and good morning to your viewers as well. Yes, Q2 is actually pretty similar to Q1. There's not much that has changed dramatically from Q1 to Q2, but we have still felt some of the impact of the Middle East conflict. But this month in particular has been good. The next month looks a little muted, and that's to be expected because as the festivals move every year, there can be a bit of a drop, and particularly in Mumbai around the Ganesh Chaturthi, there is a drop in the performance. But overall, this quarter will come in pretty much in line with what the last quarter was.
Okay, so last quarter we had an occupancy of about 65%. That's the broad range we should work with for Q2. And the average daily room rent was about 13,250. We shouldn't expect too much of a change.
Yeah, we shouldn't expect too much of a change. We should be around that number.
On both the parameters, occupancy and on ADR. You were hopeful of a pickup in foreign tourists in the second half of the year. Are you seeing any early signs of that?
Yes, we are. In fact, that's one of the key trends that we are watching very closely because as a portfolio, Chalet tends to gain from international travelers, and we have always been strong in that particular category. And as the sentiments are returning, there was good news that came in yesterday as well from the conflict zone. So we expect that to be a very positive trend for half two. Also, social calendar of half two is typically very strong, and we are also beginning to see some movement on the MICE side. So in general, both quarter three and quarter four are looking quite strong, actually.
Okay, all right. Hi, Mr. Singh. Good morning. Good to see you. When, once Cygnus 2 is operational, what kind of rental revenue are you looking at?
Good morning. Once Cygnus 2 comes into play, which is about 900,000 square foot of commercial, the last rental that we have had is excess of 150 in Cygnus 3. So we do expect that run rate to only be on the slightly upward trend. So at about 900,000 square foot of leasable space, we should expect about 125 crores coming in straight to the bottom line from that particular commercial setup.
Okay, all right. Excluding acquisitions, what is the annual EBITDA growth that you could be guiding for, with the existing pipeline that you have? What you have on the table, what could that look like?
Look, even though we have had a bit of a difficult revenue cycles in this particular year so far, thankfully our asset management practices have kicked in very well, and therefore our margin growth has been steady. Because of that, I have a lot of confidence that we will continue to grow both on the margins and very strongly on the margins, and therefore I would expect at least a early double-digit to mid double-digit growth for this year overall.
Okay, what about Ativa? What's the aspiration out there? Say in the next 5 to 8 years, thereabouts, how do you see that one scale up?
Well, the aspiration is to grow by many, many folds, but sometimes
but 5 years down the line, how should it look at?
Don't necessarily play out, but yeah, certainly with the pipeline that's in play and the fact that we are having a steady growth on our existing portfolio, I won't be too surprised if we come close to doubling our current performance in the next 3 to 4 years.
Oh, that's interesting. All right, what about inorganic growth? We had Mr. Puneet Chatwal, who joined us a couple of days ago. He was saying that they are on the prowl. Have you all heard about any asset that's on the block?
There's always plenty that is being discussed.
Something that y'all are looking at?
All of them are likely to come true. Right now, we are sticking to the pipeline that we have announced. And if you see, there's a lot of greenfield and brownfield projects that are in play for us. So we are very much in the execution phase right now. And we are, of course, on the prowl to look out for any good acquisition opportunities that are out there. Today, at about 5,500 odd in our pipeline, keys in our total keys, including operational keys that we have about 2,000 keys that are under construction or in various stages of development. So that's what we're sticking to for now. And when something comes up, I'll make sure that I'm here to announce it first for you.
Yeah, and make sure you join on CNBC TV18 for sure, Mr. Singh. But you spoke about Ativa. You would like to double it. What is the current run rate it's doing?
So it's not just Ativa. This is the total pipeline that I speak about. It includes all multiple brands. But when it comes to Ativa, we have had a great news. We made a big announcement yesterday with the 4-point Sheraton being announced as or reflagged as Ativa Pulse, an autograph collection. And that's and we are very proud to partner once again with Marriott for it, which means we'll have the power of distribution and Bonvoy coming from Marriott while Ativa builds its scale. So this is our second Ativa, as you're aware. One is the reflagging of the Dukes at Khandala, and this is the second one. We have a total of 1,250 odd keys that we have announced under Ativa, and we are very excited to see how this is ramping up as we speak.
1,250 under Ativa, and for the core, for the traditional business, what is it at? So the total number of keys is what I'm looking at?
About 2,300 odd keys that's in pipeline right now. So we'll go from 3,300 odd to 5,500.
And by when do you get to 5,500 keys?
Yes, that is correct.
No, in 3 years, in 2 years?
In about 3 to 4 years, we should be finishing the execution of these. So this is our announced pipeline as of now, and we expect to finish it by FY 29-30.
And what will the balance sheet look like, say 3 years, 4 years down the line, as you get to the size of 5,500 keys? What would be the balance sheet? What would be the revenues and the margins?
Revenue is a bit difficult to look out that far in the future, but we expect, as I said, aspirationally, we are expecting to double our current performance at least from where we are in terms of both revenue and EBITDA. And EBITDA should actually grow a bit more healthier than revenues. So that's the plan. In terms of balance sheet, as I said, as I've maintained before, we are very well positioned. We have great internal accruals. We have headroom to grow from because of the levels of debt that we are at today. And most importantly, our annuity business is throwing up a lot of cash, which will allow us to actually service the current levels of debt and the debt that we will require for the future. So we are very well positioned from a balance sheet perspective as well.
How is this festive season? I mean, there is still some time away, but you do get pre-bookings. Now that we enter into the strong period, is it going to be similar to what we had last year or the year prior? Or because the macro indicators, when we look on the ground, are looking better, the earnings have picked up. Is this festive season going to look better for you?
No, absolutely. As you say, the tailwinds are brilliant, and typically when the world comes out of a bit of a crisis, the rebound is always can be expected to be stronger than what it was before, and that's what we are banking on as well. The early trends are also looking very good. The bookings are looking very good, and as I said, the social calendar is as strong as ever. So we are looking very good for half two of the year.
Got it. Okay. All right. Mr. Singh, thanks a lot, sir, for joining in, giving us all of those details. You have a plan. We wish you all the best with regard to execution, and we look forward to chatting up rather soon.
Thank you so much. Bye-bye.
Okay, time to slip into a short break. On the other side, we have the management of MTAR Tech, who's waiting for us. Remember, a lot of news flow in the defense space, and they just bagged a small order just around half hour or so ago. We'll get the management. Mr. Reddy will be joining in to detail all of that.
Okay, well, 24,370 is where the Nifty is at. You know, it's picked up a little bit. Absolutely flat. 5 down, 5 up, that kind of open. And you got about 30 on the board as we speak. Well, the next management is MTAR Technologies. I mean, you know, works across cutting-edge sectors, be it, you know, space, defense, the nuclear space, and provides precision components to a lot of these sectors, a lot of leaders in these spaces. Stock, of course, has done phenomenally well. Mr. Srinivas Reddy is with us, Managing Director at MTAR Technologies. Mr. Reddy, good morning. Great to have you with us here. It's always a pleasure, sir. Prashant this side. You know, the latest, of course, is this DRDO news flow, which I will just get to in a bit, Mr. Reddy. But if you'll allow me, I just want to start with the big driver for you, which has been this, you know, AI boom in the US and your connection with Bloom, right? Bloom Energy. Bloom has raised its 2026 revenue guidance to about $4 billion or so, right? I mean, they've got Oracle agreement. They've got Brookfield, which has expanded Bloom's financing framework to about $25 billion. Could you give us a sense, sir, how much of what you are projecting here now is already showing, there's this guidance raised from Bloom and what we are seeing there. Give us a sense of how much of that work has flown through already and how much is yet to come.
Oh, there's a lot more orders to come, but we already have enough orders on hand. As I said earlier, we would like to relook at our guidance by end of Q2 and then take it forward from there. We had given earlier guidance of 80% in revenue growth, but we'll definitely do better. But we would like to reassess that by end of quarter 2.
Okay. No, I'm not that guidance. So yeah, 80% is strong, and you're saying it'll be even stronger, most likely, but at the end of the second quarter. So I'm not going to ask you to do it today. But give us a sense of what are you hearing from Bloom in terms of the opportunity, the work. I remember a couple of months back we had a conversation, and at that point there was this news of a pushback with regards to a data center in the US and perhaps risks to order. Just give us a qualitative assessment of what you're seeing and from your partner, which is Bloom Energy.
No, absolutely. There is a very positive feedback, and there's nothing like any of those issues which have cropped up in our discussions. And we are right on track in terms of what we need to execute during the current financial year and also the next year. And we have a clear roadmap for the next 5 years as well. So we have all the positive news from their side, and we are actually working towards our quick implementation of our expansion plans to cater to the requirements of the customer. And we are on track as well on the implementation plan on the CapEx side as well.
Okay. So just one quick point to finish this off. You're expanding here, but will you need a footprint in the US as well? I mean, there is increasingly more and more kind of it's not new, but it's, make in America. Will you need to have a footprint in the US as well?
Not really required at all. This is a kind of technology which already Bloom has its own facilities in US to do the final assemblies right now. So the majority of the work is being done here and the rest of the assemblies are done there. So that's not required to have a footprint in US.
Okay. All right. Hi, Mr. Reddy. Good to see you in, sir. What proportion of Bloom's orders come to MTAR? If you could help us out with the rough number. When we look at if we talk about hot boxes or the other components, from Bloom, what proportion comes to you?
I think we don't have the exact percentage right now. It's all about how much we can take and how much we can execute right now, right? Earlier we had a majority percentage, but right now the situation is that the more we execute, the more opportunities we have, and we have a very strong order book in keeping that forward.
So should it be, sir, approximately 2/3 of Bloom's orders comes to MTAR, the remainder I probably goes to someone in Korea or Taiwan? Would that be a fair estimate? 2/3 of their orders?
More or less, that's how it was, and that's how it is even now. So we need to really focus more on implementation of expansion plans and execution right now, and that's what we're doing.
Yes. Okay, all right. And as a percentage of your order book, how much is Bloom?
I mean, I think 65% is Bloom right now in the order book what we have today.
Okay. And apart from Bloom, is there any other customer in the clean energy segment that you're looking at, where you're getting orders from?
We are looking at various customers, but right now we have to evaluate everything and see, and the facilities have to be different. There are a lot of NDAs which have been signed, so we cannot mix up the technologies. So we are looking in that direction, but it's too premature to comment on that, right?
Ex of Bloom, in the clean energy segment, what is the potential opportunity? And then from there, you'll be getting some part of those orders. But if you could help us out, ex of Bloom.
So there are a lot of opportunities which already are, a lot of inquiries are coming in, but we are carefully evaluating everything step by step. Because we have a huge responsibility to take care of the current customer in a big way. And then we look at the others. So we are looking at other opportunities as well. For example, the data center infrastructure build up with another customer, which we're working on right now. So that's going to be another opportunity in the similar segment as well. So we're looking at various options and how we can execute them and how we can take it forward.
What we are hearing very clearly, Mr. Reddy, is that while we are asking you about new orders, new opportunity, you are very squarely and absolutely rightly so. I'm not saying you're not going after new customers, but you have enough in your plate. So you want to be very focused on executing what you have, right? Even as you get more orders. Focus is not on new, is not on going after chasing new orders, but on executing well and in time. Is that what you're saying?
Yeah, we have very strong order book. Exactly. We have very strong order book and a lot of orders in not only in clean energy, but in different segments that we are getting. So the focus is primarily on execution because right now, there is no limit to what, kind of orders we can get in various segments. So it's more or less on the execution side that we need to focus and take it forward.
So this order book of 5,000 crore plus that you have right now, when will you be executing it? Will it happen in FY28, FY29?
See, most of these orders, unlike any other order book, it's all, most of them are like within 1 year, 2 years at the maximum, a very marginal portion in 3 years. So that's the good news. I mean, the more orders we get, it's for the subsequent years. So it's a very short cycle kind of orders, majority of them within year and a half.
And how much better than 80% growth can you do for FY27?
No, I couldn't hear you that. Can you repeat
I'm
that?
saying that last quarter you revised your guidance from 50%, you're talking about an 80% growth for this year. But you're saying that there is a likelihood you do even better and you will give us the actual number in Q2. Just trying to get a sense based on the demand, the pipeline, your execution, how much better than 80% do you do for this year?
I can't really comment on that, but definitely we are looking at the various aspects to it in terms of our expansion plans and also the ramp up that we are looking at. So we'll have more clarity by end of the quarter, but definitely a lot more than we'll definitely do better than what guidance we have given, but we'll come out with the exact percentages by end of Q2 for sure.
Is your growth constrained? These are all short cycle orders, as you said, 1.5 years. Is your growth constrained because of your ability to execute or capacity in some way and not demand? Could growth have been higher if you were able to execute? I mean, what's the bottleneck right now, if at all?
There is no bottleneck. There is a gestation or a moratorium period for putting the capacities in place, and that's being done on highest priority. So I don't see that as a bottleneck. It's a minimum time frame required to implement such capacity expansions based on the demand that we have. And we are planning that very well, and we are on track with that. That's why we are pretty confident of doing better than what we have guided for.
Okay, now, Mr. Reddy, talk to us a little bit about what's happening on the nuclear side, sir. We had spoken about, you told us, this is, I think, back in April, in our conversation in April, that, that 70% of the core of the fast breeder reactor prototype was done by you, right? And it took a long time, a lot of R&D, etc., and that you were expecting this to start to be rolled out. Has there been progress there? What's happening on the nuclear opportunity now that the Shanti bill, etc., has also gone through?
I mean, right now on the nuclear side, there are a lot of opportunities. I mean, fast breeder is one among them. Fortunately, the criticality was achieved, and what I hear and from various areas is that they want to work towards building another couple of more reactors. Obviously, MTAR will have a great opportunity there. And then and we have another 700 megawatts Mahi Banswara 4 reactors which are going to come in. So a lot more reactors are in the pipeline. We already received, I think we have informed the exchanges today, I guess, in terms of the refurbishment reactor order which we have received today for around 125 crores. So orders are just flowing in from the nuclear division, which we never had in the past. And that's going to be a continuous uptrend in terms of not only the order booking, but also on the execution side going forward in nuclear division.
Yeah. So you're saying that 3 to 4 additional fast breeder reactors, right? Which they want to set up. Which was, I remember you had said that at that point as well. They'll have to build out a few more operational, and then before you can move to the next step, right?
Exactly. So probably there are 4 reactors. They'll start with 2 and then move on to the next. That's how it's going to be, I guess. But I'm not too sure about the timing of this. We are yet to get clarity.
You had said that for you, the opportunity could be about 1,500 crores per reactor, right?
Yeah, that's a fair opportunity because we have done the majority of the core of the reactors when we first did the fast breeder. And we had worked almost for 14 years for that. So it's a long time to build it.
Yeah, I remember you sort of explained this. With regards to space, right? Again, a fair bit of excitement. We are hearing all the news flow around the first private sector launch, putting a satellite into orbit by Skyroot. I think you've got other companies in behind with their launches planned. Give us a sense of what's happening in that area with regards to MTAR.
No, we are not looking at developing any SSLVs at this point of time. We have done our preliminary work, and we primarily work with ISRO. And obviously, we have our own plans in terms of to wait and watch and see how this goes. But we are one of the primary suppliers to ISRO, and would like to continue that way for some time. But parallel work is happening in terms of the various developmental activities which the R&D is working on right now. So we'll get back to you at appropriate time. Well, it's very crucial not to burn a huge amount of cash for a company like MTAR in areas like this at this point of time.
So, so you're saying that you have a prototype for a rocket ready, but you're not going to be building it anytime soon?
Yeah, we have been working on the design. We're working on various things over a period of time. We have a separate team for that, but we're not going to take it forward as of now. We'll see how it goes in the future, what kind of market situation we are in. We would like to do a lot of risk analysis in this area and then see how we can take it forward.
Okay, so you continue to supply to ISRO, which you will, which you've been doing in any case as one of the primary suppliers. But not going into it on your own in that sense, like a private space company, so to speak, right?
Yes, exactly, yes.
Yeah. Anything else investors need to be cognizant of in terms of risks? The opportunity is there. I think we've spoken about all three segments, right? Sorry, I just want to ask you about defense as well, Mr. Reddy, before I get to risks. This latest news with regards to DRDO saying that they're going to supply missile defense transfer missile technology to private companies. Could you contextualize that for us, Mr. Reddy? How does MTAR see it? Is MTAR going to be interested?
Yeah, let's see how that goes. I mean, we have been working with the DRDO for almost for many years right now in various sectors, and we would like to evaluate that and see how it goes. And we are working on various projects already right now, and we're expecting a lot more orders to flow in the defense sector during the current fiscal year. So we would like to evaluate it step by step and see, and obviously we will participate if we find that is interesting for us on the short term and long term as well.
The technology transfer, sir, was happen. I mean, DRDO used to supply technology. I mean, this is just an academic question. Used to give technology, right? Earlier as well to companies like HAL and is this new sort of in that sense directive notice from the government? Is this for the private sector, which was not happening earlier and that's not going to happen, or this is just a enabling kind of a notice, a more clearer direction?
Yeah, it's just an enabler right now, and let's see. We have to go into the finer details of it. So basically, a lot of private industries have worked with DRDO in terms of developing various projects. So probably it's a combination of everything that they want to do in with various companies. So probably an enabler. Let's see how it goes moving forward.
You're saying nothing changes for MTAR in that sense because of this, right? You will look through it, but as of now, nothing changes with your plans.
Yeah, nothing changes. Yeah, we already have certain plans with defense, and if anything comes up, we look at that opportunity and then take it forward.
Okay, just 30 seconds, Mr. Reddy. Any risks to the MTAR growth story? I think you've told us I think the risk is execution. You didn't put it that way, but you said you're focused on execution. So I'm assuming you don't want to slip on that front. But anything else?
I don't think there's any specific risk. We have taken all that into consideration while giving our guidance, not only for this year or moving forward as well. And when I say focus on execution, it need not be the risk. Our focus is to ensure that we execute better, and a lot of demand that we need to cater to.
Okay.
So that's been the main focus.
All right, Mr. Reddy, the other risk that people talk about is the kind of business you're getting it from Bloom. For now, they're a little bit concerned about that. But as you said, adequate business coming from Bloom, and you're looking at newer customers as well. So probably you'll get orders from there as well. We appreciate you joining in, sir. Thanks for joining in, giving us some clarity with regard to business, how you see the industry shape up as well, and how you expect business to progress from here on. That said, let's get back to the markets. We're trading in the green. It's a good start to September. Vinay Rajani of HDFC Securities joins us. Vinay, give us a call on the index first and a couple of trading picks as well.
Yeah, good morning and thanks for having me on the show. So yes, back-to-back follow buying can be seen, and today Nifty has crossed the yesterday's high. So yesterday there was a nice recovery, and today backed by the data, some positive data is there, and on the back of that we can see that Nifty is performing very well. We feel that Nifty is headed higher now. Now Nifty is trading at 24,365. We feel that Nifty is headed for the next target of 24,600 from here, because some good development happened technically. Yesterday we saw that the August series expired, and we have seen a long build-up in the August series. Where Nifty has gone up by 1.5% and open interest has also risen in the August series. So long build-up is there in the Nifty. Bank Nifty has seen a short covering. So 58% of the stocks in the August series have either seen long build-up or short covering. So that is a positive sign. So we believe that Nifty is headed higher from here. 24,600 is the target. And yesterday's low becomes the strong support now, which is around 24,115. So unless that is breached on the downside, we should remain positive. And we feel that large caps can do very well. F&O stocks can participate from here. Looking at the overall development, mid-cap and small caps have run up a lot, already trading near their all-time high. They could see some profit booking from higher level, but we feel that F&O stocks, top 200 stocks can do well from here, and there are good chances of doing trading in the long side in the index as well as the most of the large cap stocks from here.
Okay. What about any stock recommendations?
It is up by 4%, but still it looks like that it is headed higher. Backed by the commodity price, the Hindustan Zinc is backed by the zinc is at all-time high in the commodity, so that is also augurs well for that stock. And silver has also started showing some momentum. So Hindustan Zinc around 621 can go long. 605 should be the stop loss. On the upside, 650 should be the immediate target. The second stock is from the auto space. Ashok Leyland is looking very strong after some consolidation. The stock has resumed its uptrend. So around 177 one can go long. 172 should be the trading stop loss. On the upside, we are expecting an immediate target at 185.
Okay, thank you very much for that. It's now over to Mangalam for a check of the Sensex derivatives at this hour.
Well, we kickstart a new series on the NSE, but we have the BSE expiry still, which is tomorrow. So as a result of which, we're looking at Sensex right now. The Sensex is holding between the 77,800 and 78,000 mark. And that's pretty much where we're likely to stay, as the options data is suggesting as well. On the way up, obviously, the 20-day moving average, that's where we are. 77,925 is where the Sensex is. If you look at the 20-day moving average, it's 77,975. So that's something we'll be tracking. On the way down, 77,500 has the 50-day moving average as an important support. But the active options, if you look at the 78,000 call, that's fairly active, premium for almost 200 rupees, tells you around 78,200 is where supply is likely to come by. And the 77,800 put, however, on the way down is equally active as well. That has a premium of 100 rupees, telling you around 77,700 is where the support is. So if you're looking at a range on the Sensex ahead of expiry tomorrow, it's the 600-point range between 77,700 to 78,200, 78,300 thereabouts. So that's something that we'll be tracking. Currently doing well for the frontline index, hovering around the 20-day moving average.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and talk commodities. Manisha Gupta will join in as always. Welcome back. As promised, let's talk commodities. Manisha is now joining in. Manisha, what's catching your eye today?
Well, a couple of commodities on my radar right now, and I'll take you through all of them. I'll start with the crude oil prices first, because it has been such a sharp decline in the overnight markets, where we saw the prices decline by 5%. Yesterday, same time when I was talking to you, we were trading at $92 a barrel. We are trading at 86 right now. So it has been nearly $6 of a decline that we've seen in the overnight market, and Asia looking at some more follow-through selling on your screen therein. Today is the third straight day that we are looking at decline coming for the crude oil prices. Well, 2 or 3 factors which are weighing on, and that has led the premium coming off the markets. One, of course, is about reports about ceasefire between US and Iran. I mean, this has been coming in from other country heads and not basically from US and Iran, but the markets have read clearly a lot into that. The second point really is about Iran and Oman, which is as of now discussing a temporary joint maritime corridor in Strait of Hormuz. That means you could be looking at oil supplies coming back. And then you also have the US, which has come out with various statements starting from Monday onwards, where new sanctions against 60 entities and individuals associated with Iran have been talked about. But what penalties, when does it begin is something that is not very clear. And then yet again, markets have led, that is what has led to some more selling coming in for the crude oil prices there. The other one on my radar clearly is rubber prices. With the hike in crude prices that we've been working with, still trading at around 85 to 90, we've seen rubber prices continue to be on the stronger side as well. It also has to do with Thailand, which is the largest producer of rubber, also hit by heavy rains. And then end of peak tapping season in Southwest Asia is yet another reason. You would be looking at season getting over, and then whatever is available will be used for next few months. The risk of El Nino in 2026 going into the next peak season is what the street is also worried about. And then there is uncertainty, of course, about the Middle East conflict there. Third and final commodity I want to bring to your notice is zinc, because we're trading at more than 4-year highs onto that one. $3,800 a ton seems to be holding for a second straight day right now. There are disruptions in major mining operations in various countries. That has been supportive. There also was an interesting report from HSBC which says that the global zinc mine output will decline in this year. We could be looking at a deficit as well. LME inventories have continued to decline. And even as China has enough zinc stocks, but it is other countries outside of China which clearly are trading on a tighter note. And then there has been stronger manufacturing activity coming in from Europe, US, that has been supportive as well. And finally, I want to take you through on what commodities have done in the month of August till time. So barring crude, which is down by 3%, almost every other commodity seems to be heading for a stronger August. You have gold and silver up anywhere between 15 to 19%. That's exactly what we are looking at in sense of base metal prices, where you have copper 6.5%, zinc clearly outperforming with 7.5% of gains. Then you have aluminum trading 2.5% on the higher side. And then cotton, rubber, many of those agriculture, industrial commodities also seem to be doing well.
All right. Well, Manisha, thank you very much for that. So that's commodities in focus. We'll take a break. We're back. Lata speaks with Vele and Subaya, chairman of Cholamandalam Investments and CG Power on the semiconductor space, power finance, and a lot more that the group is working on. Stay tuned.
here's some interesting data for stock investors. If you start from 2021 to 26, the CG Power stock has risen 22 times. The Cholamandalam investment stock has risen 4.8 times, and the tube investment stock has risen 3.7 times. If you took the total market cap of these three stocks, in 2021 January, it was 54,800 crores. Today, the total market cap is 2,98,500 crore. Now, why do I take 21 as the date? Because in November 2020, Mr. Reliance Subbiah took charge as the chairman of Cholamandalam Investment. And later in the same month, he took charge of CG Power as its chairman. So there's something in Mr. Reliance that has made this huge rise in market cap. So naturally, for the benefit of all the viewers here, we have with us Mr. Reliance Subbiah, the chairman of Cholamandalam Investment and CG Power and Tube Investments. Thank you very much, Mr. Reliance, for your time.
Thanks, Lata. Thank you so much.
Well, let me start at the beginning of Cholamandalam Investment. Because of the announcements made by the group and the news, can Cholamandalam Investment investors be sure that you will be in charge of the company in spite of the group realignment?
Yes, definitely, Lata. So I think this has been the discussion that we've had several times, and this question has been asked several times, but definitely the answer is yes.
Okay.
It's something that it's a role that I'm 100% continuing and will continue to serve.
So it is something like this. Your group of the family will be the dominant shareholders in the manufacturing, CG Power, Tube Investments, etc. But in Cholamandalam, you will be the executive leader, even if there is somebody else with a dominant shareholding. Is it like that?
The general thinking at this stage is that basically we have aligned around three alignments that basically are managing different sides of the business, and that thinking continues.
Okay, so you will be in charge of Cholamandalam Investment. Okay, that's the family part. Now I want to come to semiconductors, which is the real purpose of me coming over to meet you here in Chennai. Just give us an idea. Your first batch of chips have been shipped, the packaged chips. I can imagine that you cannot give us a view of your revenues because it is too short. But can you tell us how much capital will be invested? Or even 5 years down the line, what is the kind of returns? I mean, investors need an idea, CG Power investors.
Absolutely. So I think that let's break it down into two sets of things, right? So I think that the key focus for us is to get to a stage where we get to 70% utilization on, about 4 years to get there to 70%. But the way to look at it also, Lata, is that this is not just about, it's not like most other businesses. You could basically look at it and say, okay, now I've got production capacity, I'm going to put out this many tons of steel. So this is not about putting out this many either tons of chips or a number of chips. Because if you take advanced packaging, right, the revenue you would get per chip can actually be over 100 times or even sometimes 300 to 400 times what you would get for a legacy chip, right? And by the way, the pricing on chips can also, on the same chip, can vary, 5 to 1 depending on the supply and demand scenario globally, right? So right now, packaging is in short supply, right? Especially because all the leading packaging firms are directing their capacity towards AI.
Okay.
Right? So they're moving towards more and more advanced packaging, which means that the entire packaging space itself is in short supply right now, right? Which means that pricing is beginning to go up.
Let me ask one specific question, at least for the benefit of the CG Power investors. At the moment, there are people who are guessing that they should, if they are making a sum of the parts analysis of CG Power, the DCF valuation of CG Power, one person says is about 30,000 crores or 32,000 crores. People are trying to estimate what is the returns and therefore what is the PE they should give to this unit, because it's not like the other units. This is a specific unit of CG Power. So if you can give them some numbers to help them, evaluate, their future investments.
No, honestly, like I've said, right? I mean, we estimate kind of revenue from this facility to, and again, that will vary depending on, where the market goes, right? So revenue from this facility could be, anywhere from, 500 to perhaps 500 to 600 million, depending, right? Currently, I would say 500 million, right? But it depends on so many factors, and honestly, I think the only way to look at it is that the country is beginning to make the right moves, right? And we want to be a significant contributor, a significant player in helping this happen for India, right? And that's really our initiative.
Fair point. I'll try and come back to it if we have time. I have to ask you this about Cholamandalam investment. There is this revolving credit kind of ban which is on the cards. It's a draft rule. Is Cholamandalam investment affected at all?
It doesn't affect us much. It's less than 1% of our AUM. So I really don't see that kind of affecting us.
Okay. Then let me come to the other big question I have about Cholamandalam. It's kind of, I have covered stock markets and especially finance and banking for 25, 30 years. It has, burst into the scene in the last 5 years in a very big way. It was always a 20% CAGR company. But in the last 5 years, from 21, it is a 30% plus, 33% CAGR. What went right?
So I would say the biggest shift is that predominantly we were in two segments, right? We were in vehicle finance and then loan against property. Right? Those were our two primary segments. And then what we realized is that we were not kind of diversified enough.
Only personal loans.
And personal loans and unsecured being one part of it, but we weren't even growing our home loan business significantly, right? The housing loan and mortgage business. That's, by the way, been our fastest growing business over the last 5 years. So there's so many segments in India that are still significantly underserved. And just getting into and serving those segments more effectively is what's helped, both broad-base Chola's asset book and also then get a higher level of growth.
What about the future then? I think you'll have about 56% still vehicle or 55% vehicle.
Yeah.
Do you see yourself plateauing there, or will it become even more diversified?
Vehicle will come down. So vehicle will come down to under 50%.
Gold loan is an attraction?
Gold loan is something we've recently got into. But like I said, the largest growing part of our book is the housing loan business. As a book growth-wise, housing loan and then loan against property, those two segments are the ones that have been growing the most.
Okay. And right now, since you are in an executive fashion in charge of Cholamandalam, are margins looking better with all this FCNR money coming in? Is the rest of the year better than the time went by?
Definitely, we see a situation where ROAs are beginning to go up. I think it's a confluence of a couple of things. One is that the performance of the book overall is also improving. That combined with our overall mix is allowing ROAs to expand from where they've been for the last couple of years.
Okay. Oh, that's good to hear. I just noticed in the last 5 quarters, there's a small inching up of NPAs. Nothing alarming. But is this a cycle which we should be prepared for, that, we had 4-5 years of NPAs coming down for the whole system, but it has bottomed out? Should we?
So overall, if you look at it, actually, I think the correct way to look at it is look at stage 2 and stage 3 together.
That has inched up a bit.
Stage 2 and stage 3 has actually improved. We've improved in stage 2 and stage 3 performance. What you're referring to perhaps is that we did have NPAs that came out of our personal loan, where we basically kind of pulled out of a lot of partnership relationships, and that book coming down basically pushed it up a bit. And slight inching up on the vehicle side. But overall, I think the more important thing to look at is stage 2 and stage 3, and we see that coming down, so we're quite
Okay, so
encouraged.
it's a minor rise, if at all.
Yes.
Let me come to CG Power. CG Power, let me take the power business, power and industries. Semiconductor is a huge giant in itself. Your power did well, but the industrial systems was a little slower. Is there a capex cycle issue?
So first off, I think the more important thing to look at is what is happening to power, right? And power systemically is going through an upcycle. Just because there's so much demand right now for the entire power chain, right?
Yes.
India has basically talked about, basically significantly enhancing its power generation, not just data centers, power generation overall. And then that means a lot more transmission and evacuation that you need to do. So that itself is putting a lot more load on the system. Data centers both here and globally. But the overall shift, right, we're using more renewables. So renewables, then we need to kind of get them onto the grid. And so connecting them onto the grid. And then on the other end, kind of, with all the increases in demand. So this as a trend really looks like it's going to be,
So you see
continuing
power
for a while.
CAGR,
Yes,
vigorous.
it's grown. It's grown. I mean, it grew at like 50% almost, right? And so that's
was
been,
very
and so that's been phenomenal. And we're seeing, I mean, our unexecuted
pace. You think it can go?
Well, our unexecuted order book is now over 14,000 crores in just on that segment. We're opening a new facility, a new transformer facility in Madhya Pradesh, and that's actually happening next week. And that'll be, I actually think it might be the largest transformer facility in India, right? And so we're significantly expanding capacity because there's both domestic demand as well as global demand.
No, I was going to come to power in great detail.
Oh, sorry.
But thank you for answering that. You therefore see that demand continuing.
Right.
There is no saturation at any point in the near term.
Well, I'll be cautious about saying that because I think all industries, by definition, will be slightly cyclical. But the kind of tailwinds supporting power right now are very significant.
What about the various units you have under tube investments? I mean, I can go on. You have a bunch of well-performing businesses. You have medical devices, contract research, clean mobility, TiVolt. I mean, I can go on. Will you bring each of these to the market?
So I think it's too early, right? I mean, the first thing we're focused on is just building these businesses and just building the businesses right. But if it requires it at some point in time, we're not averse to it at all.
Okay, but the way Shanti Gears behaved, as a reporter, I got the opposite impression. I mean, it jumped 18% because you all have increased your stake from 71 to 73. Is that a way towards, reverse merger or something like that?
No, I mean, I think it's too early to kind of think through that. It's basically, there was, we definitely see that in businesses we're interested in, we want to continue to have a significant shareholding and continue to improve that. So when there was an opportunity to do that, we did it. That's the way I look at it.
That's true, but 71 to 73 is perilously close to 75, where the minimum public shareholding kicks in. That's why, the stock went up so much, 18% in a day, because of all these chatter in the market. Will that also be on the horizon?
So there's no thinking of that right now. Okay. There's no thinking.
Okay. But even...
Shanti in.
Okay. It remains a separately listed company.
Yes, definitely.
Crude prices fall for the third straight day, down nearly 3% overnight as reports emerge of Iran and Oman agreeing to a temporary shipping corridor in the Strait of Hormuz. Oil marketing companies trade with gains on the back of that.
Hindustan Zinc rallies as zinc prices hit the highest levels in 4 years on the back of a disruption at major global miners. Jefferies also raises the target price on the stock to 750 rupees from 600 earlier. They're expecting a zinc production deficit through 2026. HSBC expects global output to decline this year.
Signed at its investor day says it views double-digit growth as a priority and aims to hit an EBIT margin of over 15% in the near term as it transitions to new business models. The stock rallies over 6% in trade today. Brokerages bullish on the stock.
Grow under pressure after a large block trade which sees 2% equity change hands worth around 2,500 crores. Earlier, investor Ribbit Capital is likely to have sold part of its stake in the company.
And we have beer seller United Breweries up nearly 1% in trade today as it's launched Heineken Silver in the states of Kerala, Odisha and Madhya Pradesh. They aim to double share of their revenue from premium offerings to 20% over the next 2 to 3 years.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and the markets are as flat as we can speak actually as we speak because we were higher by close to 30 points or thereabouts. Now we're holding more or less steady. Mangalam, new series, September series. Let's see how it goes. Traditionally, it's been more or less a flattish kind of series as per what history suggests.
Been a flattish series, and flattish is what the market has started out as well. Let's see, we do have a bunch of cues to track this series, which include the likes of watching oil prices and what takes place in the geopolitical scenario as the world progresses along into September. But let's get in Ashish Kyal of Waves Strategy Advisors for a quick technical check on the market. Ashish, for the longest time, the Nifty has been consolidating. You typically have specific levels which preempt a big move on either side. So which are the ones that you're tracking on the Nifty and the Nifty Bank this morning?
Morning to you and also to Nigel and all the viewers. If you look at the overall market trend, yes, the markets have been moving majorly due to the CAS or because of the gap, and the intraday movement has been very lull. That is what we can clearly make out. Even yesterday, what we saw was a 70 points move on the upside because of the CAS closing. And today, again, after a gap up, we are just consolidating in a narrow range. Having said that, I think the overall undertone is going to be on the buy side. If you look at the premium of Nifty futures compared to Nifty, it's nearly around 180 points, and that's a huge enough premium that is suggesting there is some kind of a buying that is there emerging in the future space, and eventually the spot should move towards the level of 24,500, 24,550. So I'm going to use any kind of a dip as a buying opportunity for the move towards 24,550 on the upside, and on the downside, the important support level is going to be around 24,180 levels for Nifty.
Got it. Okay, all right. What about individual stocks then, Ashish?
From the buy side, there are individual stocks that has been buzzing around. If you look at the small cap index has been near the lifetime highs, the mid cap has been doing that. So the individual stock specific market is continuing here. We can see that PB Fintech is once a stock that has shown very strong momentum in today's session. So any dips from here can be an opportunity to buy as long as the stop loss near 1815 is maintained for the target of 1975. And the next stock on the buy side that we can clearly see is that Eclux. So this stock has emerged as a very strong outperformer within the space. And we can see that after forming a consolidation pattern, Eclux is breaking out again. We can expect the target of around 2100 on the upside for the stock. And the stop loss can be maintained at 1890 levels.
All right, take that point. Thanks a lot, Ashish, for joining in and giving us your call on a lot of these stocks as well as the index on the whole. Slightly positive is what you feel for the frontline index. We take a short break, come back. On the other side, we have the management of Gaja Alternate Asset Managements joining in after the company's steady listing on the exchanges, trading about 17% higher versus its issue price. Gopal Jain joins in. Welcome back. Let's talk about the new listing on the block right now. We have Gaja Alternative Asset Management made a steady debut, listing with gains of almost mid-teens when it comes to its issue price. Compared to its issue price, still holding at a decent premium as well. This at a time when the markets moved off the highs and we are seeing some consolidation. Gopal Jain, the MD and CEO of Gaja Alternative Asset Management, joins us on the show to discuss the company's strategy going ahead. Thanks a lot, Gopal, for joining in, and congratulations on the listing as well.
Thank you. Good morning.
Good morning. So, the last time you joined us, and this was when the IPO was announced, you did say that it's a highly modelable and predictable business. This, when the question was around the increasing carry income that you got. So, could you give us a sense in terms of predictability on this business? What's your average time to carry across your fund life cycles, so we can actually model that when it converts into P&L over the next 2 to 3, 4 years, if you could give us a sense on how that plays out?
Absolutely. The amazing thing about our business is there's a tremendous sense of transparency. We have been fiduciaries for over 20 years. We have investors from over 20 countries. We are currently managing our 4th fund in the RHP. It's mentioned that we will be shortly raising a new secondaries fund, our 5th fund. The assets in each of these funds are very well known. The methods of accounting are transparent. We are a regulated business at the fund level, and now as a listed business also we are regulated. And the good news is it's a very simple business in essence, because we have kept the complication out. How all of our management fee, all of our share of profits, what's called carried interest, and all of our sponsor gain comes to the AMC. Where the funds are, how the management fee is computed, where is the carried interest due, what are the exits in the pipeline, how is the TVPI, the NAV of the funds growing? This is all highly transparent. This is what gives me the confidence. And this has also been the opinion of the investors that we've engaged with, that once we are past these basic steps, the business is predictable. Also what helps, the business is modelable. Also what helps, may I repeat, is 2 decades of history as a fiduciary.
All right. Hi, Gopal. Good morning. Nigel on this side. Congratulations on the listing.
Good morning.
You and the team seem quite thrilled as you'll rang the bell out there. So a lot of responsibility on you guys now. A quick question with a couple of other verticals of the company. Credit as well as real estate. How do you plan on scaling these businesses?
Well, we are currently not in credit and real estate. Our strategy to build a platform is clear. It's to scale up our flagship strategy. The flagship strategy provides growth capital and buyout capital to India's mid-market. We've also spoken about adding a secondaries business. Yes, you're right. There is an opportunity for people to do more. We haven't yet spoken about that.
Which is why we wanted you to speak about that as well. But, if you could give us a sense on how much of your carried interest is concentrated on 1 or 2 funds or 1 or 2 portfolio exits. Because, if the vintage underperforms, then the overall growth narrative goes for a bit of a toss or a tizzy. So if you could give us a sense on that, how much of it is concentrated in 1 or 2 funds or 1 or 2 portfolio exits?
That's a great question. You see, we follow the European waterfall, which means the share of profits or carried interest is on a fund as a whole, which means that once we are in carried interest territory, then it is no longer about the performance of that particular asset. It is not a deal-by-deal carry. It's not an American waterfall. So this is what helps in the predictability and modelability. We're an increasingly mature firm. Right now, there is, the number of funds that will come into carried interest territory will grow over time. We are young by the standards of global asset management. We're only 22 years young. But as we become progressively more mature, more and more funds will come into the territory of share of profits. But remember, share of profits is not on a deal-by-deal basis. Share of profits is fund as a whole. It's a European waterfall.
All right. And also, Fund 4, it does carry a clawback provision. Now, given carry is nearly half the income, as you pointed out earlier as well, what's the maximum quantum that can be clawed back, and is it provisioned anywhere on the balance sheet?
Yes, this is part of standard boilerplate. But again, because we are European waterfall, because we first have to return the fund to our investors, then we have to return the hurdle to our investors, only then does our share of profits come. So theoretically, the chances of a clawback are minimal, but boilerplate contains clawback. In our last 20 years, we've never seen clawback, and you've seen how India has gone up and down. So this is the point, I'm glad you've brought this out, that the nature of our carried interest, the European waterfall, the carried interest on a fund as a whole, makes the chances of a clawback relatively low.
So no provisions made either, right?
Yes.
All right, Mr. Jain, since you're batting all of the questions, just want to clear the air on this as well. There was an FIR that was there, right? What's the current status, and what happens to the promoters' fit and proper standing with SEBI if this particular FIR is not squashed?
Well, I wouldn't like to, it's all the disclosures have been made in our RHP. Please remember that we invest in a number of companies over the years, right? So there is a hazard that we face when we work on behalf of our companies. When we work on behalf of our companies, sometimes there are hazards we face, and because we are on the boards of these companies, there are these hazards we face. But as far as the business is concerned, the business is very well insulated from such hazards because we've been operating in this area for over 2 decades. And this is, so as to say, I wouldn't say it's par for the course, but it's collateral damage as part of doing business in India. And when you get involved in businesses, when you join the boards of companies, this is the collateral damage that comes for the members of the management team of the AMC, the collateral damage that comes when they get involved. We do a lot of operating value add to our companies. We get onto the boards of these companies. So there is this, even as non-executive directors, sometimes these things happen. But all the disclosures have been made, as you rightly said, in the whole run-up to the IPO.
Right. We take that. Thank you for answering that as well. And since we're speaking about the business, also let's talk about management fee. Again, you said that as a proportion of your overall income, it's coming down as carry is increasing, management fee is coming down on a growing denominator. But even on an absolute basis, right, it went from 76 crores in FY24 to 60 crores in FY25, FY26, 57 crores in FY25. On an absolute basis, it has fallen, and it's charged on committed capital, right? I'm looking at Fund 4 commitments. They've been flat at 1775 crores. So has fee-based income stopped growing and won't move until Fund 5 closes?
Let me explain, and we've explained this earlier, but I'm happy to explain again. You see, in private equity firms and private equity funds, whenever there's a final closing, there is a catch-up on fee. So you get a lump sum fee payment in that year. So our Fund 4 had its final close in financial year 24. So there was a lump sum catch-up on the management fee, which explains the bump up. Everything else I said stands true. The management fee is stable because it's on committed capital, it's not on NAV. The percentage of management fee is declining not because of a problem, but because of it's a happy problem because it's the growth of carried interest, the growth of sponsor gain. So the denominator is growing. So once you take into account this one-time lump sum that comes when the final close happens, you will see that it's fairly, and that's how people normally model our business. They take into account these one-time bump ups.
So for those who are looking at your numbers as is, and the ones who don't understand the financial sophistications of an alternative asset management company, what are the 3 metrics that we should be looking at over the next 2 to 3 quarters after you list for one to understand the nature of this business and predict the revenue, earnings per share, as well as their overall capital allocation to this company as a result of their portfolio basis, what you report?
Well, thanks for asking that question because, what we've managed to clarify through this entire process is what's going public is the fund manager. So many of your questions were at the fund level. For the fund manager, we have created a very simple business. And finally, it's about net profits and earnings per share. So I would focus investors on the net profit trend line. We've grown from approximately 45 crores in FY24 to 62 crores in FY25 and 82 crores in FY26. Similarly, if you look at it as a financial business, it has a net worth. The net worth has grown from 330 crores to 600 crores. So both the growth rates are above 30%. Past performance is not a guarantor of the future. And finally is the trajectory and the addressable market. How long can this growth happen? So we have received 1.7 million applications in the IPO. In addition to having a very strong institutional response, because I feel this message has finally reached investors that investing in Gaja AMC is not about investing in a fund, but it's about investing in a fund manager that derives income from multiple funds, derives multiple income streams, and finally, it's a profitable dividend-paying business with 20 years of track record. There's a trend line, and the question to ask is, will this trend line be maintained? Will it go down? Will it accelerate? So it becomes a very simple question. In Buffett speak, it's something that you can sum up at the back of an envelope.
Attrition rate was what? Around 13%?
So the three co-founders have been together for the past over 22 years. The average tenure in the partnership is 17 years. At the junior levels of the team, we do see attrition because there's so much competition for talent. But our attrition is,
so you don't see
perhaps,
a key man
I don't want to
risk,
say
right?
the lowest, but arguably one of the lowest in the industry.
So you don't see a key man risk over there?
We have addressed, there is always a key person risk, but we have addressed that key person risk by growing the partnership, by growing the number of key persons. The future, only God knows about the future. Everyone should be keenly aware of their mortality and their frailties. So the way you address this is by widening the partnership. We have 3 managing partners, 3 co-founders. We are 6 partners. It's a meritocracy. There are no relatives in the business. And there is ample evidence that you can join the team as an associate and rise to become a managing partner, rise to become a partner. In that sense, it's unique. You can rise to become an owner of a business. This is what has attracted best of breed talent to Gaja Capital. We are a magnet for talent. And by expanding the talent pool is how we have mitigated the key person risk.
Right, take that point. We threw a lot of questions at you. You fielded them all. Wish you good luck. We'll await quarterly earnings and our conversations around those times as well. And as you pointed out, the EPS is something, the trajectory of which we will be tracking very closely. Thanks a lot, Gopal, for joining in.
Thank you so much. Look forward to engaging more.
Good luck. With that, we'll take a short break. Come back, get you more on the markets. A lot of stock-specific action. Stay with us.
Welcome back. Keep an eye on a couple of those stocks that went through the large trades early this morning. Welspun Corp, the promoter entity, coming in there and taking off close on 2.5% stake, 2.4% odd. Mr. Mathur as well did pull off some stake, and that's why the stock did correct. But it appears that at lower levels there is some buying because the stock has recovered close on 2% from the day's low. Remember, it's already more than doubled in this year. So we'll have to see whether or not this dents investor sentiment, or the investors say, well, they are the ones that created the wealth from 1,500 crores of market cap to 15,000 crores. So probably they can take some money off the table. We'll have to keep an eye out on that. Well, let's shift focus for the time being to our special segment, where we get you a few ideas for profit from Money Control Pro. Anand of moneycontrol.com joins us to talk about a stock that is tracking closely. Anand?
Yeah, thanks for having me. So we like SP Apparels Limited, which is one of the leading garment exporter with a diversified presence across children's wear, intimate wear, and retail segment, supported by manufacturing operations across India and Sri Lanka. The Q1 numbers doesn't look exciting, where revenues remain flat, but the margins improved sharply despite lower utilization. After a challenging FY26 marked by tariff uncertainty, delayed orders, and shipment disruptions, the business now appears to be entering a stronger phase. Young brand apparels continues to do well. Early benefit of India-UK FTA are visible, with 3 new UK customers added during the quarter, while SP UK revenue jumped by 125% in Q1. Retail business continues to remain EBITDA positive. Consolidated order book also remains strong at 600 crores, with orders are fully booked till October. Sri Lanka contributed around 25 crore in Q1, with the management expecting the business to generate around 150 to 200 crore for FY27. The management maintained its revenue guidance of 2,000 crore in FY27. Q2 is expected to be better than Q1, and we believe that the revenue shortfall in the first half can be recovered during H2. Stock trades at 15 times on FY28 earnings, which appears reasonable to us.
Right, with that, we are out of time on this edition of Chartbusters. From Nigel and me, the Nifty is still holding around the flat line. We have the Sensex marginally in the green. We wrap up this edition. On the other side, the team of Trading Art takes the market action forward. Thank you for watching. Hello and welcome. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Ritu Singh. We kickstart a new series, the September series. And it is, as always, a tug of war once again. On the way up is the Nifty Bank, up around 0.2%. On the way down is the IT index, down about 0.2%. And as a result of which, the Nifty absolutely flat. The mid-caps doing a shade better than the frontline indices, with the market breadth firmly in favor of advances. The series is known to be consolidatory. The market's been consolidatory. Let's see which way September moves this year. Hi, Ritu. Good morning.
Hi, good morning, Mangalam. Yes, looking like a good setup for the market, building on the gains that we saw in late trade yesterday. As of now, but you do have the frontline index slip briefly into the red as we speak, about 20 points lower. But the Bank Nifty, like you said, that is doing better, gaining about 0.6%. The mid-cap index also looking good. The small-cap index, though, about flattish and a bit in the red. The IT pack that is seeing some pressure today, down about 0.6% as we speak. But overall, the market breadth is positively positive. You have more than 2 stocks advancing for every 1 stock that is declining. Apart from this, PSU banks are doing well in trade. The media and the pharma pack is also holding up. Realty, auto, energy, all of that is in the green. The IT pack, of course, is a pocket of red, and the FMCG names as well seeing some pressure. But as always, let's get you the individual movers and shakers that are buzzing in trade, and Mangalam gets us that list.
Well, if you look at some of the individual buzzers right now, the top gainers are the private banks. That explains why the Nifty Bank is higher. So you have Kotak, which is about 2.5% higher among the top gainers on the Nifty. ICICI Bank over 1% as well. Just under 1% is Axis Bank. But beneath the surface, a lot of gainers in the F&O space. We have Cyient, which is higher. Management commentary fairly strong. Hinge Zinc up by about 5% as well. Dalmia Bharat is up close to 3%. We're also seeing some traction on IRB Infra and PB Fintech. And beneath the surface, in the small cap space, there are some ones which are buzzing with big volume. So Tarmat Limited up around 13%. A fair amount of volumes backing that counter. Quest Corp up 6.5%. IOL Chemical up 7% as well. And then you have Omax and Balu Forge for the longest time has been buzzing for the last few trading sessions. Then on the losing side, however, we have the ones that gained the last few trading sessions. Kohinoor Foods doing extremely well this month is coming for some profit taking. United Food, the erstwhile Barbecue Nation, also coming in for some profit taking. Jana SFB has been moving around ever since reports of Federal Bank's stake purchase, now down about 5% today. Welspun Corp was lower because of the large trade, and now the stock has recovered from lows. And we have Billion Brains as well, which is basically Grow. These stocks on our radar in focus on account of the large trades that took place. So those are a bunch of stocks which are buzzing around. But among one of those stocks that we pointed out is Cyient, because the company's outlined its growth and margin priorities on its investor day. Rima joins in with more details. Rima.
Thanks so much for that. So what Cyient is trying to do is change the positioning of the company. So up until now, the company operated in the traditional engineering ER&D space. So basically, they're helping their clients design and develop particular products. Now what the company is saying that we want to move to a full life cycle engineering services model, which means they want to stay with the customer across the entire life of the product or asset, right from decision making to manufacturing the product to after manufacturing, the aftermarket maintenance, the upgrades, or even the end of life. So basically, the idea is to move away from effort-based or project-based, which is short-term cycles, to a more predictable annuity outcome-based revenue. So in simple terms, if you move towards annuity, you have longer relationships, stickier revenue, and higher value. And as a result of this dramatically expands the opportunity side. So the traditional ER&D company, they said the opportunity for the company was about the TAM. The total addressable market was about $80 to $100 billion. Now, if you play across the entire life cycle on a services side for the company, then we're talking about an addressable market of trillions of dollars, $2 to $3 trillion, 25, 30 times larger. The company has set out a 3-year roadmap. FY26 is going to be the year of stabilization, FY27 transformation, FY28 scaling up. The near-term target set by the company, what they've announced right now, is that immediately they want to get to, which is in this year, double-digit year-on-year top-line growth. But after that, FY28 to FY29, they want to get into a very steady, predictable, consistent quarter-on-quarter revenue growth and scale up margins to 15%. But over the longer term, They want to, have industry-leading revenue growth along with further expand the margins to 16%. The brokerage view is mixed. So JP Morgan came away constructive from the investor meet. They've got an overweight rating. Motilal Oswal is still cautious. They say we're excited with the new focus area, the addressable market for the life cycle engineering and the semiconductor business, but they will wait for evidence and execution before turning constructive. Antique also has a buy call. Their target price is 11.25. Back to you.
All right, Rima, thanks very much for getting us that update as far as Cyient is concerned. But let's shift focus to the commodities market, and Manisha Gupta joins in with that. Manisha, everything from the coffee we drink to the sugar we don't try to put in it is getting pricier.
Oh, well, absolutely. You're eating something for sure, but that is also getting pricier. So the month of August clearly has seen very strong gains across commodities. And I'll start with wheat, where you have seen the least price increase of 5%. But almost everything else is double-digit percentage higher for the month of August. And that clearly has taken the price hike much higher for 2026. We have been dealing with El Nino, lower than normal monsoon. And the global markets also are looking at higher freight rates, couple of waterways not functioning properly. And all of that can be seen in case of prices there. You have palm oil within the edible oil space, which has gained up by 6%. Rubber is up 9%. Actually, the agriculture, industrial commodities like rubber, cotton is up by 9% as well. They have gained quite strongly. Sugar has been surging in any case because we're looking at a global deficit this time around. So nearly 18.5% of gains for sugar coming in just in the month of August there. Cocoa is up 11%. You have rice, which is gained up by 5.5% as well. So clearly, no place to hide when you look at the agriculture space as well. And with the crude oil prices rising, and that just about multiplies and finds its way in case of cost addition for many of these commodities, that is again also working. So soybean is trading at a 4-week highs in the international markets, and the Indian prices also have been higher. We import 65% of our edible oil requirement. So whatever is happening in the international markets clearly can be seen here as well. The U.S. Sugar futures have seen a decline of 2% in the overnight market, but for the month of August, trading quite on the positive side there. There's a report from Greenleaf which says that India would be importing sugar until the end of October, but would perhaps be 500,000 versus the 1 million ton which has been allowed. Rubber should be on your screens because 2013 highs is what we are trading on for this one. Thailand, which is the biggest producer of rubber, has been hit by rains and typhoons. It also is disruption when you look at various latex prices that has seen higher numbers as well. Also, this is the end of Southwest Asia tapping season. So the seasonal supplies will stop coming into the market. You'll have to do with what's available. That is also keeping the prices in premium. And finally, you have coffee prices now trading at a 6-week highs. There are tight inventories, lower production, and the ICE certified Arabica stocks now stand at a 25-year lows. That in turn will keep the prices much on the higher side.
Right, Manisha, thanks a lot for that. We'll take note of that. In fact, since you spoke about commodities, we'll take a short break, come back on the other side. The impact of higher raw material prices, demand and the rural outlook along with food safety standards, all these factors will be spoken to with the management of Parley on the other side of the short break. Take a short break, come back. We have Mayank joining in.
back. You're watching Trading Hour. Now, the Food Safety and Standards Authority of India, or FSSAI, has said several major food businesses operators have taken corrective action following notices that were issued over misleading labels, claims, and other regulatory violations. Rachna Dhanrajani joins us now to give us more details on some of these developments that have taken place. Rachna.
Well, if you've picked up a Bonvita pack or a can of Sting or a Lotte Choco Pie recently, you may have noticed something different. The claims on the packets have now changed. Mondelez has withdrawn the health and nutrition claims on Bonvita and pulled the advertisement that carried them. PepsiCo's new Sting cans no longer say energy on the packet. Lotte has been pulled up for calling its Choco Pie 100% vegetarian, which will also change now. Amway has taken 100% off its coconut oil. Heritage Foods has dropped the word fresh from its paneer packets. And The Whole Truth now says sweetened with dates instead of no added sugar. Then there's Dabur that has 7 products barred from sale, including honey, ghee, apple cider vinegar and coconut oil, and is taking legal advice even as it strips the claims off its website. Now, here's why FSSAI has issued more than 150 notices to food and beverage companies in recent months. And the names on that list include Nestle India, Coca-Cola India, Abbott, Danone, Ferrero and Kenvue. The regulator's position is quite simple here. A food label is not an advertising copy. It's for consumer information. So if a claim can't be proved scientifically, it cannot be printed on the packet. That same logic has now also extended to alcohol, with Diageo and Pernod Ricard among those getting notices over flavoring and age declarations. But not everyone is falling in line quietly. United Spirits has moved the Bombay High Court. Red Bull and Monster, the energy drinks, have made no visible pack changes yet, with the 90-day energy drink deadline running down. A notice, of course, is not a conviction. It is a chance to explain or correct. But the precedent was set last year with ORS drinks, where the courts backed the regulator and refused companies even a sell-through of their old stock. Now, for the industry, that's the real signal, because marketing language that survived for decades is now a compliance risk, and a rewritten label cost is far lesser than a product being pulled off the shelf. So we're seeing many changes, and a complete overhaul is expected in the recent times.
Take that point, Rachna. Thanks a lot for that. So FSSAI's push, no more sugar coating. To discuss demand, to discuss this, and to discuss, business at large, we do have Mayank Shah, who's the Vice President of Parley Products, who joins in as well. Before we speak about the demand and, how rural demand is picking up, or rural volumes are picking up, Mayank, do you have a word on this? Because the FSSAI's crackdown has increased on packaged products. What we want to understand is whether it's going beyond now the letter of law and is going into the spirit of law, and what is it that players like you are planning to do for for maintaining your cadence in the market right now, for maintaining trust in the market right now going forward because of these crackdowns that are coming in from the food regulator?
Mangalam, from a consumer's point of view, I think, consumers have all the right to know what is there in the pack. When you are offering him, your product, it is important to be transparent and tell your consumers what is there in the product. So, in principle, I think, the stance that's been taken by FSSAI is very consumer-centric and, really great as far as consumers being aware about what's going into pack, how the product is being made, or what all ingredients are going in are concerned. Also, what we see simultaneously is that consumers are getting more aware about ingredients which are going into the product. They have preferences like, avoiding certain ingredients, and they would ideally like to know whether, it's there in the pack or not. So, in principle, if we talk about, I think it's a welcome move. Claims should be authentic, and it should be informative. They should be transparent. There should be transparency between the seller and the buyer, or the marketer and the consumer on the product that's being offered to them. So in principle, I think it's a welcome move, and ideally, claims should be true. Whatever claims which are being made on the pack, they cannot be misleading. So I think this is in long run. There might be, some concerns right now coming in from certain sides, but in long run, this is definitely going to help, given the trend that we are seeing in the market, where consumers are getting more and more aware about the kind of products they are consuming, ingredients which are going into them, reading labels, understanding what's getting into it. and making choices based on that. As far as that entire phenomenon is concerned, I think it's a welcome move.
So welcome move indeed. But if you look at some of the products that you sell, including your hero product as well, when we look at the ingredients on the back of the pack, obviously you mention everything which is there. But at the same time, is it advisable for one to consume it in the quantities that one does? Because at the end of the day, a biscuit is 90% sugar, maida, as well as palm oil. So how do you justify that? And are there any variants that you're coming up with which explicitly take the use of all these products out?
Yeah. So, Mangalam, two things here. One is, if you look at the trend that we are seeing in the market and the consumption, consumers are moving towards healthier options where they are looking at, consumption of lesser sugar, reduction in, consumption of sugar, edible oil. They are moving towards, atta compared to maida. And you will see that getting replicated in the offerings which are coming in the market. So if you look at Parle-G, I think, we have Parle-G oats and berries also, which is, having oats, added to it. Over a period of time at Parle, we have reduced, sugar and edible oil that's going into fat and sugar, both going into our products. That happens over a period of time, and quantities, a significant quantity reduction has happened there as well. So that is happening. Consumers are becoming more aware and they are choosing those things. In fact, in new offerings which are coming, we have millet-based offerings, which we have launched. And there are offerings which are even lower on sugar, which have been, launched by us. So, and we declare that, wherever that case is. But as we shared earlier, the preferences of consumers are something that one needs to respect. That's one. Secondly, excesses in anything are not right. So when we talk about consumption of, snacking items also, the idea is to consume it in a certain, limit and rather not exceed that limit, or excessive consumption is not good. And that can be, the case, not just with, food, but with anything, not just with snacks, but any other food item as well. So ideally there are, consumption matrix as well, or recommended quantity which needs to be consumed at a given time also. So I think if consumers stick to it, then there should not be a problem. In fact, if you look at Indian market, I think by default, it's not by design, but by default it has been designed in a way where consumption gets limited, because most of your market is at smaller packs, lower unit packs. So your 5 rupees and 10 rupees are quantities which are around 40, 50 grams to 100 grams and around that. So by virtue of having smaller packs, you are limiting consumption. And normally it's seen that when you talk about biscuits and other things, they are typically consumed not alone, but they are being shared. So it further goes down. So you normally always are consuming less than what the recommended quantity is or an ideal quantity is. You are not breaching that. That by default is something that's also helping Indian consumers.
Yeah, that's very much playing out in shrinkflation as well. We're getting smaller packets for the same amount of money. But Mayank, that aside, how much ambiguity still exists in, among players about these tighter rules? I mean, are you going to still get 10 different interpretations when you ask 10 different companies? And when you talk about, generally the consumers moving towards healthier products, will the tightening, to your mind, also result in the reformulation of the product, what's inside the packet, or just a clearer wording of, describing the ingredients?
I think it's more about clear wording rather than, change in formulation. You need to be honest enough. And as far as Parle is concerned, as I shared, we have been in last almost about 7 to 10 years, we have been reducing the sugar, high fat content in most of our top products. And ideally, as I shared earlier as well, that one needs to be transparent. You need to declare upfront what you are giving in the product rather than being ambiguous about it or not being transparent about it. It's more about wording rather than that of reformulation is what I feel.
Just to be clear, does any of Parle's packaging or communication need revisiting on account of these tighter regulations? And if so, what would the cost of such an exercise be like?
No, we continuously keep evaluating because, we continuously keep improving our products and we try to make it healthier. So as I shared, over a period of last 8 to 10 years, there has been a significant reduction in HFSS because of HSFS guideline, high fat, sugar and sodium, they have been reduced. So the quantum of sodium, sugar and fat has been reduced in our, most products. And hence we keep revisiting, whatever we are declaring on our packs, and we try and, keep it compliant with what's going in the pack. And hence you will see, we've continuously evolved on our communication on the pack on what's getting into it.
We take that point, Mayank. Just before we ask you about demand and the business, how it's coming along, just a follow up on your, commentary around marketing of these products and around some of the new products that you've launched. Say something like the oats and berries biscuit. If you look at the back of the pack out there, oats are just 5% and berries are just 1% of the overall product that you're giving, right? It's still 65% maida, sugar, and refined palm oil make up for another 20% on that. Even the millet biscuit is 40% maida and 19% whole wheat. So obviously, there is a lot more clarification that people seek. And even for Parle G, the advertisement that there is, which makes one believe that, if children have it, it makes them geniuses. G say genius, but actually the G stands for glucose. So what we want to understand is how you are rolling back on all these things, and then a comment on how demand has played out in the second quarter so far.
No, I think, Mangalam, when you talk about certain things, it needs to be looked into the context. We're probably putting it out of context. When you talk about G-Money Genius, you look at the communication. It's all about, qualities of geniusness that we are talking about, and we are not talking about having biscuit and having it. Okay, so if you look at, I think you need to look at it in totality when we talk about our communication. We talk about genius wahi jo paaye dusron ki khushi mein apni khushi. In the joy of others lies our own. Now, this is based on research that we did during COVID times that, because kids were not allowed to go out, they were not allowed to socialize. We've seen in younger generation, kids, they're becoming very self-centered. Probably the tolerance levels are going down. They're more privileged. So the socializing, what used to be there in earlier days, is something that's missing. And that, as a result of that, what we had seen is qualities like, caring, caring for others, empathy levels, they were dropping and they were becoming more self-centric. Based on that research, if you look at our current communication, it talks about, in joy of others lies our own. And a genius is a guy who really, has empathy for others, or who does, or who has empathy or attributes like, kindness, qualities like kindness, who cares about others. And that's, about, the geniusness of a kid that we are talking about. We're not talking about you consume a product and you become a genius. We're talking about we are celebrating a genius who's like that. So I think we need to differentiate, between what's being said and,
what's being interpreted. We take that point. We take that point entirely. And to your credit, you've also reduced the quantities of sugar, fat, and sodium over the last few years. We take that point, and you've been fairly responsible in your communication as well. Take that point. Thank you so much for commenting on what has been a bit of a contentious issue for the industry at large. And you, as one of the leaders out there, need to stand up and speak about this as well. Thank you, Mayank, for joining in at a short notice. With that, we take a short break, come back, focus on the markets. Once again, we get chatting with a technical expert as well. Somil Mehta joins in with his trading strategies.
Welcome back. Let's get in Somil Mehta from Mirae Asset Share Khan for his, top stock picks and view on the market. Somil, thanks very much for being here. It's been pretty volatile. We've been seeing lower lows, lower highs. Where do you see, the frontline index move from here, the Bank Nifty, and your key stock calls for the day?
Good morning to everyone. See, my bias still remains positive. We've been making a higher lows since last 4 to 5 months, since April, and we've been making lows around crucial levels like 2300, 23,000, 23,100, then 23,600, and now we've taken support around 24,000, which makes higher lows every time we slip down. Now we've also been holding on to a upward sloping trend line, which is very good sign, and we've been consolidating around this range around 24,000 and 24,500. So that's a range. I'll be expecting this small range to break on the upside. The resistance is around the 200 daily exponential moving average, which is 24,400. However, there are a lot of opportunities going on in the market right now. Like metals are doing good, defense are doing good, banks have started doing really well from here. Banks have broken out of a flag pattern today with ICICI doing good, and the other PSU banks are also doing good. So Bank Nifty, I'm more positive than Nifty. Nifty probably would, consolidate more from here. However, Bank Nifty has given a clear breakout for a target of at least 58,500, 58,600. In the bank side, ICICI definitely a top pick. However, I've chosen two other stocks from the financials, from the metals. As I said, metals are definitely looking good and financials are looking good as well. The first stock I have chosen is Vedanta. Vedanta has broken out of a small consolidation, correcting, a small correction has already done, taking support at short-term averages 20 and 40 daily moving average. My stop loss for Vedanta is around 270 and my target on the upside is 310. The other stock which I have chosen is HDFC Life. HDFC Life is a reversal trade. A small ending diagonal pattern has broken on the upside, trading about 20-40 daily moving average. Great risk-reward ratio from here. Stop loss would be 545 and my target would be 600.
Right, Somil, thanks a lot for joining in and giving us your picks, more positive on the Nifty Bank, likes Vedanta as well as HDFC Life. Take a short break, come back, get you more on the markets. We'll also get chatting with a market guest for the fundamentals of the market. Welcome back. You're watching us here on Trading Hour. Let's talk about DCB Bank. We understand from sources that it's in talks with private equity firms for a potential capital infusion. Stocks moved to the high point of trade. Yash joins in with that story. Yash.
Well, what we've been given to understand is that DCB Bank is in talks with a few private equity firms, and this is for the purpose of capital infusion into the bank. Additionally, as information that we've been given to understand from our sources, is that Crude Capital is one of those many private equity firms which DCB Bank is in currently talks with. As far as raising that funds are concerned, Crude Capital is leading those conversations, and possibly, the way of raising these funds that is being looked at currently is to make a preferential issue in favor of Crude Capital, which is leading those conversations at this point of time. DCB Bank has already received an in-principle approval from its board for a 2,000 crore rupees fundraising, out of which the bank said that 1,500 crore would be via equity issuance and the balance would be via debt issuance. We've written to both DCB Bank as well as Crude Capital on this particular query. A response from both of them still remains awaited, but just a couple of details. DCB Bank is likely to raise funds and requires the fundraising for growth capital. The bank's stated objective is to double its balance sheet every 3 to 4 years. So that's where the capital is likely to be used, which the bank raises. Also, as far as the capital adequacy ratio is concerned, the bank's CAR stands at 17.03%. These numbers are as of June 2026. They were up from 16.66% on a year-on-year basis. That number remains comfortably above the regulatory requirement as of now. But of course, growth capital is what DCB Bank is looking at. Crude Capital ahead, leading that conversation as far as those few private equity players for this fund infusion is concerned.
Yash, thanks very much for bringing us that story. Important developments there for mid-tier, private sector lender DCB Bank, a deal in the works. Keep in mind, any private equity player coming in will require an explicit RBI nod, and they cannot exceed, 9.99% stake. And, the management had publicly indicated that they're open to a strategic investor, but this clearly is a financial investor, as Yash reports. Crude Capital, one of the leading players that remain in talks with DCB Bank. So we'll keep our eye out on that one. But for now, we slip into a short break. Up next, we're going to talk market fundamentals with Seshadri Sen. Stay tuned. Welcome back. You're watching Trading Hour, and as promised, we have with us Seshadri Sen, the head of research and strategist at MK Global, joining in now to discuss market fundamentals. Seshadri, thanks very much for being here. Let me just start with the financial space, because the last time you were with us, you said, this year looks a bit tough for the PSU pack. You saw limited room for upside. But what about the private banking names? And I'm asking because of this whole bunch of deals in the news, whether that is Federal Bank with Jana Small Finance Bank and now DCB potentially looking at a large fundraise. Do you see more activity here, some sort of a opportunity for upside in some of these mid-tier, private sector names?
Yes, absolutely. So we've been saying consistently for some time that small and mid-cap private sector banks is where the action will be. And that is our one of the preferred segments within the financial space. We think that segment offers what we call growth beta, that in a credit upsurge, they will outperform the system credit by a significant margin just because of low bases and a little more risk-taking capabilities. So we maintain that these deals, if they do happen, are reinforce that argument, because then not only do they get growth capital, but it also addresses capital anxiety for the future, so they can grow with more confidence, knowing that there's an anchor investor, and if they need to come back to the markets, then they will be able to do that with with an anchor investor already established. So. You're absolutely right. The small and mid-cap banking space does look interesting from here on, and that is one of our more preferred sectors, and we prefer that pack to the large-cap banks.
Right. We take that point. And the other thing that really stands out this time around is the earnings have been fairly resilient, Seshadri, if you look at the first quarter earnings season. But the market moves haven't been so. We haven't seen a big reward coming to some outperformance. Instead, there was a dent coming into any sort of rare misses that happened in the market. So what do you make of that? And in light of that, the next couple of quarters, what do you think stands to benefit more from an earnings-led recovery?
There are two reasons, I think, why the market hasn't responded as strongly as it should have to the strong first quarter earnings season. First is global factors. You've seen two significant headwinds. Oil prices have been elevated. That's the first. They're now starting to correct. If we get crude back below $80, and it's difficult to predict, but if it does come back and there is some peace in the Middle East, then I think that would be a good catalyst for Indian stocks. The other is, of course, long bond deals in the US pushing up over 5. That obviously raises the asking rate for the expected return for Indian stocks, and with valuation slightly stretched, that becomes a second challenge in terms of the market. So those are the two external factors. We also would point out that if you look at the dispersion of valuations, the number of companies that are trading above long-term averages, that percentage is quite high. Even though the headline Nifty valuation may look a little attractive, the dispersion of valuation is not that attractive, which is why the market is in stock picking mode. They're chasing stocks which are which are definitely showing strong growth momentum, and a little cooler to where the valuations are high, but growth is not keeping pace.
Right, take that point. Just a final question before we let you go. Global sentiment is still fairly volatile, though oil prices are off highs right now. Do you have a call on oil marketing companies and energy stocks?
Yeah, if oil prices do come, you may see a short-term rally in the oil marketing companies. Their long-term price-to-book valuation is not that is not that stretched, so you could see a short-term rally. Whether they provide you the long-term compounding story in terms of stock price is a different question, and the answer there is largely no. These are not long-term holdings. You want to hold them for these short-term opportunities, and then try to exit them. The other is that product spreads are also very high. So some of the larger players may benefit from that. Because there is a little bit of tightness in global refining capacity. But these are short-term factors. Long-term, as I said, you wouldn't want to hold these energy companies. You just play the trends of if oil does fall below $80.
Right. Take that point. A lot more questions, but out of time. Thank you so much for joining in and giving us your view on the markets and a whole host of themes that we should be tracking over the next few quarters. We'll obviously get back for a longer conversation later as well. Take a short break, come back, get you an insight on India's credit spending. Stay tuned for that one. Welcome back. Let's talk about the macro story now. Credit card spending remains resilient, with Indians spending over 2 lakh crore rupees for the third straight month in July. Where the spends are and how they're overall holding up right now, we do have Ritu with the macro signal. Ritu.
Well, yes, Mangalam, credit card spending is holding up pretty well, and that's an important indicator for consumption and for the economy. So in July, for instance, Indians spent about 2.08 lakh crore rupees through credit cards, which is up by about 3.4% from the previous month and about 7.5% from a year ago. But more importantly, this is now the third straight month that we're seeing the total spends cross that 2 lakh crore rupee mark. So the average monthly spend that we've seen in the first 7 months of 2026 has averaged about 2 lakh crores versus about 1.9 lakh crores that we saw in all of 2025. So the headline looks good, but the spending is actually growing much slower than the number would indicate in terms of transactions. So overall, credit card transactions have jumped by almost 25% year on year to about 60.5 crores for the month of July, but the spending has risen by only 7.4%. Now that means we're using our cards a lot more frequently, but we're using it for much smaller amounts. So the average transaction value has actually fallen to roughly about 3,440 crores in July, 3,440 rupees, pardon me, in July, from about 3,987 a year ago, which is a 14% decline in a year. The card base, though, that is expanding at a healthy pace. So we ended July with about 122 million credit cards outstanding, which is up from about 121.6 million in June. That's roughly 11 million more cards that we've added in a year, about 10% growth in percentage terms. July alone saw about 1.26 million cards getting added, which is a good 11.5% higher than the addition that we saw in the previous month. Now, there's also an interesting shift in the competitive landscape. So public sector banks are gaining share in credit card spending. Their spending has actually increased 22% year on year, taking their total share of the industry spend to more than 22%. Private sector banks, of course, they remain dominant, but the spending growth is just 2.8%, and that's brought their share down to about 72%. But the market stays very much top-heavy, as has been the case. HDFC, SBI Card, ICICI Bank, Axis Bank. Now, between these four, they hold nearly 70% of all the outstanding cards and 76% of all the spending that is happening. But individually, there's some interesting trends. Of course, HDFC remains firmly in the front. It accounts for almost 29% of all the spending alone. But SBI Card has been growing fast. Roughly 19% of the spend. ICICI Bank around 16%. Axis another 11.5%. But again, the growth numbers, SBI Card spending has jumped almost 21.6% year on year compared to just 11.9% for the market leader HDFC and just 4.6% for Axis, whereas ICICI Bank actually saw its spends decline. So overall, the credit card spend is still strong. It's crossed 2 lakh crores now for 3 months. The card base is at a record high, but the growth pattern is shifting where you're seeing transactions rising a lot faster than spends, which means growth for the industry will come not just from adding more cards, but also from more frequent and smaller value transactions.
All right, Ritu, thanks a lot for that. So that's the macro signal for the day, and that's also the signal for us to wrap up on this edition of Trading Hour with the news that Halftime Report comes up after this short break. From Ritu, me, thank you so much for watching.
Stocks fall from highs to trade near the low point of the day. This after opening higher after crude oil saw a 5% drop overnight. Cement, financials and chemicals notch gains while IT and consumer durables drag.
Wednesday morning sees over 6,000 crore shares change hands via 5 block deals in Grow, PhysicsWallah, Rubicon Research, Viyash Scientific and Wellspin Corp. The flurry points to strong institutional appetite for equity.
Reliance sees CG Power's larger chip unit ramping to 70% in 4 years and the business contributing $500 to $600 million in sales. The power vertical, he says, is in an upcycle and lending arm Cholamandalam will continue to diversify its book.
And the food safety regulator FSSAI cracks down on F&B and e-commerce players for mislabeling. It has shot off almost 200 notices to top brands like Coca-Cola, Mondelez, Nestle, PepsiCo, some of whom have already made the label changes.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra, with me Sonal Bhutra and Vinny Motiwala. Well, it is turning out to be a day where we've not managed to hold on to gains despite the benefit that we've seen from Brent crude, which is hovering at around $85, $86 per barrel at this point in time. In fact, the Nifty is around 100 points off the day's high at this point. So the high for today's trading session was around 24,378.6. But as of now, we're just about marginally in the red, down around 0.2%. What's doing better is the entire banking space. The Bank Nifty is managing to hold up with a gain of around 0.6%. We also have an advanced decline ratio, which is on the positive side. So around 2,400 stocks advancing to around 1,500 or 1,600 stocks declining at this point in time. Let's see whether we manage to sustain that or not. As of now, it's a bit of a subdued day.
Hey girls, good afternoon. A new series. We're already in the September series with markets at the day's low as we speak. Something not sitting well with the markets for now. We do have big names, the likes of HCL Tech. You do have Tech Mahindra, Tata Consumer, Maruti Suzuki, Power Grid. All these stocks are at the day's low. Of course, Nifty IT is the biggest one putting pressure right now. That's the top sectoral loser as we speak. Advanced decline ratio, as Ekta mentioned, is in favor of advances for now. But do remember, Midcap Index also has come off sharply from the highs of the day. We'll keep tracking those moves for you, but it's a lot of stock-specific action today, Vinny. Block deals data, there are some updates in Scient as well. We'll discuss all that on the show.
Absolutely. We are going to be discussing all of that on the show and more on the broader end of the market as well, specifically a lot of individual names that are moving around there, especially the mid and small cap still managing to hold on to some bit of a gain. But on the show, what's lined up for y'all? We'll be putting the spotlight on a fresh wave of block deals, like Sonal mentioned, in the equity market with over 30,000 crore rupees of equity supply seen so far. Vivek will also decode who's selling and what's driving this surge. We'll focus on a whole host of buzzing stocks and big movers in trade today. Stay tuned in for that. And then we'll have the management of PTS Limited who will join us, a fashion sourcing major, to discuss their Q1 numbers, roll ahead from the company, what's happening in the industry as well. And we'll discuss how to navigate crude oil volatility with Iman Nasiri, who is joining us on the Commodity Corner segment to talk to us about the growing concerns over prolonged disruption in the Strait of Hormuz and what it means for overall the prices as well. We'll also track on the latest moves in cryptocurrencies as Bitcoin crosses $80,000 mark and what is fueling the rally. But first up, let's go across to Vivek to take us through the stocks that are moving around in the trading session this afternoon. Good afternoon, Vivek.
Good afternoon. Well, we've started off the September series. Saw last surge yesterday, but that's not held on to, especially as far as markets are concerned. In terms of individual stocks, what is it that we're tracking? First on the list is the NBFC pack, and within that, KP Global up almost 6%, very strong volumes as well on this particular name. Gujarat Pipavav Port, major overhang clears. The extension of the concession as far as its key terminal is concerned is something that has now been lifted, and the Gujarat Maritime Board has gone ahead and given a comfort letter on the same. Raja Capital, the recent listing, has started off on a very strong note, almost 10% higher. And Hindustan Zinc, over here too, it's outperforming the metal peers. Jefferies is quite positive on the name. Both silver as well as zinc prices are moving higher quite significantly. So Hindustan Zinc clearly outperforming today. And DCB Bank, our colleague, just told us that there could be a large capital infusion in the offing from one of the larger private equity players. That particular stock have another 5%. On the other hand, quite a few stocks under a bit of pressure, and mainly on the back of very large equity supply. VS Scientific, we told you about this particular story in June. Carlyle selling a little over 10% stake. That stock low by 6% today. Wellspun Corporation, again, a promoter entity going ahead and paring stake by 2%. Grow or Billion Brains, within the spate of 10 days, you've seen the second consecutive block deal in this particular name. And two names, especially as far as graphite electrode place is concerned, both of these names under a bit of pressure, HEG and graphite, the broader end of the market, seeing some profit booking emerge.
Okay, all right, Vivek. A lot of stocks which are buzzing around in today's trading session. But let's talk about one particular company. PDS Limited is the one that we're tracking. And if you look at it on a 6-month basis, the stock has done quite well. It's up around 20% just in the past 6 odd months. But to talk more about it, we have Sanjay Jain, the group CEO, who's joining in to discuss 3 focal points. One is the Busana apparel partnership. Second is the growth opportunities in the UK as well as European Union versus the US. And 3, the overall FY27 outlook. Sanjay, hi. Thank you very much for joining in and speaking with CNBC TV 18 this afternoon. Well, just wanted to start by asking you about this partnership with Busana Apparel Group. It is basically focused on high-value customers, we do understand. What is the revenue potential from this? When does it start sustainably showing on your P&L? And what are the margins that you are expecting from this partnership?
Yeah, hi, good afternoon. PDS manufacturing business with 2 units in Bangladesh and 1 in Tirupur does about close to 1,200 crore of top line. We, with the partnership with Busana, are trying to upgrade the customer profile to more fashion customers from largely value customers at present. So we believe with this step, the current close to 7-8% EBIT margin that we are earning, there is potential to improve it by another 3-4%. So this partnership is more about getting more value from the existing. Busana brings on board some of the leading fashion retailers with whom they have a strong relationship. We are going to allocate part of our capacity to the orders that they would help bring in, and thereby help improve significantly the profitability of our existing manufacturing business. That's the main motivation behind the partnership.
You must have done some calculations of what kind of contribution it will bring to your top line and profits. What is the initial assessment? How much can it bring in FY27? Since it's more a top line and profitability game, what kind of customers will you be looking at? Will it be margin accretive since you'll be shifting from value to more high-end products? Give us some numbers.
Yeah, I think this partnership just got signed. So it may take a couple of quarters for it to fully unfold. It also entails labor's skill development and a bit of automation to handle high fashion customers. So therefore, to answer your point, I think the next year should enable us see the full potential. That is number one. And from, as I said, from the current 1,200 crore top line, we are generating about 7% EBIT margin. If this partnership fully unfold, over a 2-year journey, that 7% present can gradually move to about 11% in terms of EBIT margin.
Okay, that's on the margin front, and full potential and full revenue maybe we'll start seeing coming in on the top line. The benefit of this from FY28 is what you're highlighting. Mr. Jain, just pushing a bit more on that. One, what would be that revenue next year that you are expecting to see, if you have calculated anything on that front? And then talking about your current numbers as well, order book has seen a very strong growth this time in Q1 FY27. How much of that is going to be executable in the next 12 months as well for the company, given that revenue growth was a bit lower than the order book growth? So what is the execution timeline for this order book?
So ordering in the, answering in the order that you asked, for the manufacturing, I answered on the margins. There is, if you bring in the requisite operating efficiencies and a good mix, we should be able to extract more 20-25% revenue from our given capacities. But this would unfold over 2 years time frame. So therefore, that's the revenue potential from the current levels with this partnership and the impact of operating efficiencies. On the second or third part, Yes, our order books are healthy at present, 20% plus. We had a good first quarter with about 15% odd growth. This order book that is in hand typically reflects the next 6 months visibility. So therefore, if we execute it fine, I think it should translate into revenue growth in the coming 2 or 3 quarters.
Okay, all right, fair enough. So the order book is looking strong. Just wanted to narrow in on the US because you had America, which grew quite strong. It was up around 48% on a year-on-year basis. We do understand that Family Dollar as well as Pentland added significantly in the quarter gone by. What are you projecting in terms of total revenue growth for the US, and how is it doing in terms of demand for you?
See, the last 2 years, we've been into investment phase. And one of the key investments has been building inroads and strength into the North American market, US market. And somewhere that is beginning to give results because we had 45% plus growth in quarter one. And I think US has been close to 15 to 17% of our overall top line. And we want to scale it to about 30% in 2 to 3 years time frame. That's the longer horizon. We believe we got good teams in place. We got the initial breakthroughs with the relationships that we wanted to build. It is all about scaling up now. And the first quarter is a big step in that direction. So therefore, from less than 20% of our total revenue to it moving to 30% in about 2 to 3 years, we believe that's the aim that we are working on in terms of sales to US. And secondly, the demand in US has been fair, but the value that we bring in to our customers allow us to grow much more faster. On one hand, we cater to the value requirement, and at the same time, we also have invested into building fashion capabilities. So therefore, with this multi-pronged approach of offering value as well as fashion, and on top of it, you also mentioned about the Family Dollar sourcing as a service. So there are 2, 3 offerings which are allowing us to grow much more faster than the overall US market growth.
Mr. Jain, two-part question now. This on the cost front, this particular partnership with Busana, does it come with any payment that you have to make to Busana? Because since it's a partnership, it should benefit them as well. So will there be some revenue sharing here? The 25% incremental revenue from existing capacity that you've spoken about, does something flow out of your own company as well? And now that net debt has come down sharply, what happens to interest costs, which is right now at 37 crore rupees? What are the incremental cost savings you will see there?
So on the Busana partnership, no, neither they pay us anything nor we pay them anything. I think one has to understand the fundamental construct of this partnership. Busana has good marquee fashion customers. They are looking for capacities, and I have, compliant capacities very well run. And we both partners believe that if we come together, and I, kind of represent to them that if you bring business to me, I will allocate a part of my capacity to your fashion customers. So therefore, why is Busana into it? They are getting an access to a capacity. Why am I into it? I'm getting access to fashion customers. Nobody has got kind of any cost commitments to each other. We have formed a kind of JV with PDS having a 51% stake, wherein whatever business comes in, the entire profit would sit inside that JV, and both partners will take their commensurate share. So it's a win-win for both sides.
And what about interest?
Sorry, you also had another question. Could you repeat that, the second one?
It was on the interest costs. Since debt has reduced, how much will interest costs come down by?
So we've been really focused a lot last year in this quarter to get our operating cash flows, up and running. We have seen some good results. So therefore, coming the next quarter, one should see slowly, gradually about 8 to 10% reduction in the interest cost. That's a target with which we are working. That's at least set on one side. One may feel on a steady state basis, there should be interest cost reduction. At the same time, there is going to be growth. If I cater to a strong growth momentum from US, then some of these marquee customers also require me to bring goods to their warehouse. That means my working capital cycle may a little bit go longer. As a result, we want to grow, a lot to US without allowing my working capital to grow up. So you may see a flattish trend in the interest cost, but there should be more top line growth and profitability growth.
Okay, point taken there, Mr. Jain. Thank you so much, for joining us this afternoon and explaining us the outlook of the company, business of the company going forward. What should we watch out for as well? Thanks so much for that. But on that note, we're going to slip into a very short break. And in our next segment, in our What's Trending segment, Vivek will focus on fresh wave of block deals in equity market with over 30,000 crore rupees of equity supply seen post Q1 FY27. Stay tuned in for that.
Welcome back. You're still tuned into Halftime Report. The markets have come off from the highs of the day, but there's a lot happening in the broader markets. And it's time for our What's Trending segment. The equity market is seeing a fresh wave of block deals with over 30,000 crore rupees of equity supply seen so far. Who's selling and what's driving the surge? Vivek is joining us with more details on this one. Vivek.
Well, thank you so much for that. Like you mentioned, it's a deluge as far as block deals or equity supply is concerned. And we are only focusing as far as the secondary market is concerned. And we are only focusing on block deals or bulk deals where existing sellers are actually pairing stake either in the block window or in the open market. So at this point of time, this analysis does not include any OFS or even an IPO, which also adds to the equity supply. So what's actually transpired that post Q1 FY27, there's been a whole host of equity supply that's come across, especially, and it's been focused mainly on new listings and select healthcare names, where there was quite a few corporate actions that had taken place in the quarters gone by, and there was some amount of consolidation as seen as the ownership is concerned. Who are the key sellers in most of these block deals? It's mainly been the private equity players, the early stage investors, as well as the promoters. Now, what are the key reasons why we are seeing so many block deals happen, especially just immediately post Q1 earnings season when the silent period gets done? Number one, early stage investors, are taking part exit. Number two, promoters, who have debt on the personal balance sheet and also they have pledged certain amount of shares. They are taking an exit as well to go ahead and reduce the stake or reduce the pledge. And also, in many cases, you're actually seeing the private equity fund cycle come to an end, implying that, the private equity would need to go ahead and pair stake further. So the total equity supply has actually gone ahead and exceeded 30,000 crore in just a few weeks since Q1 FY27. Now, a couple of things to note, it's not comprehensive given the fact that quite a few term sheets are something that CNBC TV 18 may not have access to. And along with that, like we mentioned at the start, does not include OFSs like the large one we saw yesterday in Hindustan Copper or even in LIC, which in itself was close to 30,000 crore. We've also kept away from the primary market activity, given that at this point of time, there's quite a few there too in the pipeline. So which are the stocks that have seen majority of the stake sales come about? Just talking about today, you've seen four. You've seen VS Scientific, Welspun Corp, Grow. You've seen Misho as well. Most of these anywhere between 1,000 to 3,000 crore. Most of the sellers here are actually early stage promoters, early stage investors, as well as private equities like Carlyle. You saw a very large block deal take place in K Fintech, where General Atlantic sold close to 1,400 crore. Aster DM, TPG sold close to 5,000 crore in that particular name. Another large block deal that we saw was in Paytm, where the eventual owner of the stake was Anne Fink, again closed a little over 4,900 crores. These are very large block deals that we're talking about, and in most of the cases, they got absorbed quite easily. A couple of names too, you saw Tenneco Clean Air, where the parent entity paid close to 2,000 crore, Misho to 1,200 crore, and what we understand from our investment banking sources that there are still quite a few large block deals in the offing. So it'll be interesting to see what is the kind of equity supply and how it gets absorbed as far as the market is concerned.
Okay, Vivek, thank you so much for that. But on that note, we're going to actually slip into a very short break. After the break, we'll have Dharmesh Shah of ICICI Securities, who will join us to take us through his trading strategies, individual stocks to watch out for as well. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty at 24,278. Just a few points uptick from where we started the show, but not managing to hold on that. We're seeing a bit of a decline again coming in there as well. Almost near the day's lowest point is what the Nifty continues to trade at. But let's keep it going and then bring on board Dharmesh Shah, Vice President at ICICI Securities, now to talk to us about his trading strategies. What are the levels that we should keep an eye out on in this new series as well? Dharmesh, afternoon. Thank you so much for joining us on the show. What are the levels that you're keeping an eye out on for the Nifty today, Bank Nifty as well? And for the series, maybe what should we watch out for in terms of levels?
Yeah, so good afternoon, Vinny. Absolutely, I think so the way the Nifty seems to be behaving in today's trading session, it looks like more of a consolidation in today's trading sessions. But 24,220 to 25 remains to be the very strong support for the Nifty from the intraday perspective. On the higher side, again, I think so 24,340, 360 will act as an immediate reason as far as Nifty is concerned. Coming to some positional perspective, I think so the way the Nifty seems to be defending 24,000, if you look from the medium term perspective, I think so joining the lows of April and May and June, I think so Nifty seems to be holding on to the upward rising channel trend line. It seems to be, I think so the 24,000 to 23,900 will act as a very strong support for the Nifty for the month of September. At the same time, if you look at the Nifty 50 constituent earnings from the banking perspective or from the oil and gas perspective, it looks like I think the Nifty is on the verge of a breakout about 24,600. Yes, maybe some bit of a consolidation in this range of 24,000 to 24,500 cannot be ruled out in the couple of days. But eventually, we expect for the month of September, Nifty should be looking for a target of 25,000. With a strong support placed at around 23,800. Also, if you look at the market breadth, I think so a good indicator to understand the sentiment of the market. It has also seen the improvement where if you look at the CNX 200, CNX 500, where percentage of stock trading about 200 day moving average has improved from 48% to 58%, indicating a more of a broad-based rally happening for the Nifty in the current juncture. So yes, we remain to be constructive positive for the Nifty, and a dip towards 24,000 to 23,800 should be looked as a buying opportunity for a target of 25,000 for Nifty.
Okay, all right. Dharmesh, wanted your thoughts in terms of how you would approach Infosys, which is one of the top IT losers today, and obviously it's lost significantly this year already. That one and any other stock picks that you have.
Yeah, so as far as Infosys is concerned, ICTA we remain to be more of a neutral at current levels. I think so, yes. Overall, IT seems to be more of a consolidation. We believe, I think so. Since the quarter two numbers are not out, I think so. We should see a more of a consolidation for Infy. But as far as levels are concerned, 1175, 1190, 1180, 1190 remains to be the very strong. So 1,080 to 1,090 remains to be the very strong support for the Infosys, which we expect to hold in this current corrective phase. And eventually, I think so. Infosys should see a more of a consolidation in this range of 1,080 to 1150, 1160 is likely the trading range for Infosys. As far as trading strategies are concerned, yes, banking as a sector remains to be positive, where we see the banking also seems to be holding on to the 200-day moving average. So going forward, for Bank Nifty, look for target around 58,600, 5900 as far as Bank Nifty is concerned. But the stocks which will remain to be positive will be the Kotak Bank. Again, Kotak Bank looks to be on the verge of a weekly consolidation breakout. 9 weeks of consolidation in this range of 413 to 372 is finally witnessing a breakout with strong sets of volumes. So Kotak Bank is something like which we like at the current market price. We look for a target of around 448, hitting a stop loss of around 385. So Kotak Bank inside the banking space looks positive. Apart from Kotak Bank, again, HL is something on the defense space we like, where again the stock has been witnessing a 2 years of corrective phase, falling trend line breakout, indicating the end of the corrective phase for HL. Also, the move which happened from 4,000 to 5,000, what we see currently is more of a retracement of this sharp rally. The 4750 to 4780 remains to be the strong support which we expect to hold. And HL should be looked for target around 5350 to 5400, giving a stop loss of 4750. So Kotak Bank and HL remains to be our target.
Take that point. Thank you so much for joining us. So those are some technical picks. With that, we'll do one thing. We'll slip into a short break now. When we come back on the other side, Manisha Gupta will join in with Iman Naseri. As crude prices have fallen, stay tuned for that conversation.
Welcome back, and joining us on the show now is Iman Nasseri. He's MD Middle East Research, FGE Nexantenka. Iman, hi, thank you so much for joining in. What is your sense, first of all, with the kind of easing in prices that we've seen in last 24 hours, yesterday and then today in Asia yet again?
Thank you for having me back, Manisha. The crude oil market has been mainly basically moving with the headlines, with Trump tweets, with the messaging around how the transit through Strait of Hormuz will be impacted through tighter blockade or easier kind of flow, helping, assisting the vessels. And now the recent reaction to price has been basically the message from the US president that the Strait of Hormuz has been, the mines have been removed, and basically further vessel transit is expected. It is a wishful thinking from the market, but it's very much possible that the US military would try their best to increase the traffic through the Strait of Hormuz, which we assess to be at around 6 million barrels per day versus 15 million barrels per day pre-war levels. If that happens in the weeks and days ahead, we should continue to see the downward pressure on crude price, because what has been absent from the market has been resolved through lower refinery utilization. That doesn't mean the oil market is off the pressure, only because what has happened is that the pressure has shifted from crude market to products, which we still are observing prices of $150 to $200 in certain products, including diesel, gas oil, in the markets such as US and Europe. Yes, the reaction is basically to what may come, which is increased traffic through the Strait of Hormuz.
Okay. If you look at the various Wall Street banks and brokerages, 2027 is a year everybody seems to be putting as in sense of surplus. If you look at the forecasts, those are in 70s, even 60s for some. How would you react to that?
Yes, absolutely. What our house view is that the 2027 balances are in surplus. We have, without OPEC acting and setting a new ceiling for the production, we may see the market in surplus with more than 3 million barrels per day. Of course, it very much depends on your assumption on how the supply through the Strait of Hormuz would evolve. We have it slowly recovering by nearly 50-60% of pre-war levels by the end of this year, and then continuous recovery is slow, not to pre-war level 100%, but we're probably around 70-80 by the year end. That supply assumption, together with the slow recovery during 2027 to bring us back to pre-war level in terms of demand by the end of next year, will translate into 3 million barrels per day of surplus. Assuming that OPEC at some point, perhaps during first half of next year, will take an action to balance the market, as that's what their role is defined, we may expect to see the balance to drop to probably 2 million barrels per day surplus or less, which guide us towards also $70 to $80 oil price forecast at the moment.
Iman, also, how would you look at the demand destruction that the markets are dealing with right now? That go away as well as we look at the prices come down? Would you see this demand coming back also?
Not fully. We think there has been some structural demand loss, permanent, mostly in transport sector, where faster transit to electrification, EVs in China, but also in other parts of the world, especially in Europe and Asia, has accelerated. So that has killed some barrels in the transport sector, but also in the petrochemical sector, we find evidence of a structural shift away from liquid fuels, liquid feedstock, LPG and naphtha, into more ethane, which is a gas-based US supplied feedstock. So we find about 700 to 800 KBD of demand lost permanently, but regardless, absent of that segment, we still find the demand destruction to continue, and as I said, brings us back to where we were before war by the end of next year.
Iman, a final question then. How would you look at the Asian demand? India, for example, and then China, which has been almost absent from the markets?
China is where most of demand destruction in Asia has been. Perhaps China single-handedly has solved half of the demand destruction, with others being in mostly Southeast Asia. We find Japan and Korea nearly back into where they were in terms of both supply to the refineries. Refinery runs in Japan and Korea are nearly back to where it was, but also demand. But in as you mentioned, in India and some of the Southeast Asian countries, together with China, we see most of the demand destruction, and that continues. In China, as I said, most of that permanent loss of demand is happening in China, where massive acceleration of electrification of fleet has been observed over the past 5-6 months, but also petrochemical feedstock yield shift towards more ethane has also been happening.
The point is well taken, Iman Aseri, as always. Thank you so much for joining in. Well, that's the view coming in for crude. Further decline not ruled out. Demand destruction, well, some of that is perhaps we would see in the next year as well. But next year also could be looking at surplus of around 3 million barrels per day. And that is what is keeping the prices in check. Well, that we go for a short break. When we come back, we will talk about cryptocurrencies and what really has been the mood there for the month of August. We'll bring you that after this break.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome to Crypto Corner, and let me tell you that the Bitcoin has been surging almost all of August, so much so that we've seen $80,000 as well come back. If you look at the last 1 week and last 1 month, it has been good gains continuing for many of those cryptos. Bitcoin gained 14% on week and 25% on month. Same goes for Ethereum as well, which is up 32% now for this month. XRP has gained 35% for the month. Solana has gained 15% on week and 30% on month. And those gains just about continue. It's been a very strong month of August. But where is this August rally coming in from? What are the key drivers? Well, to begin with, it is about the US Treasury bond intervention, which has lowered yields and revived global demand for risk-on assets. It also has been about record institutional inflow, where you have the US spot Bitcoin ETF haul in nearly $1.92 billion in just about 1 week. The Clarity Act push has been supportive, where the lawmakers are now preparing for a critical Senate vote by the mid of September. Also, take a look at what's happening in cryptocurrencies. Well, it has been about tokenization, where South Korean trading titan POSCO is now shifted trade receivables into Avalanche blockchain. You also have Bitwise, which is launching an automated portfolios converting tokenized stocks on Coinbase into AI and robotics baskets. And then there are various other big names as well, which are now accepting crypto as payments. Within this, you have Shopify, you have Microsoft, which is now accepting Bitcoin for digital purchases across Xbox and online ecosystem store networks. Steak and Shakes also and Chipotle is fast food brands which are also now giving you food in return for crypto. Newegg continues to feature native Bitcoin payment structure during checkout. And then you have companies like Gucci, Balenciaga, which are high-end fashion houses, also allowing you to pay in crypto for all those fashion accessories.
Okay. All right, Manisha. Thanks very much for bringing us such an interesting update. We need to take a short break, but on that note, we'll get you a lot more in terms of specific stocks on the other side. Stay tuned.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, still subdued for the market. So below 24,300 is currently where the Nifty is at. The Midcap index is absolutely flat. We have the Bank Nifty, which is managing to outperform. So it's holding up with a gain of around 0.7%. Just want to point out that within the Nifty space, there is one stock which has been sulking for the entire week, and that's Cipla, which has lost around close to 2% in terms of market cap this week and is down around 1% today. The news is their Indore facility, which is their Pathampur plant, has been inspected by the US FDA and issued a few observations. So the street is a bit worried about what the observations might look like. Remember that this particular plant already had a warning letter which was issued to it in 2023. So after that, there are at least over 5 observations which have been issued to the facility. So the street is worried about the way forward on that. But on that note, we need to wrap up. On Halftime Report, Business Lunch will take all of the action forward. Stay tuned.
Stocks fall from highs to trade near the low point of the day. This after opening higher after crude oil saw a 5% drop overnight. Cement, financials and chemicals notched gains while IT and consumer durables dragged. Wednesday morning sees over 6,000 crore rupees of shares change hands via 5 block deals in Grow, Physicswala, Rubicon Research, Viyash Scientific and Wellspun Corp. The flurry points to strong institutional appetite for equity. Reliance Subaya sees CG Power's larger chip unit ramping to 70% in 4 years and the biz contributing $500 to $600 million in sales. The power vertical, he says, is an upcycle and lending arm Cholamandalam will continue to diversify its books. Food safety regulator FSSAI cracks down on F&B and e-commerce players for mislabeling. It has shot off almost 200 notices to top brands like Coca-Cola, Mondelez, Nestle and PepsiCo, some of whom have already made label changes. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. Good afternoon, guys. The market started the new series on a positive note, but coming off those highs, and now the Nifty and the Sensex are in the red. The Nifty 0.2% lower, finding resistance at that 24,400 mark. It's currently below 24,200 at that 24,275 mark. The Midcap index managing to stay in the green, but absolutely flat. The Nifty Bank, that's the outperformer today, about 415 points higher. That's about 0.8% in the green as we speak, and that's what's contributing to the Nifty on the upside. But if you take a look at the sectoral performance, the fall that came into the Nifty was led by those IT names. Infosys, which is down 2%. We've got TCS, that's down 1%. And if we can bring that up for you on the screen, we've got Tech Mahindra as well, seeing cuts of nearly 2%. So those IT names being the main ones contributing to the fall on the Nifty. We've got those FMCG names also feeling the pressure. Varun Beverages down over 3%, Nestle down over 1.5%, and Tata Consumer Products down 1.3%. So those are the stocks that are the key drags on the Nifty. What's doing well today? We've got private banks and PSU banks, both of that contributing to the upside. So on the private bank side, we've got Kotak Mahindra Bank, which is seeing a big surge, 3.5% higher. ICICI Bank over 1% in the green, and Axis Bank also doing well, 1.3% in the green. We've got PSU banks, as I pointed out, also doing well. Bank of Maharashtra, 4.5% higher. Indian Bank and Bank of Baroda, both of them seeing gains of over 1%. And that's how the markets are shaping up this afternoon. But first up, the equity market is seeing a fresh wave of block deals with over 30,000 crore rupees of equity supply post Q1. Who's selling and what's driving the surge? Vivek joins us now with all of those details. Vivek?
Well, thank you so much for that. Like you mentioned, it's a deluge as far as block deals or equity supply is concerned. And we are only focusing as far as the secondary market is concerned. And we are only focusing on block deals or bulk deals where existing sellers are actually pairing stake either in the block window or in the open market. So at this point of time, this analysis does not include any OFS or even an IPO, which also adds to the equity supply. So what's actually transpired that post Q1 FY27, there's been a whole host of equity supply that's come across, especially, and it's been focused mainly on new listings and select healthcare names, where there was quite a few corporate actions that had taken place in the quarters gone by, and there was some amount of consolidation as seen as the ownership is concerned. Who are the key sellers in most of these block deals? It's mainly been the private equity players, the early stage investors, as well as the promoters. Now, what are the key reasons why we are seeing so many block deals happen, especially just immediately post Q1 earnings season when the silent period gets done? Number one, early stage investors, are taking part exit. Number two, promoters, who have debt on the personal balance sheet, and also they have pledged certain amount of shares. They are taking an exit as well to go ahead and reduce the stake or reduce the pledge. And also, in many cases, you're actually seeing the private equity fund cycle come to an end, implying that, the private equity would need to go ahead and pair stake further. So the total equity supply has actually gone ahead and exceeded 30,000 crore in just a few weeks since Q1 FY27. Now, a couple of things to note, it's not comprehensive given the fact that quite a few term sheets are something that CNBC TV 18 may not have access to. And along with that, like we mentioned at the start, does not include OFSs like the large one we saw yesterday in Hindustan Copper or even in LIC, which in itself was close to 30,000 crore. We've also kept away from the primary market activity, given that at this point of time, there's quite a few there too in the pipeline. So which are the stocks that have seen majority of the stake sales come about? Just talking about today, you've seen 4, you've seen VS Scientific, Welspun Corp, Grow, you've seen Misho as well. Most of these anywhere between 1,000 to 3,000 crore. Most of the sellers here are actually early stage promoters, early stage investors, as well as private equities like Carlyle. You saw a very large block deal take place in K Fintech, where General Atlantic sold close to 1,400 crore. Aster DM, TPG sold close to 5,000 crore in that particular name. Another large block deal that we saw was in Paytm, where the eventual owner of the stake was Anne Fink, again closed a little over 4,900 crores. These are very large block deals that we're talking about, and in most of the cases, they got absorbed quite easily. A couple of names too, you saw Tenneco Clean Air, where the parent entity paid close to 2,000 crore, Misho to 1,200 crore, and what we understand from our investment banking sources that there are still quite a few large block deals in the offing. So it'll be interesting to see what is the kind of equity supply and how it gets absorbed as far as the market is concerned.
Absolutely, Vivek. Many thanks for taking us through those details. Let's listen in to Vellayan Subbaiah, the executive chairman of Cholamandalam Investment, who says he will continue as executive chairman. He also sees improvement in Chola Investments as overall book performance picks up, while adding that it is too early to think about a merger or delisting of Shanti Gears. Take a look.
I think this has been the discussion that we've had several times, and this question has been asked several times, but definitely the answer is yes.
Okay.
It's something that it's a role that I'm 100% continuing and will continue to serve.
So it is something like this. Your group of the family will be the dominant shareholders in the manufacturing, CG Power, Tube Investments, etc. But in Cholamandalam, you will be the executive leader, even if there is somebody else with a dominant shareholding. Is it like that?
No, the general thinking at this stage is that basically we've aligned around 3 alignments that basically are managing different sides of the business, and that thinking continues.
Okay, so you will be in charge of Cholamandalam Investment. Okay.
Definitely, we see a situation where ROAs are beginning to go up. I think it's a confluence of a couple of things. One is that the performance of the book overall is also improving, and that combined with our overall mix is allowing ROAs to expand from where they've been for the last couple of years. I think it's too early to kind of think through that. It's basically, there was, we definitely see that in businesses we're interested in, we want to continue to have a significant shareholding and continue to improve that. So when there was an opportunity to do that, we did it. That's the way I look at it.
No, that's true. But 71 to 73 is perilously close to 75, where the minimum public shareholding kicks in. That's why, the stock went up so much, 18% in a day, because of all these chatter in the market. Will that also be on the horizon?
So there's no thinking of that right now. Okay. There's no thinking.
Okay. But even... okay. It remains a separately listed company.
Yes, definitely.
That exclusive conversation today at 5:30 p.m. only on CNBC TV 18. On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. The Food Safety and Standards Authority of India, FSSAI, said several major food business operators have taken corrective action following notices issued over misleading labels, claims and other regulatory violations. Rachna Dhanrajani joins us now to give us all of those details. Rachna?
Well, if you've picked up a Bonvita pack or a can of Sting or a Lotte Choco Pie recently, you may have noticed something different. The claims on the packets have now changed. Mondelez has withdrawn the health and nutrition claims on Bonvita and pulled the advertisement that carried them. PepsiCo's new Sting cans no longer say energy on the packet. Lotte has been pulled up for calling its Choco Pie 100% vegetarian, which will also change now. Amway has taken 100% off its coconut oil. Heritage Foods has dropped the word fresh from its paneer packets. And the Whole Truth now says sweetened with dates instead of no added sugar. Then there's Dabur that has 7 products barred from sale, including honey, ghee, apple cider vinegar and coconut oil, and is taking legal advice even as it strips the claims off its website. Now, here's why FSSAI has issued more than 150 notices to food and beverage companies in recent months. And the names on that list include Nestle India, Coca-Cola India, Abbott, Danone, Ferrero and Kenvue. The regulator's position is quite simple here. A food label is not an advertising copy. It's for consumer information. So if a claim can't be proved scientifically, it cannot be printed on the packet. That same logic has now also extended to alcohol, with Diageo and Pernod Ricard among those getting notices over flavoring and age declarations. But not everyone is falling in line quietly. United Spirits has moved the Bombay High Court. Red Bull and Monster, the energy drinks, have made no visible pack changes yet, with the 90-day energy drink deadline running down. A notice, of course, is not a conviction. It is a chance to explain or correct. But the precedent was set last year with ORS drinks, where the courts backed the regulator and refused companies even a sell-through of their old stock. Now, for the industry, that's the real signal, because marketing language that survived for decades is now a compliance risk, and a rewritten label cost is far lesser than a product being pulled off the shelf. So we're seeing many changes, and a complete overhaul is expected in the recent times.
So changes already being seen there. All right, Rachna, many thanks for those details. Earlier, we spoke to Mayank Shah, the Vice President at Parley Products, on the new FSSAI labeling stance. He welcomes the consumer-centric move, saying clearer pack labeling will help consumers make more informed choices. Listen in.
Consumers' point of view, I think, consumers have all the right to know what is there in the pack. When you are offering him, your product, it is important to be transparent and tell your consumers what is there in the product. So, in principle, I think, the stance that's been taken by FSSAI is very consumer-centric and, really great as far as consumers being aware about what's going into pack, how the product is being made, or what all ingredients are going in are concerned. Also, what we see simultaneously is that consumers are getting more aware about ingredients which are going into the product. If you look at the trend that we are seeing in the market and the consumption, consumers are moving towards healthier options where they are looking at, consumption of lesser sugar, reduction in, consumption of sugar, edible oil. They are moving towards, atta compared to maida. And you will see that getting replicated in the offerings which are coming in the market. I think it's more about clear wording rather than, change in formulation. You need to be honest enough. And as far as Parley is concerned, as I shared, we have been in last almost about 7 to 10 years, we have been reducing the sugar, high fat content in most of our top products. And ideally, as I shared earlier as well, that one needs to be transparent. You need to declare upfront what you are giving in the product rather than being ambiguous about it or not being transparent about it. It's more about wording rather than that of, reformulation is what I feel.
Global transportation and logistics giant Federal Express Corporation is planning to develop a new integrated air cargo hub at GMR Cargo City at New Delhi's Indira Gandhi International Airport with an investment of around $150 million. Speaking to CNBC TV 18, Kami Vishwanathan, president of FedEx Middle East, Indian subcontinent and Africa, said that the hub is reflective of their optimistic outlook towards India's growth. Take a look.
We are investing $150 million in the long term in this hub, which will be an integrated air hub in Delhi, in the GMR Cargo City. It is intended to service the north and east markets in India and connect them to international markets through our global network. This hub is essentially reflective of our optimistic outlook for India growth in terms of the export potential. So far we have invested about $400 million between our Navi Mumbai and our Delhi hub announcements. And we will continue to evaluate as we go forward, and as we see the demand developing, we will continue to look at where is more capacity required, where do we need to bring in more freighters, for example. India to the US and Europe, it could be Asia to India. So we will be observing and evaluating where we need additional investments in capacity. We expect this to be functional in about 18 months. Complete with all of the automation and so on. And there's a lot of regulatory support coming in from the government as well to enable certain changes that we need and so forth.
JSW MG Motor India has launched the Hector Tomahawk EV at a starting price of 19.49 lakh rupees, while the battery as a service option starts at 13.99 lakh rupees. The 3-row electric SUV gets a 69.2 kilowatt-hour battery with a claimed 517-kilometer range and is available in 5- and 7-seat configurations. The Tomahawk EV will rival the Mahindra XEV 9S and Kia Caren's Calvis EV. On that note, it's time for a short break, but more news and updates follow on the other side. Stay tuned. Welcome back. You're watching Business Lunch on CNBC TV 18. On to the latest updates from West Asia. Iranian Deputy Foreign Minister says the Strait of Hormuz remains closed despite a temporary transit agreement with Oman, insisting that Washington must return to its commitments under the Memorandum of Understanding before the waterway is fully opened. CNBC's Dan Murphy gets us all of the latest updates from West Asia. Dan?
President actually posted on Truth Social overnight saying all mines have been removed or detonated from international waters inside the Strait of Hormuz. The president in this post saying Iran has been notified that any vessel laying new mines will be, quote, immediately and systematically destroyed. Now, Axios reports this morning that this demining could be quite a watershed moment here, largely neutralizing one of Iran's main sources of leverage. Officials also telling Axios it makes that draft Iran-Oman agreement far less relevant. Remember, Iran and Oman said on Tuesday that they had revived these talks for a new temporary corridor through the strait, with Oman's foreign minister saying future management of the strait and a permanent solution will follow in due course. So again, some confusion here about exactly what is happening inside the Strait of Hormuz. As it relates to the economic pivot that the administration took this week, of course, all eyes have been on China. China buys up to 90% of Iran's oil. It signaled very little intention of cooperating here. Beijing also warning on Tuesday that it would retaliate if Chinese companies face secondary sanctions. And the timing is very delicate here. President Trump and President Xi are due to meet in Washington in around a month's time. And all eyes are going to be on exactly how much political capital the president is willing to spend on ensuring that China is on side when it comes to cutting back its exposure to Iran, which is ultimately what the United States would like to see in order to bring about some kind of effective change among this regime.
All right, Dan, many thanks for those details. Now, shifting focus then, a flash flood originating in Tibet has triggered widespread flooding across northern Nepal. Several villages have been inundated with significant damage reported to infrastructure. Rescue operations are underway, but the extent of the damage remains unclear. Thousands are feared to have been swept away by the flood waters. In some somber news, as we wind down the show, legendary country music star Dolly Parton has passed away after a battle with cancer. She was 80. Parton's 6-decade career produced hits including Jolene, Coat of Many Colors, and I Will Always Love You. She was hailed by her family as an artist who opened doors for generations of musicians and performers. She won 11 Grammy Awards and even received an honorary Oscar in 2025 for her humanitarian work. U.S. President Donald Trump took to Truth Social following her passing and ordered the lowering of flags across the United States for a week, calling the country music legend's death a true loss for millions of people. Trump posted on his Truth Social saying there has never been anyone like her and never will. Of Business Lunch, Midcap Radar will take all the market action forward. Stay tuned.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Vivek, good afternoon. Not the best start for the September series. We have come up sharply from the highs of the day below that 24,300 mark. It's the IT pack which is putting a lot of pressure, but Bank Nifty is making a comeback after being an underperformer for last two trading sessions. And midcaps, they have also come up, but so far the ratio is in the favor of advances.
Absolutely right. Good afternoon, Sonal. We started off, the September series on a very subdued note, not taking any cues from the kind of last hour rally that we saw yesterday, and equity supply is something that continues to remain very high in the markets. But a lot lined up on the show. Let's start off with the top headlines. Markets continue to trade near the low point of the day. Nifty trades around the 24,250 mark. IT and FMCG as well as consumer durables drag, while pharma and PSU banks gain.
Gaja Alternative Asset Management makes a steady debut with gains of about 15%. The management tells CNBC TV 18 that management fee remains healthy and stable.
Wednesday morning sees over 6,000 crore of shares change hands via 5 block deals in Grove, Physicswala, Rubicon Research, React Scientific as well as Wellspun Corp. The flurry points to strong institutional appetite for equity.
DCB Bank gains after sources tell CNBC TV 18 the bank is in talks with private equity firm for a capital infusion. Chris Capital is likely to be one of the PE firms in discussions with the bank.
Science stock rallies over 6% post its investor day after the company says double-digit growth is a key priority. It also targets a EBIT margin of over 15% in the near term as it transitions to a new business model. Brokerages including JP Morgan and Antique are also bullish on the stock.
All right, those are the top headlines that we are tracking for you right now. A lot of moving parts in the broader markets, though, despite the fact that we have come off from the highs of the day. The Nifty is at the day's low. IT pack is the one which is putting a lot of pressure on the Nifty as we speak. And we do have the advanced decline ratio of those two lines come up for you on the screen. They are getting closer. So it's just about time where we could see them, there could be equal number of stocks declining versus advancing as well. But we do have a lot of moving parts and a lot of block deals as well in focus. So this is our segment, Midcap Movers. Ria is here to take us through the midcaps that are moving around in trade. Ria.
Well, yes, a lot of movers in today's trading session. Let's start off with the gainers. First, we have Capri Global as well as Jindal Saw. Both of these stocks seeing a strong gain in today's trading session. In fact, both of these stocks have been seeing a healthy momentum in the past few months, up anywhere between 50 to 60% just in the last 6 months for both of these counters. We also have Cyient Limited, which is seeing a strong gain today. This stock is also up nearly 30% in the last 1 month. There's also SPFC Finance as well as Electra Greentech on the gainers list today. Electra Greentech up nearly 4%, SPFC Finance up over 7% in today's trading session. What's also performing well today is the defense pack. We are seeing names like Data Patterns, Paris Defense, DCX Systems, Garden Reach Shipbuilders as well as Cochin Shipyard. All of these stocks seeing healthy gains in today's trading session. And on the flip side, looking at the losers today, we have the likes of IKS as well as Premier Energies seeing cuts of around 3 to 4% today. Granules India also seeing a cut of nearly 2%, but this stock has run up by nearly 75% in the last 1 year. And Graphite India as well as Voltas also seeing cuts of nearly 2 to 2.5% in today's trading session.
Well, thank you so much, Ria, for joining us and giving us a list of all the top stock movers, especially as far as the broader end of the markets are concerned. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, we've actually seen quite a bit of a sell-off, especially as far as some of the utility names are concerned. So names like NTPC, Tata Power, all of these stocks too going lower in trade along with how the Nifty itself is performing. But it's a good time to welcome Pritesh Mehta from Yes Securities for a quick technical check on the market. Well, Pritesh, good afternoon and thank you so much for joining us. Pritesh, it's not been a very encouraging start as far as September series is concerned. How do you see markets headed from this point on?
Good afternoon. Thanks for having me. Now, see, when we look at markets right from the low of the month of March 2026 to the recent peak of August, we have spent most amount of time around 24K. So that is likely to hold on as important support. So I think we won't be breaking it on downside. But what is lacking is the strength or the, we can say, upside action. So I think for that, Nifty top 10, top 20 stocks need to participate. Bank Nifty needs to play a crucial role. So I think once this space starts participating, this heavyweight starts, joining in the contributing in the market, then we can say market will move higher about 24/7 zone. But I feel at least for time now, we are going to consolidate, take some time. We won't see markets moving in either direction. Rather, focus would be on the broader markets, which are outperforming.
Okay, so in that case, what stocks would you bet on? Would it be on the shorting side, I assume?
So as I mentioned earlier, that yes, market is consuming time, but the plenty of action in the broader markets. When you look at Nifty 500 or maybe Nifty Micro Cap or even the Nifty Small Cap Index, all of these indices are outperforming Nifty. So there is plenty of opportunity out there. So our first recommendation, buy on BNB Housing Finance. Now this particular stock is outperforming the entire housing basket. So we are on customized housing finance index, and this stock is outperforming, moving higher. We can see series of bullish anchor column, double top buys coming in. So it's an uptrending structure. So buy for a target of 1350 levels, and stock would be around 1120. The second stock that we like is again from the financial space, that is LTF. Now it had a strong run up a couple of weeks back. Thereafter it has been consolidating. Now showing signs of resumption of the uptrend. So from here on, we can see rally towards 390. The stock would be around 302.
Okay, all right. Thank you so much, Pritesh, for joining us with all those names. With that, let's move on and get stock or sector specific. There's an interesting note from InCred on the cement sector. Nigel is joining us now with the details of that one. Nigel.
That's right. Sonal, normally in the monsoon season, we don't talk too much about cement, but there is a note coming from InCred, so I said I'll just update the viewers in terms of what they're saying. Now, they say that, in fact, in the middle of August, there was a price increase that was attempted to be pushed through. That's closer on 20 rupees per bag. But always when there's a price increase, you want to know how much of that has been absorbed. And InCred says that closer on 50% of that, that's closer on 10 bucks, have been actually, accepted by the shade. They also go on to say that there could be probably another push in terms of pricing as the monsoon season comes to an end. So as of now, what we understand is that at least in South India, there's a marginal price increase to the tune of at least 10 rupees per bag, which is heartening in this sort of an environment where you see a slowdown in construction activity because of the monsoon. Going ahead, they are saying that there'll be another price increase that will be attempted in the month of September itself. How much of that is absorbed is going to be rather important. How does demand come back since construction activity will resume, post September itself? And finally, they're saying, yes, Q2 is expected to be soft. But that's par for the course, they believe. They're saying that the second half of the year, they're expecting a good recovery in terms of pricing as well as in demand. So put everything together, a mild price increase is being pushed through, and some part of the street is getting a little bit more optimistic with regard to the second half of this fiscal year. Back to you guys.
Thank you, Nigel, for joining us with that update. That's about the cement space. But shares of Cyient are zooming in trade today. The company has outlined its growth and margin priorities at its Investor Day. Brokerages have also come out with mixed views. Rima is here to join us with more details on this one. Rima.
Thanks so much for that. So up until now, Cyient operated in the traditional ER&D services space, basically helping clients design, develop, and design particular products. But now the company is saying that we want to move towards full cycle engineering services model, which basically means they want to stay with the customer across the entire life cycle of the product, right from design, manufacturing, all the way to aftermarket, maintenance, upgrades, and even end of life. The entire life cycle of the product instead of just developing the product. So the idea is to move more towards predictable annuity outcome-based model, which results in longer relationships, stickier revenues, and even higher value. Because of this, the company said that the total addressable market expands materially. Currently, it's $80 to $100 billion. If you get into full engineering life cycle, we're talking about $2 to $3 trillion, 25 to 30 times larger. So the company has laid out a roadmap, a 3-year roadmap. Year 1, FY26, year of stabilization. 27, the year we're in, is transformation. FY28 is all about scaling up. Now, in terms of growth numbers, what they are focusing on right now is double-digit year-on-year revenue growth. But FY28, FY29, they want to get to quarter-on-quarter growth. They want to see the consistency in sequential growth. Immediate term margins are 15% at the EBIT level. Longer term, they want to even get to 16%. So that's the growth and margin aspiration. They spoke a lot about even the other businesses like semiconductor. The brokerage views are mixed. So JP Morgan is constructive, but Motilal Oswal is still cautious because they say we're excited with the new focus areas, the addressable market, but they wait for some evidence on execution before turning constructive. Back to you.
Well, thank you so much, Rima, for joining us and giving us all of the updates as far as Science Investor Meet is concerned. Well, moving on, sources tell us that DCB Bank is in talks with private equity firms for a potential capital infusion. Let's go across to Yash. Yash, you broke this particular development earlier in the day. What is it that you're picking up?
Well, that's exactly what we're picking up. DCB Bank, in talks with various private equity players for a potential fund infusion into the bank. What we've been given to understand is the conversations between, of course, DCB Bank and all the private equity players is concerned. Chris Capital at this moment seems to be leading, in terms of, getting that opportunity to infuse fund in DCB Bank. The bank had already taken an in-principle approval from the board for a fund raise of about 2,000 crore, out of which 1,500 crore was through equity issuance and the balance 500 crore through debt issuance. We've written to both DCB Bank as well as Chris Capital on this particular story. A response from either of them remains awaited. But just a quick look at how the bank is placed in terms of its capital requirements. The bank is likely to use the capital which it raises towards growth. It has a stated ambition to double its balance sheet every 3 to 4 years. So of course, this capital which will be raised is expected to be used towards that objective of doubling the balance sheet. Its overall capital adequacy ratio, CAR, stands at 17.03%. This was as on June 2026, up from 16.66% a year ago. That is comfortably above the regulatory requirement, but indeed the bank requires capital to support the future growth that it sees in the space, and hence the conversations with private equity players. Leading them is Chris Capital at the moment, according to our sources.
Okay, all right, Yash, thank you so much for bringing us all those details. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Welcome back. Well, JSW MG Motor India has launched the Hector Tomahawk EV at a starting price of 19.49 lakh, while the battery as a service option starts at around 13.99 lakh. The 3-row electric SUV gets a 69.2 kilowatt-hour battery with a claimed 517 kilometer range and is available in 5 and 7-seat configurations. The Tomahawk EV will rival the Mahindra XEV 9S and Kia Carens Clavis EV. In fact, we caught up with Parjinder, director at JSW MG Motor India. He tells our colleague Rachna that the company aspires to become the market leader soon and expects MG to turn profitable in calendar year 2027. Listen in.
We were, very close to the #1 position in EVs, but we've fallen to like few months #3, and last month we came back to #2. I think with the launch of the Hector Tomahawk EV and with the Hector Tomahawk PHEV, our aim is to become #1 in new energy vehicles in India, and we believe that with this launch today, our sales should be coming very, very close, if not overtaking the market leader in the EV space. So we're very excited. I think this is a phenomenal product. It's a C SUV, so it's a much bigger car than the Windsor. The Windsor has also been loved for its internal space and for all its features. With this launch, we are solving two problems. One, if you want a pure electric vehicle with a very large range of 500 plus kilometers, you can go for the EV. And if you're a first-time buyer, or if you're a buyer that has some trepidations about new energy vehicles, some trepidations about range, you can go for our plug-in hybrid. And both the cars offer phenomenal qualities, phenomenal range, phenomenal power, phenomenal features. So I think that this is the first time any Indian OEM has launched the same car in two different drivetrains within new energy vehicles. And I think it's going to be, I think the product that takes MG to the next level.
All right, so the aspiration is intact, which is to be #1 in this segment. Would you back that up with more launches, more nameplates that we can expect this year?
I think for this year, this is it for MG with the EV and the PHEV. EV, deliveries will start in September, and the PHEV deliveries will start in November. I think on the back of the Magister, this is the lineup for MG for calendar year 2026. I think the next slew of launches from MG will be in calendar 27.
All right, then exciting times ahead for the company. But like I said, aspiration is pretty intact, but we've been pretty gated about profitability. So when do you see a group entity level profitability happening, and what's happening with the SAIC 49% share? Is it going down, coming up, considering there are also IPO aspirations?
Yeah, I think in terms of profitability, I think with this car now launching and with the scale coming, I think MG now, we can expect MG to be above 10,000 units in a month, which will make MG only the 7th auto company in India to cross the 10,000 milestone per month. With that scale and the economies of scale kicking in, I do expect the company to become profitable in calendar year 27. In terms of discussions between shareholders, I think that's best left between the shareholders, and as and when something is there to be disclosed, I will tell you myself.
All right, we'll keep an ear out for that. But also I had the opportunity to visit the Halol plant, which is pretty huge. About 100,000 is the capacity. But are you close to hitting the ceiling there, and is there a second plant in the works or on the table?
Yeah, so currently the capacity of our Halol facility is about 110,000 units a year. And like I said, with this car, we expect to start crossing 10,000 units a month, which is putting Halol absolutely at capacity. We are augmenting that capacity. By March, our capacity will be about 160,000 units a year. And then within Halol itself, we will be expanding in phases, first to 220,000 units, and then eventually to 400,000 units a year, all in Halol. So Halol has the footprint and the land bank and the capability to go up to 400,000 units. It's only once we start crossing 300,000 units, we would look for a second manufacturing facility.
All right, today also marks the start of the festive season in the country. Today is Onam, we have Raksha Bandhan and so on and so forth. What's the expectation with the festive season, especially with the Tomahawk?
I think auto demand has really surprised all of us this year. It's been growing at a clip of more than 10% year-on-year growth, whether you look at passenger vehicles, two-wheelers, anything. And I think it's really incredible that while the world is in such a big crisis, India remains resilient and India remains strong. I think our launch of the Tomahawk in the festive season is to really capture that demand which surges during this period. And now that both the cars are launched and the bookings are open, I expect to be sold out for the rest of this year within the next 2 weeks.
Well, that's part Jindal in conversation with our colleague Rachna, and that was the JSW MG Hector Tomahawk, which has been launched, and they aspire to be the leader as far as the EV segment in India is concerned. Well, looking at the markets itself, Nifty continues to languish, continues to trade below the 24,000, less than the 300 levels, 24,262 to be precise. Again, hovering near the low points of the day. But the other segments, the mid-cap, small-cap, continue to trade above the high point, trading above the midpoint, but still advance decline ratio largely in favor of the advances at this point of time, but not by much. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny. Along with me is my colleague Arundhati as well. Arundhati, good afternoon. And midweek blues, I think the market is feeling it as well, right? Started a bit on that high note and then we saw it coming off. And now also, if you look at the Nifty, we're not seeing any sort of a recovery that's coming. Yesterday in the last hour of trade, we had seen that spike up. Today, that's not the case, right? Nifty is trading at the day's lowest point now, 24,250, 260. Around that mark is what the Nifty 50 is trading at. Even the Nifty IT, that's the one that's causing a bit more of a pressure in the trading session today. It's down 1.5%. So that is also something that is causing that fall overall. While on the flip side, you have the banking space and Nifty Bank, which is managing to hold on to gains in the trading session. 0.7% of gains, especially PSU banks, Arundhati. Today, that's leading the way, at least on the banking side.
Absolutely. Nifty not starting this new series on the best note possible, 0.3% lower and finding that resistance at that 24,400 mark, but now below that 24,300. As you pointed out, PSU banks, private banks batting for the bulls. If you take a look at the top gainers, we've got Kotak Mahindra Bank, Axis Bank, ICICI Bank, all of them batting for the bulls. And on the flip side, it's those IT names, Infosys, Tech Mahindra, Wipro, all of them lower in trade today. And that's how the markets are shaping up this afternoon. But joining us today to answer all of your stock queries are Asta Jain from Haim Securities and Ruchit Jain from Motilal Oswal Financial Services. Thank you so much for joining us on the show today. Let's get down to it and tell you our first query that's coming in from Augustine, who writes to us from Kochi. He holds 1,000 shares of Pine Labs at 150 rupees. He's making a profit on that stock and he wants to know the future prospects on it. So Asta, let me come to you first. You know, Pine Labs at 167 right now. What's your view on it from a long-term perspective? Is it a good stock to stay invested in?
Hi, good afternoon to everyone out there. So yes, Pine Lab is a very strong fintech platform, first of all. And the kind of turnaround which we are seeing into this counter is commendable because it has turned out to be the major, turnout story because we have started seeing the profitability in the counter. And they have got the excellent operating leverage. So my idea here is if we just remove the valuation part because valuation is somewhat expensive at this point of a time. And this valuation seems to be more expensive when we compare it with the competition. So that is one of the major concern about the Pine Lab. Otherwise, there is no issue with the business model. So idea here is one should remain invested in the counter in the long term because we are expecting growth to be continue to be there. So definitely these valuations will get diluted, hopefully. So remain invested in this counter with a price target of somewhere at around 180 to 190. These are short-term targets I'm giving right now.
Okay, we'll watch out for those levels over there. But, coming to you, Ruchit, good afternoon. Viewers bought 1,000 shares at 150, so almost near that lows for this stock. I know there's not much in terms of charts to read so far. It's been less than a year since the listing. But any view and suggestion coming in, given that post-listing we've seen a 33% decline, and now in the last 1 month specifically, the stock has started picking up pace. So anything you've managed to pick up here?
Yeah, hi, very good afternoon, Vinny. Very good afternoon to everyone. Well, in fact, after that full post listing, we have seen last 3 months the stock has been consolidating within a range. Since mid-May till now, the stock has not been able to surpass that 172, 173 mark. So the first breakout level from the near-term perspective would be for the stock would be to surpass that 173. So if that is surpassed, then you can expect a momentum towards 185, 188 levels. So for now, I think since the buying price is near the support itself of 150, can hold your existing positions, keeping stop loss at your cost price.
Okay. Hold the position. Stop loss should be a cost price. That's a word coming in there on the technical front as well. But let's move on to the next query for today. We have Murukappan, who's writing to us from Chennai, holding 120 shares of PCBL. Price is 385. They're making a loss on this one. Currently, the stock is at 327. Now, he's a long-term investor, wants to know whether to hold the stock or look to add some more average. What is the view coming in on this one, Asta? PCBL, India's largest, carbon black manufacturer that is there. Anything that you are watching out for here?
So what I'm watching out right now is that it is a good long-term story. The only problem is with the valuation, although we have seen very strong set of numbers from this counter, but valuations are demanding. And I think if I talk about the business model, as you have rightly pointed out, it is the largest carbon black manufacturer, and there is a strong, story regarding the carbon growth opportunity which we are seeing right now. So it is working well for the company. They have got a they are backward integrated company, which is very strong point for the company. And I think the concern is with the valuation only, and hence maybe our investor here is facing some losses. But I think there is no reason to worry because of the business model. Stay invested in this counter, and in the coming days we can see the break even for our investor. So 385 is what the price at which he has invested. Maybe in the coming days we will see those levels again. So hold is recommendation from my side.
All right, so hold is the recommendation from your side, and you expect it to come back to those levels. Ruchit, what's your view for PCBL? 385 rupees is the buy price. Long-term investor, any technical levels to watch out for? Should he stay invested?
Yes, the stock has been holding above its 200 EMA for some time. 300, 310 is a good support zone for the stock. So the downside could be limited from current levels, but just because of the lack of momentum, I won't advise to average out or buy more quantities. But on your existing position, I think keep stop loss below 300 and continue to hold on any pullback moves towards 370, 380. Just take a review again.
All right, so that's the view coming in there for PCBL. The next query coming in from Isai Amudu, who writes to us from Tamil Nadu, and she holds 350 shares of Bajaj Housing Finance at 126 rupees. She wants to know if she should continue to hold, accumulate, or sell at the current levels. The stock is currently at 84, and she is making a loss on that stock. So, Astha, let me come to you first. Should she accumulate at these levels or sell?
So I think don't accumulate at these levels, and even don't sell. Remain invested, and I think she'll get the opportunity to accumulate or average it out at the lower level. Now, what is the problem with the Bajaj Housing Finance? Their AUM growth is strong, but the problem is with the margins. The net interest margins are compressing, and if net interest margins are compressing, definitely they will not going to add in the profitability. So this is the major issue with the company, and hence we are seeing that company is not getting that sort of a interest from the investors in the term of stock prices movement. But right now, let's wait for another quarterly numbers to come in that will arrive after, September, after 30th September. So I want her to wait at least till the numbers come. Otherwise, there's a problem with the margins, which in case if they have shown some sort of improvement in their numbers in the coming quarter, then definitely we will see some sort of a recovery in these stock prices. So right now, just hold, wait and watch is what I am recommending for this.
Wait and watch is the word coming in for Bajaj Housing Finance. What's your view this one, Ruchit? Bajaj Housing Finance on the technicals also, is it a wait and watch, or can they look to add more stocks right now as well and average it out?
It's into a consolidation phase. Every pullback move near 90, 94 has sold into one over last few months. And on the lower side, support is found around 80. So 80 to 100, you can assume that this would be the sideways trended phase in which the stock would still consolidate. Just because it's the lower end of the range, so the downside risk is not much from here. So can hold on. Any pullback move towards 95, 100 should act as a resistance.
Okay, we'll watch out for those levels over there as well. Next query for today, we have Siva, who's writing to us from Amravati, holding 300 shares of BSE. Prices 3,520 rupees, making some bit 520, so making a loss on this one. Now he's saying he can hold it for a time period of 3 more months. Should they continue to hold or book their losses? Astha, your view on this stock, what should the viewer do? The time period is short term, so does it merit holding it now?
Because in 3 months time duration, again, we will see the another quarterly number from this counter, hopefully. So that is why I recommend hold. Now, this company has got a very strong operating leverage, and the derivative markets is their major I should say, a major driver for the company at this point of a time. So they are, in fact, Q1 FY27 number was also very good. But again, the problem is with the valuation, they are demanding right now, and that is why we are saying that still stock prices are not moving in the northward trajectory, which it should be on the basis of their Q1 numbers. But wait for another quarterly numbers to come in, because here time horizon is 3 months. So definitely we will see those numbers and then make any sort of decision. Just a hold is what I can recommend for this counter at this point of time.
All right, hold is the recommendation there. Ruchit, what's your view for BSE? We will have probably another quarterly result. The person can hold it for another 3 months, making a loss currently, but should he continue to hold or book some of his losses now?
But I want to continue to hold. Last 3 years, the stock has given very good returns, and this entire 3 year, if you look at the weekly charts, and on every major corrections, the stock has formed a support base around its 50 weeks EMA, and then has resumed its uptrend. That 50 weeks EMA is now placed around 3150, and stock price is already corrected from 4400 to 3300 now. So 3150 is a major support, as far as medium-term charts are concerned. So till that is intact, there's no reason to exit at current price level. So continue.
So continue to hold is what you're saying coming in. Richard, just want to know, right? You said there's every correction is bought into. So right now also we're seeing a bit of a decline that's happening, right? So should they even look to average? Because the time period is only 3 months of their holding.
Yes, I think that could be a good idea. The risk reward issue is also favorable. So keeping stop loss below the 3150, these are the levels where one can even look to average.
Okay. All right. Okay, so that's the view coming in there for BSE, and that stock currently at 3,332. The markets currently, the Nifty at 24,265, still seeing a decline, 0.3% lower. The Nifty Bank is doing better, but it's also come off the highs of the day. It was at 1.8% higher, about 0.6% in the green right now, 350 points higher. So that's how the markets are shaping up right now. But on that note, it is time for us to head into a quick break. But we'll answer more stock queries on the other side. Stay tuned. Welcome back. You're watching Your Stocks on CNBC TV 18. Still with us, Asta Jain from Haim Securities and Richard Jain from Motilal Oswal Financial Services to answer all of your stock queries. The next query is coming in from Sriram Raghuraman, who writes to us from Chennai. He has 25 shares of Rajratan Global Wire at 483 rupees. He's making a small profit right now as we speak. He wants to know the view on this stock from a one-year perspective. So, Asta, from a one-year perspective, how do you view this stock?
Is looking very strong to me. Now, I tell you one thing, this company manufactures steel wire, that is the bead tire wire. Now, what is this? Basically, it just, fixes the tire from the wheel rim. So this is the major work this company is doing. So it is like making main internal skeleton of a tire. So this is a value-added product which this company is doing. And we have seen the numbers. Numbers are very, very strong. In fact, their facilities like Chennai and Thailand are working well, and this Chennai facility will really become very strong growth driver for the company in the coming time. And in fact, the cost price is not very much higher from the current level, so there is no need to worry. Stay invested in this counter. This counter is looking very, very good because they are not into a commodity wire. They are manufacturing something a value added wire, which will really look very strong and help the company in posting very strong set of numbers going ahead. Stay invested. Maybe price target can be set at somewhere at around 500 to 530 odd levels in the short term.
Okay, we'll keep an eye out on those levels over there. And like, Asta mentioned as well, this is not a company that is just making wires. It's supporting the automotive industry. It's the tire over there. It's making the skeleton. And, I remember this that last time we spoke to the management as well. They said that, Q1 was good quarter, steady quarter. Margins were lower, but they said that they've already taken those price hikes, which will be passed on as well. So that margins will also start coming back, and they'll keep growing volumes in terms of 15 to 18%. So will be interesting to see from here on as well. But on the technical terms, what are we watching out for here now? Ruchit, in the last 6 months, the stock has seen a 16% uptick. What should they be doing now?
The downside seems to be limited from here on. It has a good support around 450, 460 where the 200 EM lies. So till that is intact, I don't think there's much to worry about. We have seen intermediate declines with a bit volatility in the stock, but we have not seen any kind of volume-based selling whenever there is a price declines. So till 450, 460 is intact, I think you should hold on.
Till 450, 460 is intact, no worries, and can continue to hold on. That's a word coming in there on the technical front as well. Let's move on to the next query for today. We have Kumud Sethi, who's writing to us from Dehradun, holding 100 shares of EID Parry. This is at a price of 734, and they've been holding for a last couple of months, is what she's saying. Wants to know the 1 year time period outlook for the stock, and also wants to know if she should buy Tata Tech for 1 year from here on as well. Asta, Tata Tech as well as EID Parry. They're already holding EID Parry. Entry into Tata Tech, is that the best bet on the tech side?
So EID Parry is just from the traditional sugar manufacturing company. It is like, diversified in the nutrient and the allied crop protection, nutraceuticals, etc. So, and what we are seeing that now the kind of reforms or the kind of improvement we are seeing in the balance sheet is really commendable. And we believe that going ahead also, the kind of diversification they are doing, as I've already told you, that nutrient and the nutraceuticals they are into. So definitely they can also act as a growth drivers for the company. Just remain invested in this counter is what I can recommend at this point of a time, with the price target of somewhere at around 880 to 900. Regarding Tata Tech, I would recommend just hold. Don't enter into this counter at this moment of the time.
Okay, don't enter into the Tata Tech counter at this current point in time. Ruchit, what's your view? There are two parts to this query. Eat Parry at 734 rupees. She's been holding for a month. She wants to know the 1 year target for Eat Parry, and she also wants to know if it's the right time to sort of buy Tata Tech from a 1 year perspective.
Recently, we have seen a good up move in most of the sugar stocks. But if you do some comparative analysis with the price performance from Eat Parry with regards to other sugar names, then it has been a relative underperformer. So the price up moves within the sector when we are not witnessing any kind of follow buying happening in EID Parry. So my advice would be to take a sell on the rise approach, and any kind of pullback moves this comes again in the sugar sector. You can switch to some other name like Balrampur Chini where there is more consistency. As far as Tata Tech is concerned, the overall structure seems to be more into a consolidation. We have already seen an up move recently. So I think we could see some sideways trend in the near term. Comparatively, if you look at the entire IT basket, Coforge is one of the most outperformers stocks within the IT names. So I think that stock could continue to do this. For Coforge over Tata Tech.
So you prefer Coforge over Tata Tech. So that's the view coming in there. The next query coming in from Narayan, who holds 9,000 shares of ICICI Bank at 1,100 rupees. And he wants to know what the timeline is for the stock to move towards 1,700. He is currently making a profit on it, the stock at 1,437. What's the long-term view, Asta? And when can he expect the stock to hit 1,700 rupees?
The long-term view is positive with the kind of ROA the bank is delivering, 2.3 to 2.5% kind of profitability they are delivering, I believe. And they are a very strong deposit franchise. My idea here is that it will take maybe 3 to 6 months to reach those levels, maybe faster than that. I cannot comment on the timeline, but long-term view is positive, and 1,700 is the level which we can see. So yes, hold this counter.
Hold ICICI Bank. That's a word on the fundamentals. On the technical front, Richard, what's your view? They are bought it at 1,100 rupees. What should they be doing?
The overall trend looks quite strong. We have seen that the Bank Nifty index, if you see, it made a high in February 2026, around 61,000. From there, it corrected up to 51,000. ICICI being an heavyweight, we did not see that much correction in the stock. And even now, if you look at the entire consolidation in the banking space, then within the private sector heavyweights, ICICI Bank has been a relative outperformer. So you can hold on at least 6 to 9 months perspective, I would say, where you can expect good returns.
Okay, let's move on to the next query then for today. We have this coming in from Kishore, who's writing to us from Kerala. He has a query on data patterns, more on the defense side now. He's bought 275 shares of data patterns. He's bought it at 4,618. Stock currently trading at 4,800 approximately, so making a profit on this one. Wants to know whether, there's a more upside and up room left for the stock, or should they just book out their profits right now? Asta?
I think more upside is there. Because we all know, I mean, they are into the electronic defense manufacturing, and the kind of order book they are having, it is very, very strong order book. The only problem that Q1 numbers were not very much impressive. And this is the nature of the business, because they don't get smooth revenue all over the quarters. Some quarters are lumpy, some quarters are not. So that is the main thing. And another problem is with the company is that if they are not able to maintain the kind of order inflow, or some orders get delayed, then maybe company will not able to sustain the kind of margin which it is earning right now. So all these things need to be seen. But my idea here is that this stock can move more upside from here. So I think even partial profit booking is recommended, but don't exit this counter fully at this point of the time. We are seeing the target of 4,900 to 5,000 in this counter.
So partial profit booking, but do not exit the counter. All right, Asta, Ruchit, thank you so much for taking time out and answering all of our viewers' queries, but we're completely out of time on the show. But do remember to call us and email us your queries, and we will address them with our experts. But stay tuned for Closing Bell to take you through the last hour of Trade from Vinny and me. Goodbye, and many thanks for watching.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Japanese markets were higher, Kospi seeing a bit of a cut right now. So it's a mixed picture as far as Asia is concerned.
Oil fell 2% in the last 15 minutes going into the US market close. 24,340 on the Nifty. The Nifty Bank is up about 1/3%.
And as I said, the social calendar is as strong as ever. So we are looking very good for half two of the year.
So that's the good news. I mean, the more orders we get, it's for the subsequent years.
It's a role that I'm 100% continuing.
So what helps, may I repeat, is 2 decades of history as a fiduciary.
On the way up is the Nifty Bank, up around 2/3%. On the way down is the IT index.
Then we're talking about an addressable market of trillions of dollars.
DCB Bank is in talks with a few private equity firms.
Who are the key sellers in most of these block deals? It's mainly been the private equity players, the early stage investors.
Come up sharply from the highs of the day below that 24,300 mark. It's the IT pack which is putting a lot of pressure.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel. Another quiet, grinding down kind of a trading session. We hit the highs early in the morning. The Nifty high is 24,378. From that level, exactly 100 points down on the Nifty. So this 24,300 is acting as a bit of a resistance. It's a new series when it comes to the NSE, but for the Sensex, we will have the monthly expiry. Banks are doing well, so perhaps aided by the decline in the yields, global yields. So the Nifty Banking Index is up more than 0.5%, so clear outperformance, and even the PSU Bank. So PSU Banking Index is up about 0.8, 0.9%. A sector under pressure today is IT. And here, maybe there is some nervousness ahead of NVIDIA's numbers. If NVIDIA does well, then generally the AI trade does well in Kospi and Taiwan, and that's a negative for Indian IT companies. So that could be one factor to watch out for.
Well, that's right, Reema. I think and the biggest positive is crude oil prices have dipped, right?
And
Yet again. They stayed down as well. So hopefully that continues to play out and then you get a little bit more optimistic. But stocks doing a thing of their own. I think in today's trading session on the Nifty itself, it's unwinding some of the yesterday's last hour move. So I guess that's the reason.
Well, indeed, we are unwinding. And the 24,300, both Session and Mitesh were telling us that's an important level, and we are facing some resistance over there. It's just that on this crude price decline and hopes that the Strait of Hormuz opens up, they enter into an agreement. We've heard this tape in the past. That was the reason why crude fell from $90 to $70, but once again, it's come back up and now down. But I guess we have to just live with the kind of volatility in crude prices. Let's tell you, what the day has looked like, what's lined up for you on Closing Bell today. Range-bound trade continues. The market gives up opening highs. Nifty trading around that 24,270 marks. Banks, small caps outperform. Hindustan Zinc rallies on surging zinc prices and bullish brokerage notes. There is a bullish note by Motilal Oswal, which sparks a rally in Vedanta Aluminium. And Jindal Saw perks up, surging 7%. We'll tell you what's behind that. And Cyient at its Investor Day sees double-digit growth as a priority. They're talking about 15% margins in the near term, 16% margins over the long term. This stock is upbeat. Sources tell CNBC TV 18 DCB Bank could be looking at a private equity fund infusion. Yash gets us more on this story. For now, let's get to the trading ideas. Mitesh is now joining in as always. Mitesh, we've been grinding lower since the start of the trading session. What have you done with your trades and what do you think will happen in the last 1 hour?
So I think, one thing which has happened and has been the Nifty is testing 24th period but not closing above that. Yesterday we did that and today again we are off. So I hope, during the closing session we kind of managed to capture 24th period again. That should add strength on the upside. But till then, trading is stock specific and I have a buy on Ashok Leyland with a stop at about 135. Look for targets in the range of 187 to about 189, and RP has broken down below its key short-term averages, so that's a sell with a stop at about 1943 for targets in the range of 1865 to about 1880.
Okay. All right. Got that, Mitesh. Well, let's get a couple of stocks then that are buzzing around, and they are coming in from the metals pack. You have a Jefferies note on Hindustan Zinc and Motilal Oswal talking on, on Vedanta Aluminium. Let's start off with the Hindustan Zinc piece first. Jefferies, they've come out with the note on metals. They say that the spot zinc price is 15% over the average that we saw in the June quarter. They also go on to mention that silver prices have recovered close on 23% from the lows that we saw in July. On Hindustan Zinc, they have a buy rating, but they've increased the target price. Earlier, it was around 660 rupees. Now they're talking about a number of around 750 rupees. They've also gone ahead and they've raised their EPS estimates for the next 2 years by around 10 to around 11%. What they're factoring in is that now the zinc market will be in the deficit for 2026. Remember, earlier it was in a bit of a surplus. Now they're holding on to that deficit that they're talking about for 2026. They've also gone ahead and raised the FY27 as well as 28 zinc assumptions to around $3,600 to around $3,700 per ton. Remember, even these assumptions are still lower than what the spot rate is at. It's around 7 to around 9% lower as what spot is at. So they're giving themselves some bit of cushion. On silver as well, they've gone ahead and they have upped their assumption to around $60 to $63, but that as well is 8 to around 14% lower than what the spot rate is at. So that's why Jefferies is fairly optimistic on Hindustan Zinc. Moving to Motilal Oswal, they are bullish on Vedanta Aluminium. They have a target price of around 540 rupees per share. They believe that the company is entering a strong earnings inflection point because the EBITDA is projected to compound at around 18% for the next 2 years. That's FY26 to FY28. And that's going to be driven by three broad factors. One is the volume growth will come about. The integration-led structural cost reductions with regard to their backward integration as well. That's what's going to help them in reducing the cost per ton. And also the management has indicated that they're focusing more on value-added mix, which will help them in terms of profitability. They go on to mention that the global aluminium market is structurally tightening due to China's production cap, supply disruptions both in Europe as well as in Russia. And they say that the valuation gap between Vedanta Aluminium and its peers, that's what's providing an opportunity for a structural re-rating in terms of its valuation multiple, which at current reckoning, it's at around 5.3 times its forward EBITDA number. So put all that together, Motilal Oswal fairly bullish on Vedanta Aluminium. That stock has perked up, and you have Hindustan Zinc as well that's popping around post that Jefferies note. Well, let's welcome our guest on the show. We have Ashish Chaturmurtha, Managing Director and Fund Manager at JM Financial, who joins in. Hi, Ashish. Good to see you win. What are you making of both these two counters? Both of them, in fact, have seen a good bounce. Remember, they corrected a good deal from the top as well. Vedanta Aluminium listed at $530. It pulled down to around 430 rupees, and from there, it's seeing a good move. While Hindustan Zinc as well, the float is a little limited over there. And always the fear is whether the government or the promoter will come and sell some stake. What's your view?
Hi, good afternoon, Nigel, and thank you for inviting me on the show. So structurally, we are quite positive on the entire commodity cycle, obviously, because the way there's a structural deficit in aluminium, copper, zinc, or even for that matter, silver. I think that's going to be a structural trend for at least for the entire commodity cycle. And now there is a indicator which is typically in the form of falling dollar index, which has fell down below 100 odd levels, and that has resulted into a very strong re-rating happening in the last couple of days, where you have seen silver going almost 10 to 12% higher from the lower levels. Same is the case with gold, and we are seeing the same trend developing into copper, zinc, and aluminium. So as far as Hindustan Zinc is concerned, we are quite positive. Obviously, if you look at the cost of production, Hindustan Zinc is the lowest cost producer across the globe, and this quarter we have seen almost 77% kind of revenue growth, EBITDA growing almost 109%, and the PAT growing almost 145%. And our belief is both zinc and silver prices are going to go up, which is not estimated in the current, I would say, valuation. So the upside looks quite promising. As far as OFS is concerned, as Deepam has clarified that there are currently no plans for this Hindustan Zinc offer for sale. So obviously this has removed the overhang, at least in the shorter term, but definitely in the long term, as government still holds almost 28%. So future stake sale still remains a risk. But at this point of time, we are quite positive on both these names.
Okay, all right. Thanks a lot for that, Ashish. I want to ask you on these pipe makers then. That is Jindal Saw and Welspun Corp. If you pull up a chart, in the last year or even more than that, you'll see that actually Welspun Corp is almost at its all-time high, while Jindal SAW is a good distance away. It's more than 20% away from the highs that we saw, say, 2 years or so ago. So there's been a bit of a gap in terms of stock price performance. And in today's trading session, at least, you have Jindal SAW that the street is getting a little bit optimistic on. Let me try to explain this to you. First, on the valuation parameter, looking at the forward EBITDA number, Jindal SAW is trading at around 7 times EV upon EBITDA. This is as per what Bloomberg is throwing up in terms of the EBITDA number that they are working with, in excess of around 3,200 crores or thereabouts. On Welspun Corp, well, the number should be closer to around 4,000 crores, but that one's trading at around 14 times. So there is one argument that valuations are in favor of Jindal SAW. However, if we look at execution, there's a big gap between the two. Jindal SAW, if I take a look at it in the last 4 quarters, their EBITDA number from 451 crores has come down to around 390 crores. In the same time span, Welspun Corp, their EBITDA has moved up from around 590 to around 700 crores, closer to around 700 crores. So execution of Welspun Corp has been much, much better. Jindal SAW, one argument is they're sitting on pretty okay order book, $1.4 billion. That's looking at the consolidated order book. You put in the UAE business as well, the core standalone business as well, and some job work as well. So $1.4 billion approximately is what they're sitting on. And exports constitute close to around 30% of this. And bulk of the exports go to the Middle East. And we know because of the conflict, a lot of that movement has actually got restricted. So that's why, in fact, the performance hasn't been that good as well. Then what is the street optimistic on? They're optimistic that execution of orders picks up in the second half of this fiscal, and probably in FY28 as well, execution gradually picks up. They're also focusing more on oil and gas now rather than on water. And the street believes that they are looking to capitalize on the oil and gas pipeline opportunity that is presented for a lot of these pipe players. Their expansion of capacities as well will come in the next 2 to around 3 years, both in Saudi Arabia as well as in, Abu Dhabi. Whether you look at 8-saw pipes, L-saw pipes, seamless pipes, DI pipes, all of those capacities are coming in the Middle East. So by FY28-29, you'll have some of that will start reflecting as well. So those are the triggers in the time to come. So the street is excited on Jindal SAW. The question is, will it deliver from, what the street is working with? For the time being, just take a look at that. In terms of the last 1 year performance, Welspun Corp has had a dream run. Jindal SAW is actually, though it's up, it's much lower. And if you look at it in terms of the distance from the all-time high, it's still a distance away. So will Jindal SAW deliver? That's going to be the big question. What do you make of this, Ashish? I think you all were bullish on Welspun Corp, if I remember correctly. You could correct me on that. And what's the view on Jindal SAW? Will you bet on that?
So definitely, yes, Nigel, it looks quite promising, both from the valuation perspective, trading at a very sharp discount to what is being traded at a Welspun's level, and also in terms of the kind of order book. So at current levels, we are seeing almost 1,500 million, worth of order book for iron and steel pipes, and as well as for pellets. And our belief is once this entire, UAE order book starts getting execution, then you will see very strong numbers coming from Jindal SAW. And I think market has started giving those, those multiples basis the improvement in the execution, which will also get reflected into the margin profile of the company. So our belief is order book is very strong, valuations are comfortable, and UAE challenges, I think, is the overhang of UAE challenges is also getting overdone. So our belief is market is now trying to give a lot of valuation re-rating for this execution capability, which is going to take place in the UAE markets.
Okay. Ashish, what about Varun Beverages? There's been so much chatter about the company getting into the alcobev space, but finally they've made their move with Kiva in ready-to-drinks, on the alcoholic side. Stock is not very excited today, down 3-4%. What is your assessment of the news? I know it's very, very early stage. The company still has to come out with their plans. So it's not that EPS estimates get revised anytime soon, but they've taken the first step, and the CEO announcement is also positive.
Yeah. So Rima, our belief is that, now VBL is setting up a wholly owned subsidiary where they are going to do ready to drink as well as the alcoholic beverages business. And obviously they've appointed a CEO from the Diageo and Pernod Ricard. So clearly, I think in terms of hiring, they are hiring the best talent. What we believe is that they are not just going to focus on product launch, but also on the organic development as well as the acquisition side. And along with that, we believe there is going going to be a lot of partnership with the global brands. So all in all, it is quite positive. But the only challenge is alcoholic beverages is not a easy business, because as we know, it is heavily regulated at state level. Taxation differs with across different states, and licensing is very complicated. So all in all, I think execution might face some challenges, but we believe Varun Beverages has the capability to do it. So maybe currently market is not rewarding it because of a new business getting into it. But our belief is on dips, Varun Beverages could be a very interesting bet, because overall we believe the alcoholic beverage is going to grow at 15 to 20% CAGR for at least next 7 to 10 years time frame.
Okay, so the industry is growing well, and Varun Beverages, with its distribution, has a right to win. So it can emerge as a growth engine for the company. But again, very, very early stage. But Ashish says, look at the stock at dips. But let's talk about another big story. And this is what we learned from sources. DCB Bank is in talks with private equity firms for a potential capital infusion. Yash joins in with this one.
Well, that's exactly what we've been given to understand from our sources. DCB Bank currently being in talks with a few private equity firms for a potential fund infusion. Also, what sources tell us is that Crude Capital is primarily a name which is emerging as a front runner as far as the conversations with private equity players is concerned. Remember, DCB Bank had taken an enabling approval from its board to raise about 2,000 crore very recently, out of which 1,500 crore was taken as an approval through equity issuance, and the balance 500 crore through debt issuance. We've written to both DCB Bank as well as Crude Capital on this particular query. A response from both of them still remains awaited. But just, an understanding in terms of where the bank stands in terms of its financials, its capital requirements. What we've been given to understand from our sources is that the bank is likely to use the funds raised via this preferential issue, expected to be a preferential issue, as growth capital for itself. Private equity players are allowed to, infuse funds and participate as far as stake acquisition in banks is concerned, up to 9.99%. That is with a prior approval from Reserve Bank of India. And as far as DCB Bank is concerned, they have a stated ambition to double their balance sheet in every 3 to 4 years, and that's where this capital is expected to be used. As far as overall capital adequacy ratio for DCB is concerned, it stands at 17.03%. That was as on June 2026, up from 16.66% on a year-on-year basis. That remains comfortably, above the regulatory limit. So the growth capital is what DCB Bank is looking at. Crude Capital leading that group of private equity players.
Thank you very much for that. Ashish, the news surrounding infusion into banks, NBFCs, or maybe mergers like we had yesterday with Jana and Federal Bank. So much happening in the banking and fintech space. If this were to play out, DCB gets that fund infusion, how would you read the development?
It's quite positive, and we have seen in the case of RBL Bank where the stock got completely re-rated post the infusion, and now DCB Bank, which is trading at almost 1 time price to book with a very strong capital adequacy of almost 16%, the net NPA below 1.1, and we believe that the net interest margin is also quite reasonably good at about 3%. So clearly our belief is with this infusion, I think there can be very good re-rating on the price to book multiples. And structurally, we believe 1.4, 1.5 time price to book can be given to the stock with the expanded book. So our belief is a stock is moving towards 250 to 60 kind of trajectory in coming few months. So it's a very strong candidate within the midcap banks. On the NBFC side also, we believe Shriram Finance is one stock where we are structurally quite positive post this MUFG deal.
Okay, like Shriram Finance, and DCB Bank also headed higher, levels of about 250. Earlier today, Lata had a very interesting chat with Vilayan Subbiah, Executive Chairman of Cholamandalam Investment, and he said that he will continue as an Executive Chairman. He also sees improvement in Chola Investments ROA as overall book performance picks up. He also adds that it's too early to think about a merger or delisting of Shanti Gears.
I think this has been the discussion that we've had several times. Yes. And this question has been asked several times, but definitely the answer is yes.
Okay.
It's something that it's a role that I'm 100% continuing and will continue to
So
serve.
it is something like this. Your group of the family will be the dominant shareholders in the manufacturing, CG Power, Tube Investments, etc. But in Cholamandalam, you will be the executive leader, even if there is somebody else with a dominant shareholding. Is it
No,
like that?
the general thinking at this stage is that basically we've aligned around three alignments that basically are managing different sides of the business, and that thinking continues.
Okay, so you will be in charge of Cholamandalam investment. Okay.
Definitely, we see a situation where ROAs are beginning to go up. I think it's a confluence of a couple of things. One is that the performance of the book overall is also improving, that combined with our overall mix is allowing ROAs to expand from where they've been for the last couple of years. I think it's too early to kind of think through that. It's basically, there was, we definitely see that in businesses we're interested in, we want to continue to have a significant shareholding and continue to improve that. So when there was an opportunity to do that, we did it. That's the way I look at it.
No, that's true. But 71 to 73 is perilously close to 75, where the minimum public shareholding kicks in. That's why, the stock went up so much, 18% in a day, because of all these chatter in the market. Will that also be on the horizon?
So there's no thinking of that right now. Okay. There's no thinking.
Okay. But even...
Shanti in.
Okay. It remains a separately listed company.
Yes, definitely.
And Vellayan Subbiah saying that he will continue to stay on as the executive chairperson of Cholamandalam Investment. In fact, under him, that plate will come up for you on your screen while the interview was on. The stocks have done so well. They've witnessed a multi-fold growth. So he's the executive chairperson of Cholamandalam Investment. He's currently the chairman of CG Power, vice chairman of Tube Investments. CG Power, when he took over, was about 39 rupees in Jan 2021, now at 881. Cholamandalam has surged from nearly 400 now to about 1800. Tube Investments have gone up nearly 4x from 771 to 2870. So phenomenal moves under him, and he's saying, at least for now, he's staying on board. Ashish, in these group of stocks, which one do you like? Which one is best positioned?
So our bet is on CG Power, because I think the way they have executed and the way their exposure is towards all the high growth segment, whether it's industrials, semiconductor, or even the transformers. So our belief is all these are going to do extremely well, particularly the semicon business and the transformers business, which is going to grow in double digit. And our belief is CG Power being the front runner to play this entire semicon story. So our bet is on CG Power at this point of time.
CG Power. Thank you, Ashish, for joining in. We look forward to the next one. Get into a break on that note. On the other side, we'll connect with our Alpha Manager for the day, Atul Mehra, Motilal Oswal Asset Management. Stay tuned. Welcome back. You're watching Closing Bell. Now, the equity market is seeing a fresh wave of block deals with over 30,000 crore rupees of equity supply post Q1. Who's selling? What's driving the surge? Vivek joins in with details. Vivek?
Well, thank you so much for that. Like you mentioned, it's a deluge as far as block deals or equity supply is concerned. And we are only focusing as far as the secondary market is concerned. And we are only focusing on block deals or bulk deals where existing sellers are actually pairing stake either in the block window or in the open market. So at this point of time, this analysis does not include any OFS or even an IPO, which also adds to the equity supply. So what's actually transpired that post Q1 FY27, there's been a whole host of equity supply that's come across, especially, and it's been focused mainly on new listings and select healthcare names, where there was quite a few corporate actions that had taken place in the quarters gone by, and there was some amount of consolidation as seen as the ownership is concerned. Who are the key sellers in most of these block deals? It's mainly been the private equity players, the early stage investors, as well as the promoters. Now, what are the key reasons why we are seeing so many block deals happen, especially just immediately post Q1 earnings season when the silent period gets done? Number one, early stage investors, are taking part exit. Number two, promoters, who have debt on the personal balance sheet, and also they have pledged certain amount of shares. They are taking an exit as well to go ahead and reduce the stake or reduce the pledge. And also, in many cases, you're actually seeing the private equity fund cycle come to an end, implying that, the private equity would need to go ahead and pair stake further. So the total equity supply has actually gone ahead and exceeded 30,000 crore in just a few weeks since Q1 FY27. Now, a couple of things to note, it's not comprehensive given the fact that quite a few term sheets are something that CNBC TV 18 may not have access to. And along with that, like we mentioned at the start, does not include OFSs like the large one we saw yesterday in Hindustan Copper or even in LIC, which in itself was close to 30,000 crore. We've also kept away from the primary market activity, given that at this point of time, there's quite a few there too in the pipeline. So which are the stocks that have seen majority of the stake sales come about? Just talking about today, you've seen four. You've seen VS Scientific, Wellspun Corp, Grow. You've seen Misho as well. Most of these anywhere between 1,000 to 3,000 crore. Most of the sellers here are actually early stage promoters, early stage investors, as well as private equities like Carlyle. You saw a very large block deal take place in K Fintech, where General Atlantic sold close to 1,400 crore. Aster DM, TPG sold close to 5,000 crore in that particular name. Another large block deal that we saw was in Paytm, where the eventual owner of the stake was Ant Fink, again closed a little over 4,900 crores. These are very large block deals that we're talking about, and in most of the cases, they got absorbed quite easily. A couple of names too, you saw Tenneco Clean Air, where the parent entity paid close to 2,000 crore, Misho to 1,200 crore, and what we understand from our investment banking sources that there are still quite a few large block deals in the offing. So it'll be interesting to see what is the kind of equity supply and how it gets absorbed as far as the market is concerned.
Thanks a lot for that, Vivek. Well, lots of selling. Some would argue liquidity is getting drained out, but it provides an opportunity for a couple of fund managers. Let's find out from Atul Mehra, fund manager at Motilal Oswal Asset Management. Atul, how excited are you? You have plenty, that's being offered to you. What's your comment? Good entry opportunity some of these stocks have given to you, your fund?
Yeah, hi Nigel. Hi, good afternoon. Yes, that's true. So basically, with a lot of these blocks coming about, one of the key challenges in especially some mid and small names is liquidity is not available. Now, with some of these issuances and blocks, you kind of participate without any impact cost on the names. So in that sense, yes, definitely, it is easier to deploy money through some of these transactions and deals, which is what is happening across the board. And I think, like Vivek was mentioning, it's not just in terms of blocks, it's QIPs, it's primary issuances in terms of IPOs. So a whole host of like OFS, the government has been fairly active on the OFS side. So it's a lot of money incrementally is going towards deals rather than in the secondary market. So that's really what is really playing out. Most of, I would say, time lately has been going towards deals, because every now and then, like today, we've seen 4 or 5 blocks. So every now and then there's so much activity happening on the deal side that from a time allocation and money allocation perspective, most of it is going towards that.
But at what stage will this become unhealthy?
I would say that it is healthy in the long term. Yeah. It is healthy in the long term because, see, in the absence of supply, you will see that the stock prices will shoot up quite significantly, because if you have 25,000 crores inflow every month and you need to deploy in equity because all the money is coming in equity funds. So in the absence of supply, you will kind of artificially inflate prices. And as the supply is catching up, you kind of deploy money for the long term at a healthy price rather than at a price which may not sustain itself. So in that sense, from a capital market perspective, it is a healthy thing to happen that there's supply because you don't have a crazy price impact on the stock with that.
Yes, this Sanjay Mukim of JP Morgan was earlier telling us this whole pipeline of IPO, QIPs, blocks is now absorbing more capital on a monthly basis compared to what domestic mutual funds are bringing in. Sorry, so that whole, the phrase about India has surplus liquidity when it comes to domestic markets and equities, that perhaps no longer holds or is a thing of the past right now. So Atul, give us some names where you all have participated. Incremental interest is where?
So, Rima, so names I would avoid, but I would say that we have been active in many of the recent transactions, either in terms of IPOs or QIPs or blocks. So it's been across the board. I would say that obviously we have in terms of the names, specific names we want to get into, but safe to assume we have been active on many of these transactions, and those kind of have added to returns for many of our funds. So let's avoid names, but yeah, fairly active space to be in.
Some themes, some sectors where you're incrementally more interested.
So incrementally, again, there is a lot of I would say activity on the IPO market. So lately, you've seen that many issuances have listed at fairly healthy in terms of gains, 40, 50, 60% in many of the names. So I think that pocket of the market remains the most exciting because in an IPO, you have a repricing event. Like in a block, it's kind of a listed company, a discovered name, a discovered price. Maybe you get it at 3 or 5% lower. But in an IPO, you have a complete price discovery coming about because the company is getting listed for the first time. So in terms of, I would say, descending order of priority, I would say it's IPO followed by QIP followed by blocks. Because in case of QIP as well, there's money going inside the company and that money is going towards growth in terms of organic or inorganic that the companies are pursuing. So that is the, I would say, descending order in terms of priority and potential profit opportunity from the fund's perspective.
What about metals? Is it catching your eye? That sector has come back strong. The government of India, yesterday I spoke to the DPM secretary and they were saying this is a chance that they're giving investors to participate and share wealth as well. And Hindustan Copper till midday it was okay, and then by the end of it, it got totally lapped up. Green shoe option as well, 3,000 crores goes to the government. Besides that, you have both the ferrous and the non-ferrous pocket that are lighting up the screen right now. How are you all placed on the metals basket? Are you all overweight, equal weight, underweight? And within the metals basket, what do you like?
Nigel, generally as a house, historically and even currently, we have kind of avoided commodity businesses because we believe it is not our strength to kind of predict the commodity cycles. So we tend to focus more on businesses which are more structural and where there's long-term high return on capital and a growth runway ahead of them. So most of our focus and most of our funds, you'll tend to see that they will be in more of structural stories with high return on capital and high growth potential. And as a space, metals is we are underweight, and it's not like a tactical underweight. We have generally been underweight the space because we believe that's not our strength. So in that sense, we are kind of avoiding many of the metals at this point in time as well.
Okay. What about the banks? The argument has been that PSU banks, stock price returns actually have been better in PSU versus private sector banks. And the larger names actually haven't performed that well. HDFC Bank, Kotak Mahindra Bank, they've actually underperformed. Their time has come. Private banks, large private banks will lead the way from here on, or would you like to go with the mid and the smaller names? Last couple of days, we at CNBC TV 18 have been breaking some stories as well. Could probably be fresh capital that are coming into some of these smaller banks. Probably there could be some consolidation as well. How do you read it?
Definitely. So that is one of the most, I would say, undervalued pockets of the market currently. So if you look at the last, I would say, 12 to 24 months time, you've seen so many transactions in the space in terms of FDI. You saw a transaction with Shriram, you saw a transaction with RBL and Federal. So many of these names have seen a lot of capital, new forms of capital getting infused in these companies. And on the larger banks, if you look at it, I would say that in the current quarter, as the FCNR scheme comes to an end, by the end of this month, you will see that also being a deposit growth delta for many of these banks. So from the perspective of in terms of like valuations, if you look at it, like the large private sector banks are, I would say, most attractive at this point in time. And you should see growth coming about in terms of the FCNR deposit scheme, helping them on the liability side, and that getting reflected in this quarter's results. So that space remains attractive, but at the same time, mid banks as well selectively look good, and we have ownership across many of these names.
Okay, and on the headline index, before we let you go, Atul, Ramdev ji has been thumping the table. Our time has come. I recall he told me in one of the shows that people are looking at KOSPI now because it's in fashion. But over the last 40 years, Nifty has done way better than KOSPI. That's, Ramdev at his best. But you think remainder of this year belongs to India and we will make fresh all-time highs?
So if you look at it, the broader market is already at all-time high. It is just the Nifty, which is about 10%, 8 to 10% away from all-time high. So broad markets, mid-cap index, small-cap index, they're already at or around all-time high. So I would say that one of the concepts to think about in the context of KOSPI you spoke about, if you look at, although KOSPI has had like very strong earnings growth in the last 12 months time, but if you look at it from a longer period perspective, the standard deviation of growth will be extremely high for a KOSPI. So while you have high earnings growth, but that also could lead to, like in the future, you could also have very large negative growth as well, because some of these aspects of memory, etc., could be cyclical in nature as well. So India in that context is more, our index is much more broad-based. We have all kinds of businesses. So earnings growth, it will be kind of moderate. Like even now, like this year, you should see 18% earnings growth. But it's more predictable and the standard deviation of that earnings growth is much lower than a KOSPI. So I think when you tend to value companies or countries as such as a basket index, it is not just earnings growth in a particular given year, but it's also sustainability and standard deviation of growth that matters. And in that context, India looks fine. So as some of the AI excesses kind of turn, I would say that what Ramdevji mentions in terms of time for India, that could definitely lead to some inflows. Like if you look at it on the FII side, lately we've seen stabilization. We haven't seen any major negative flows lately. There has been stabilization on that count. And if the AI trade reverses, you'll perhaps see India being one of the biggest beneficiaries in terms of inflows. So yeah, so broadly, I think that's the view.
Okay, all right. Optimistic, Atul. Thanks a lot for joining in. Appreciate you giving us your views on a lot of these sectors, themes as well, and sounding bullish on the markets. Thanks a lot for joining in.
Thank you, Nigel. Thank you.
Let's do a quick check then on the F&O markets. Well, the option tracker should come up for you on the screen. You're seeing considerable amount of writing around the 24,400 call as well as the 24,300 call. And that's been the case, really. If you look at the premium on both those two strikes, they've actually come down a little bit. So telling you that the writers are at play. Now, punching in these strikes, these premiums out there, you're getting a broad level. On the upside, 24,500, 24,600, the bears are going to come in there to fight. So that's going to be a crucial resistance mark. I'll tell you what, if we can get past the 24,600 mark, then I think we'll see a fresh leg of a rally because the markets are still net short. The FI positioning is still on the short side. If we can get past the technical level, then in fact, a lot of these bears, they'll have to squeeze out. They'll have to cover their shots. That's what will lead to a bit of a short squeeze. On the downside, I've been mentioning this even when the markets went around the 23,950 odd mark, that the 24,000, 23,950 appears like a near-term reference point and quite a firm support as well on the downside. Individual stocks, sale, it corrected all the way to around 160 bucks, and now in fact we're seeing fresh buying yet again. Pricing is expected to improve from year on. The spreads could likely improve. The street is okay that in the monsoon season, you have some kind of softness, but they're getting optimistic about the second half of trade. So it explains why that sale is seeing some fresh buying. Kotak Mahindra Bank as well. Last few years, performance has been a little bit subdued, but that as well on the first day of a new series is seeing a considerable amount of open risk build-up. So fresh longs being seen out there. And Ambuja Cements, the street is sniffing something. They believe that something's got to give, I think, on this one, because this was a regularly shorted counter. Now you're seeing a bit of a short squeeze. So Ambuja Cements, actually, if you look at the intraday chart as well, the street, there appears some part of those shorts, they're getting a little bit nervous. So I'll be waiting by to see whether or not there is some news flow. But the intraday chart of Ambuja Cements will tell you that there was some buying that was seen through the trading session. And now the shorts as well are getting squeezed out. Keep in mind, it's been a big underperformer from the cement pack, but the shorts are squeezing out. So I'll be waiting by to hear if there is any news on that counter as well. Take a short break, come back. Nimish is waiting for us on the other side. He'll tell us what's going on in D-Street Chatter. Welcome back. Well, the markets are sitting with a cut of around 50, 60 points, but that's precisely what's been the case over, a majority of the trading session. Good time to go across to Nimesh, who's joining us on D-Street Chatter to tell us what are the cues he's getting. Hey, Nimesh.
Hi, Nigel. Again, the same theme of Nifty in a very narrow range. But the fact that there's so much of supply of paper, that is actually capping the market or the Nifty on the upside. Even today, we saw 6,000 crores of block getting executed in the morning trade. Some good participation from both FIs and DIs in some of those blocks. So the institutional data may look a bit skewed because of those large block deals. From an overall flow perspective, my sense is there is a small MOC sell basket at a leading FI desk today. So maybe that might have an impact on some individual Nifty names in the last 30 minutes of trade. Broadly, some bit of buying seems to have resumed in the private bank names. That was a feedback yesterday as well. And looks like this private bank rally is backed by some bit of institutional buying for the last couple of days. Kotak Bank stands out in terms of very aggressive buying from larger FIs in the last couple of days, and that's been a big mover as well. Even in the broader market, looks like a bit of momentum is back. The mid-cap, the small-cap index is up 1% today, and the breadth has also improved to some extent. But I guess from an overall market perspective, the fact that there is so much of supply of paper, that is actually capping the upside in the very near term.
Well, indeed, today only we've had 5 or 6 block deals, Wellspun Corp, Physicswala, Grow, Rubicon Research and Viansh Scientific, totaling more than 6,000 crore rupees. But that point in Kotak Mahindra Bank is well taken, 6.5% rally since the start of the month. Nimesh, what else have you picked up in terms of buzz, chatter about stocks?
So in terms of individual names, Rima, the first stock is AB Real Estate, Aditya Birla Real Estate. While the stock has been under pressure on very thin volumes, but my sense is there could be top-level exits in the company very soon. So watch out for any sort of top management reject in Aditya Birla Real Estate. So that's the first name. Second stock is Kane Technologies. That's been buzzing in the last couple of days. The Q1 was quite strong, but I believe some bit of buy flows have resumed at FI desk. And also for Kane Technologies, the big trigger to watch would be the de-risking of the smart meter business. My sense is there could be some development with regards to the smart meter business very soon. So that's a trigger in Kane Technologies. The third name is Rashi Peripherals. We saw a big reaction to the stock after that independent director resigned yesterday. Was down 10% yesterday, down another 2-3% in today's trade. The volumes are also on the higher side. But interestingly, I believe one of the domestic mutual fund who's an existing shareholder has been accumulating in this fall in the last 2 days. So even today, my sense is they've been buyers in Rashi Peripherals. And the last is Previous Speciality. Again, a stock which is very thinly traded, been consolidating with a positive bias. But even in Previous Speciality, the sense is that there could be some M&A on the cards. Might be a global acquisition is something that the company may do in the very near future.
All right. Thank you very much for that. Always helpful to get in what's happening in the dealing rooms. Moving on now to get in a few more trading ideas before we wrap up today's trading session. The cash session has also begun. Mitesh is now joining in with his bets. Mitesh?
I have a VTST on Hindustan Zinc. Look for targets of 640, keep a stop at 622. And VTST on HDFC Life with a stop at 553 for targets of 564.
All right. Thank you very much for that. Let's talk about Cyient. That's been a big mover since the start of the trading session. Well, the company held their investor day, and for the last couple of months, the company has been telling us that the company is pivoting to capture a larger part of the opportunity. So traditionally, it was an ER&D company. So they help the companies research and design a particular product. But now they want to get into the entire life cycle of the product. So it begins right from the beginning with designing, manufacturing, but even after the product is ready in terms of aftermarket maintenance, upgrades, and end of life. So it's called Life Cycle Engineering Services Company. So you're moving more towards annuity because you will have the company relationship, the product over a period of time, not just deliver the product. So it's more annuity, more outcome based, so longer relationships, stickier revenues, higher value. Now this also expands the TAM, the addressable market for the company. Traditional ER&D is about $80 to $100 billion. When you include the full engineering life cycle, the addressable market jumps to $2.4 to $3.2 trillion. That's 25-30 times larger. Now the company has laid out a roadmap for this. And as I said, it's not the first time they're articulating this. They've spoken about it in the past. They switched to life cycle engineering. So FY 26 was the year of stabilization, 27 transformation, 28 is going to be scaling up. What they're looking at right now at least is get to year-on-year double-digit revenue growth, After that, over the medium term, the company wants to get to quarter-on-quarter sustainable growth. So currently, if you look at science numbers, there are many quarters in which the company is reporting a degrowth. They want to get to the company being consistent with quarterly revenue growth, and eventually, over the longer term, they want to be industry leading on revenues. On margins, the near-term target is 15%, but eventually they want to get to 16%. So all that is fine. So JP Morgan is constructive. Their target price is 1,050, but there is a Motilal Oswal who's a little cautious. They're saying that they're excited with the new focus area, this increase in addressable market, but they will wait to see for some evidence of execution before they turn constructive. Antique has a higher target price of 1,125, but the street likes the developments and the stock. I think it's still holding up. With the gain, it's still up close to about 7% in today's trading session. Other than that, it's been a quiet, in fact, a negative trading session for most of the IT stocks. The Nifty IT index is one of the big sectoral drags. Mayuresh Joshi, Research MarketSmith India, is now joining in. Mayuresh, why don't you begin with an idea of your own, the big idea that you all are working with today?
Afternoon, Rima. I think specialty chemicals has been on our radar for some length of time as we speak. And therefore, I think one name that we recently added and one name which remains on our watch list. The name which we recently added has been in focus, Sudarshan Chemicals. Our own sense is that the acquisition that they've probably done a couple of quarters back related to UBOC, I think you got 19 odd sites operational as we speak from a global perspective. Almost 1,600 pigment products that are probably there as far as the portfolio is concerned. And the expectations in terms of the guidance that they've probably given for FY29, revenue around 14,000, 15,000 odd crores, EBITDA, absolute EBITDA around 1,400 to 1,500, and achieving a net debt-free status. Obviously, what they've achieved in terms of winding down of debt in the last 2 quarters as well has been commendable. And therefore, I think our own sense is that they might actually wind down debt faster than what the market probably believes and expects. As well as smoother execution. I think that is the biggest risk for Sudarshan Chemical. If they're able to execute well over the next few quarters and get those synergies in place, my own sense is that the kind of numbers that can get rolled out as per their vision is a huge, huge possibility. So this is one recent addition that we've done. The other one that you keep on our radar, within the same pack, is Philips Carbon Black. Our own sense is that looking at the management commentary on what they have envisaged for FY30 as well, I think it's going to be a complete transformation. And similar to Sudarshan, if the Philips management is able to probably execute well, I think our own sense, again, is that the share of specialty chemicals on the EBITDA front is expected to inch from 24% to 60-odd%. They're expecting EBITDA margins to inch up from 16% to 23% over the next 3.5 years. All because of newer segments getting added, including silicon, including nanocarbon, conductive carbon as well, which are high margin products as we speak, and expecting a turnaround in terms of output. So I think 2x revenue, 3x EBITDA, 5x profits. Even if you're able to achieve half of that over the next 2 years, I think the story will be phenomenal as we progress.
Got it. All right. At the bottom of the screen, ICICI Prudential AMC to sell close to 2% stake on the August 27th to meet the minimum shareholding norms. So that's why I think that stock has dipped a wee bit, in the last few minutes. Yeah, holding with a very, very mild cut. Mayuresh, Hindustan Copper, yesterday when we had Deepam Secretary joining in, I recall, just mentioning that probably the orders start coming in from the second half because sell side coverage is very less. So approvals are taking a little bit of time. And then we saw, a lot of bids coming in, particularly in the last 90 minutes or so. And the government went ahead and exercised the green shoe option as well. Cut-off price around 520 rupees. Today, retail's turn. They're going full on inside. What's your take with regard to Hindustan Copper? At around 540, 550 rupees, it's not cheap. 50 times trailing earnings. But the street wants to look ahead. They believe EPS will double. And some hope that it will do even better than that. So that's why they believe 20, 25 times for a copper miner is good enough. What do you make of it?
So as we stand, Nigel, afternoon to you as well. I think as we stand, the only pure listed copper play in India, that's one. The second aspect, obviously, is that expectations in terms of the structural story related to copper itself and the end applications, whether it's batteries, whether it's data centers, whether it's semiconductors. I think all of that is going to probably gain steam as we progress over the next few quarters, as we speak on LME, is a little bit constricted. But going forward, I think as demand supply dynamics obviously start coming back, specifically in terms of more demand factors moving far, far higher and faster than what supply probably is at this juncture, I think LME prices should start rationalizing and stabilizing on the higher side. Fourth, I think the management, and I recollect, Nigel, the interview that we've had with the management, I think it was exactly a quarter back, where the management believes the kind of volumes and realizations that they're probably pegged is a little bit conservative, in my opinion, as well. And therefore, I think if things are to stand in terms of expectations on how all these factors might actually move in favor of copper and the industry thereof, I think Hindustan Copper is very, very strongly placed. If they're able to execute well, and you're rightly putting that, I think if volumes start playing out and realizations start playing out, then the valuations don't look that expensive. And therefore, I think from a rating backing perspective, it appears reasonably well placed. And therefore, anybody holding Hindustan Copper should.
Okay, all right. One wonders what's next on the government's radar. IDBI Bank, as we speak, has moved to the high point of the day. It's up close to around 8%. Yesterday, Deepam Secretary didn't give us any kind of direction with regard to how that one's going. Strategic divestment of IDBI Bank that didn't happen last year. At some point of time, my director will get it up for you on the screen. There it is. Time to slip into a short break. On the other side, we'll continue our market talk with Mayuresh. Welcome back. Well, we're still in conversation with Mayuresh Joshi. Mayuresh, I've just got the invite coming in from the Ultratech management, and on September 3rd, that big launch in the cables and wires space is what's going to come about. So, final quarter of this calendar year, we'll have wires and cables coming in from that cement major. What is your approach? The cables and wires players, they pull back big time, and from there, they've seen even a bigger rebound. How do you approach the others?
So all of them have done phenomenally well, Nigel, I think. And you look at the numbers that have probably played out, whether it's RR Cable as an example or KEI as an example as well. I think most cable makers have given a fabulous show. Look at Polycap as an example as well. And therefore, I think the expectation is largely getting built in is that volume growth should be reasonably well placed. If you probably look at VGuard's presentation side, I think they've given a complete picture in terms of the available market size for consumer durables as a space. And within that, wires and cables, I think a large part of that being organized, I think there is still scope for these organized players to capture the unorganized market as well. And therefore, I think the pricing pass-through that has probably come through, the expectations of stronger volumes still playing out as we head into the second half remains a strong possibility. With Ultratech foraying into that, I think it's just a marginal capital allocation compared to the overall allocation of the balance sheet size that Ultratech has. But looking at the core business, I think our own expectations in terms of the consolidation that is happening for the industry as a whole, and the organic and inorganic ways in terms of which capacities are probably going up, extremely well placed. So I think we do like leadership stocks at markets within the Ultratech within the cement pack space now.
Okay, just counting down to the close, and there is a clarification, or DCB Bank is responding to the CNBC TV 18 query. They're saying that we always evaluate strategic options. This is regarding the story that my colleague Yash put out about private equity fund infusion. Well, for the day, it looks like it's a close closer to the 24,200. So we've slipped more than 150 points from the day's high, 0.5% down on the Nifty, while the Sensex is down close to about 180 points. A much better day coming through for the banking index. The Nifty banking index off highs, but still ending with a gain of 0.5%, and the advanced decline ratio in favor of the gaining side.
Well, that's right. Plenty of stocks moving around from the broader markets. Vedanta Group, though, had a fantastic day. Vedanta Oil and Gas, that was up close to 7%. Vedanta Iron and Steel was up close to around 5%. The street is sniffing probably something on these smaller names. But even the big boys, Vedanta Aluminium was up close to around 3% by the time we wound up, and Hindustan Zinc as well dancing away. Well, you have Genesis International that was up close to around 16%. In the last 2-3 trading sessions, the stock is up close to 40%. I think the rights issue got cleared out there. So that stock did pop up and trade. Renaissance Global, that stock was up close to around 13% in today's trading session. Big move is what we saw out there. So good move out there. And IDBI Bank as well did do well. Guess what though? The CAS session has got completed and it's gone in favor of the bears. So yesterday it went in favor of the bulls. You had an uptick of close to around 70 points on the Nifty. Today, all of that has got reversed. The entire 70 is there, but that's on the downside. So flip-flop in the CAS session. Well, on that note, we'll wrap up on this edition of Closing Bell. You don't go anywhere. The team of Markets Forward is waiting for you.
Market ends the day sharply off the day's high to end in the red. The Nifty manages to hold on to 24,200 while banks put on a decent show.
Block deal frenzy on Dalal Street continues. Shares of Grow, Physicswala and 3 other companies worth 6,900 crore rupees change of hand. Existing investors have sold shares worth 3.6 lakh crore rupees through more than a 9,600 crore block deal so far in 2026.
Yes, I am 100% continuing as the executive chairman of Chola Investment and will continue to do so, says Reliance Subaya. Lauds the government for its semiconductor policy, adding that CG Power's chip unit could generate revenues of $500 million in a year. He also sees the power sector in a huge upcycle. That's a CNBC TV 18 exclusive.
Hello and welcome to Markets Forward on CNBC TV 18, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vinny and along with me is my colleague Ritu. Hi Ritu, it's a day where we did start off in the green and then we saw a fall coming in and then we didn't manage to sustain through the day, closed at the day's lowest point, just managing to hold on to 24,200 in the trading session as well. Decline of almost 0.5% for the Nifty 50 is what we saw. IT, obviously that led the decline today. So IT was down almost 1.2 to 3% in the trading session as well. Actually, 1.5% is the decline what it closed with. PSU banks on the flip side, that managed to do well. And overall, the banking space ended up in the green as well. Ritu, but a lot of movers today individually that came in from the broader end of the market as well.
That's right, Vinny. A whole lot of movers. DCB Bank, for one, that has just responded to our news story as well. But yeah, like you said, financials held one end of the market. The IT, of course, was the laggard. IT stocks, in fact, they're off the highs. Infosys was one of the top Nifty losers. Bank Nifty held up. Midcap index also slipped about 62 points as we see. Hindustan Zinc, that was one of the stock that surged. We saw one of the standout stocks. SAIL, Vedanta, NMDC, all of those saw gains in the range of 3 to 6% or so. Defense stocks had a bit of a mixed session. And apart from that, Avenue Supermarts, Varun Beverages, Premier Energies, these are some of the key names in focus. But let's get you a lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Vivek Iyer, from block tails to the key takeaways from Science Investor Day. We'll also decode the major developments on Dalal Street. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So let's get right to it, Vinny.
Absolutely. Let's get right to it. And on that first segment for today, we have Vivek here to take us through all the stocks that are moving around and were moving around in today's trade. Vivek, over to you.
Well, thank you so much for that. Well, we started off the September FNO series on a very subdued note, especially as far as the broad end of the markets are concerned. But individual stocks continue to take all of the headlines, given the kind of news flow and strong block deal action that we saw today. First on the list has to be KP Global, the top NSE 500 gainer, up on strong volumes today. Hindustan Zinc clearly stood out, especially as far as the metal pack was concerned, up almost 6%. Jefferies quite bullish on this particular name on rising zinc as well as silver prices. Gujarat Pipavav Ports, a positive development coming in which removes a significant overhang on the stock. The Gujarat Maritime Board has gone ahead and said that there is now a comfort letter for extension of the concession period of a key port that it runs higher by 3%. Gaja Capital, one of the strong listings of the day, cooled off a little bit towards the end of the session, but still 5% uptake or 5% pop for this particular name. And DCB Bank, our colleague yesterday tell you about a large likely fundraise, the management saying that they do evaluate various fundraising proposals as routine matter. On the other hand, quite a few drags as well. VF Scientific, a large block deal. Sources told CNBC TV 18 that it could be Carlyle that has gone ahead and paired a little over 10% stake in this particular name. Grow, a billion brains garage, that particular stock. Ribbit Capital expected to have gone ahead and paired stake of a little over 1,900 crore. Both the graphite makers today, both HEG as well as Graphite India, both of them under quite a bit of pressure, saw a bit of profit booking after the recent rally. And lastly, Varun Beverages, despite the positive news flow, especially in terms of the Alcobev entry, that particular stock was one of the top FNO drags in the session.
All right, Vivek, thanks very much for joining in with that list. Let's shift focus to another stock, that was pretty much in focus today, Cyient. Now, this is after the company laid out its 3-year roadmap at its Investor Day with a shift towards higher value, full life cycle engineering services. Let's bring in Reema Tendulkar with the key takeaways from this one. Reema.
Thanks so much for that. So Cyient, operated in the traditional ER&D space. So basically, they helped their clients, customers design, develop particular products. Now the company is saying that we want to move towards the full cycle engineering services model, basically start to end. So they want to stay with the customer right from designing the product, manufacturing it, to the aftermarket, the maintenance, upgrades, and even end of life. So the idea is to move more towards annuity based. So you get stickier relationships, more value, and just better relationship with the client. This move away from pure ER&D to entire life cycle engineering services also expands the TAM for the company, the total addressable market. So in the traditional space, the ER&D space, the TAM was about $80 to $100 billion. For the full life cycle engineering, it jumps to $2.4 to $3.2 trillion, vastly higher, 25 to 30 times higher. The company has laid out a 3-year roadmap. Year 1, stabilization, FY27, transformation, FY28, scaling up. What they're focused on right now is double-digit year-on-year top-line growth. After that, they want to get to quarter-on-quarter revenue growth consistently. Immediate term, margins 15%. Over the longer term, they want to get to 16% margin along with industry-leading growth. Brokerage views mixed. JP Morgan is constructive, but on the other hand, Motilal Oswal is cautious because they're saying while we're excited with the new focus areas, the addressable market, we still want to see evidence of execution and pickup before they turn constructive.
Okay, thank you so much for that, Reema. But on that note, let's bring on board our experts for today. We have Mayuresh Joshi from MarketSmith India, as well as Shrikant Chauhan, who will be joining us from Kotak Securities as well. But Mayuresh, let me start with you, right? Cyient IT space as a whole. Now, when you look at this takeaway that has come in from Cyient in terms of increase in terms of addressable market, they're talking about improvement in terms of margins. We have split views that have come in from brokerages. Which side do you come on? Are you positive on this one? Are you still cautious on this one? What are you watching out for?
Afternoon, Vinny. I think the market has given its verdict. It's remained very, very constructive. But my own sense is that I still need to wait for a quarter or two to decide whether these numbers are actually translating into what they've put in terms of the revision. So everything is fine, I think, from a target addressable market size of $100 billion going up to $2.5 trillion in terms of the entire life cycle engineering management. All seems to be feasible, all seems to be plausible. But how much does that come on record? And how much that does that have a say in terms of the margins as well? They're expecting EBIT margins exit 28 to exceed 15% as well, backed by that very, very strong life cycle order book. And therefore, I think the next 2 to 3 quarters are going to be extremely, extremely critical. I think the stock has already reacted quite significantly based on what they have probably announced. Now it is up to the numbers to probably do the talking for the stock. But within the midcap IT, Vinny, again, I think Coforge has clearly remained a clear outlier, both in terms of numbers and the management commentary.
Got that, Mayuresh. Hold on, we have some other news to address as well before we come back to you. The equity market that's seeing a fresh wave of block deals with more than 30,000 crores worth of equity supply hitting the market post the first quarter. Who's selling? What's driving this sharp rise in block deals? All of that. Let's bring in Vivek Iyer with more details on this one. Vivek.
Well, thank you so much for that. Like you mentioned, it's a deluge as far as block deals or equity supply is concerned. And we are only focusing as far as the secondary market is concerned. And we are only focusing on block deals or bulk deals where existing sellers are actually pairing stake either in the block window or in the open market. So at this point of time, this analysis does not include any OFS or even an IPO, which also adds to the equity supply. So what's actually transpired that post Q1 FY27, there's been a whole host of equity supply that's come across, especially, and it's been focused mainly on new listings and select healthcare names, where there was quite a few corporate actions that had taken place in the quarters gone by, and there was some amount of consolidation as seen as the ownership is concerned. Who are the key sellers in most of these block deals? It's mainly been the private equity players, the early stage investors, as well as the promoters. Now, what are the key reasons why we are seeing so many block deals happen, especially just immediately post Q1 earnings season when the silent period gets done? Number one, early stage investors, are taking part exit. Number two, promoters, who have debt on the personal balance sheet, and also they have pledged certain amount of shares, they are taking an exit as well to go ahead and reduce the stake or reduce the pledge. And also, in many cases, you're actually seeing the private equity fund cycle come to an end, implying that the private equity would need to go ahead and pay its stake further. So the total equity supply has actually gone ahead and exceeded 30,000 crore in just a few weeks since Q1 FY27. Now, a couple of things to note. It's not comprehensive given the fact that quite a few term sheets are something that CNBC TV 18 may not have access to. And along with that, like we mentioned at the start, does not include OFSs like the large one we saw yesterday in Hindustan Copper or even in LIC, which in itself was close to 30,000 crore. We've also kept away from the primary market activity, given that at this point of time, there's quite a few there too in the pipeline. So which are the stocks that have seen majority of the stake sales come about? Just talking about today, you've seen 4, you've seen VS Scientific, Welspun Corp, Grow, you've seen Misho as well. Most of these anywhere between 1,000 to 3,000 crore. Most of the sellers here are actually early stage promoters, early stage investors, as well as private equities like Carlyle. You saw a very large block deal take place in K Fintech, where General Atlantic sold close to 1,400 crore. Aster DM, TPG sold close to 5,000 crore in that particular name. Another large block deal that we saw was in Paytm, where the eventual owner of the stake was Anfink, again closed a little over 4,900 crores. These are very large block deals that we're talking about, and in most of the cases, they got absorbed quite easily. A couple of names too, you saw Tenneco Clean Air, where the parent entity paid close to 2,000 crore, Misho to 1,200 crore, and what we understand from our investment banking sources that there are still quite a few large block deals in the offing. So it'll be interesting to see what is the kind of equity supply and how it gets absorbed as far as the market is concerned.
Vivek, thank you so much for that. So much supply of equity coming into the markets. And this is just after Q1 also for some of the numbers that Vivek mentioned as well. But we also have Shrikant Chauhan now with us. Shrikant, hi. Thank you so much for joining us on the show. Before we jump to all the supply that's coming in here and, block deals coming in, I want to understand first day of the new series. What are you watching out for in terms of levels? It doesn't seem too much of an excitement, at least the way we have closed today.
Yeah, absolutely. I think the way the opening was there in the market, everyone was expecting that now the market can move towards the levels of 24,600 or 700. But again, it disappointed. Again, it closed lower. And during the cash session, we saw one more decline. So broadly, I'm of the view that the market is currently facing a lot of uncertainties. Because of that, the market is finding difficulties to sustain at higher levels, or maybe whenever there is a fall, the fall is also gradual. But I am of the view that till the market is above this level of 24,000, we can again see the levels of 24,500 or 600. It will take some time, but I think instead of focusing on indices, because there we are not seeing any specific trend, any specific formation pattern, but stock specific activity is definitely there. So instead of focusing only on the index, it is better to focus on stocks. But in terms of technicals, based on levels, 24,000 is now going to act as major level. In case market closes below that, then we can expect further more decline in the market.
Take that point, Shrikant. Do hold on. Like you said, let's focus on some of the stocks, because there's a whole host of corporate developments, from new business forays to regulatory updates and fresh order wins and whatnot. So let's take a closer look at some of these stocks that were in news today with Devyani.
Well, starting with SBI Cards. Now, the stock was in focus as July credit card spends came in at 39,592 crores, up 21% on a year-on-year perspective, significantly higher than the industry growth of 7.8%. Now, that said, the spending moderated on a month-on-month basis in the month of July, but all in all, a strong year-on-year growth coming in from the company. Now, moving to Varun Beverages. Now, the company has incorporated a wholly owned subsidiary, Kiva Spirits and Company, marking its entry into the ready-to-drink alcoholic beverages and allied product segment. The former Diageo India Chief Commercial Officer Prathamesh Mishra has been appointed as the CEO and MD of this particular subsidiary. Separately, Varun Beverages will also set up a beverage JV in Tunisia for the production and distribution of soft drinks, juices, as well as water and dairy products. Now, coming to Cipla, the US FDA conducted a follow-up CGMP inspection at the company's Pitampura manufacturing facility. Now, the inspection has resulted in 7 observations in Form 400 283, with Cipla saying that it will work closely with the US FDA to correct any and all observations that have come through. And finally, Advait Energy. Now, the company has received a 135 crore turnkey order from Madhya Pradesh Power Transmission Company. The order is for the design, manufacturing and supply of emergency restoration systems for extra high voltage transmission lines. So these were all the stocks that were buzzing in trade on the back of key news developments in trade today.
Thanks so much for that, Devyani. But in an exclusive conversation with CNBC TV 18, the executive chairman of Cholamandalam Investments, Reliance, said that the company is seeing an improvement in return on asset, performance on overall loan book is also strengthening, as well as there's a favorable shift in the business mix. Listen in.
Has been the discussion that we've had several times, and this question has been asked several times, but definitely the answer is yes.
Okay.
And it's something that it's a role that I'm 100% continuing and will continue to serve.
So it is something like this. Your group of the family will be the dominant shareholders in the manufacturing, CG Power, Tube Investments, etc. But in Cholamandalam, you will be the executive leader, even if there is somebody else with a dominant shareholding. Is it like that?
No, the general thinking at this stage is that basically we have aligned around three alignments that basically are managing different sides of the business, and that thinking continues. Definitely, we see a situation where ROAs are beginning to go up. I think it's a confluence of a couple of things. One is that the performance of the book overall is also improving, and that combined with our overall mix is allowing ROAs to expand from where they've been for the last couple of years.
All right, we still have with us Mayuresh and Shrikant. Mayuresh, a whole bunch of stocks that we've covered. Just a quick thought on SBI card and some of this latest card data that's come in. It's not the dominant player yet, but the spend share or the spend increase has been pretty phenomenal for SBI card versus say a decline for ICICI in the last 1 year. Any thoughts on that space? Who you see emerging as leaders? Where you see opportunity for buying as well?
A piece that you did, and it was quite well done, specifically on the card space. However, I think my own sense is that it's largely an unsecured credit environment that these card operators operate out of. Obviously, I think higher limits are given to card spenders and people who probably pay their payments on time with a reasonable good CIBIL score. However, I think with the kind of exaggerated card disbursals that are probably happening over the last few quarters, and very aggressive ones like that, and the second element of this being unsecured credit, I think when the cycle is in its favor, it's fine. But if the cycle starts turning and starts to become a little sticky and patchy, I think that is where asset quality pressures and some pressures in terms of delinquencies will pop up. So my own sense is that don't understand this space very well, and therefore I think far better choices are there for order.
Okay, point taken there, Mayuresh. But Mayuresh as well as Shrikant, thank you so much for joining us as always and helping us understand in terms of individual stock names, levels to watch out for in terms of markets as well. Thanks so much for that. On that note, we're going to slip into a very short break, and after the break, we'll get you the top corporate voices along with the key market events to watch out for. Stay tuned in. Welcome back to Markets Forward on CNBC TV 18. Now taking you through the top corporate voices of the day. First up, we had MTAR Tech that came in and joined on CNBC TV 18. The management said that it has a clear roadmap for the next 5 years and remains on track with its planned capex. The company expects to do better than 80% of its guided revenue growth for FY27, with an update of expected at the end of Q2 FY27. The company says it will participate in DRDO's missile program after evaluation.
And Chalet Hotels is aiming to double its current performance over the next 3 years. Speaking to CNBC TV 18, they said the company is on track to reach a 5,500 key portfolio by FY30, with more than 2,000 keys currently under development. Meanwhile, they also continue to look for acquisition targets.
Okay, and before we wrap up this edition of Markets Forward, let's go across to Devyani to take us through the key events to watch out for in tomorrow's trading session. Devyani?
Well, starting with the global cues, Nvidia's Q2 earnings are set to come out tomorrow, with investors tracking the commentary on the AI demand, data center growth, as well as the semiconductor outlook. Now, the Jackson Hole Economic Policy Symposium, which begins August 27th, will be closely watched for signals from global central bankers on the interest rate trajectory as well as the monetary policy outlook. Now, markets will also keep a close eye on the US initial jobless claims data, which will provide further cues on the labor market in the US. From China, the July industrial profits data will be released, offering insights into the corporate profitability of the country. Now, moving to India, Zee Entertainment's SAT hearing on the 3,000 crore warrant issue will be closely tracked by investors as a key stock-specific development in trade tomorrow. And in the primary market, Lumino Industries 700 crore IPO opens for subscription, while Symbiotech, Pharma Lab, as well as Skyways Air Services IPO closes tomorrow, with investor participation being the key monitor here. On the geopolitical front, though, the UN Security Council briefing on Syria will be watched for any developments that could impact the global risk sentiment going forward.
Thanks very much, Devyani. And on that note, Vinny and I take your leave on this edition of Markets Forward. But stay with us. News and updates will continue right here on CNBC TV 18.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Iran and Oman closer to a deal on a temporary transit via the Strait of Hormuz. Tehran clarifies that the waterway remains closed after President Trump claims that all mines have been cleared and detonated from the Strait's international waters. Oil prices pair gains with Brent around the $86 mark. Sensex and Nifty give up early gains to end in the red, but bank stocks buck the trend. Rupee remains on a tight leash against the dollar. Block deal frenzy on Dalal Street. Shares of Groww, Physicswala and 3 other companies worth 6,900 crore rupees changed hands. Existing investors have sold shares worth over 3.6 lakh crore rupees through more than 9,600 block deals so far in 2026. Canada retaliates with 50% tariffs on more than 700 US goods following new US levies. Canada's tariffs will take effect from the 8th of September and is likely to sting President Trump and the Republican Party ahead of the midterm elections in November. The Trump administration halts immigrant visa applications worldwide as it moves to limit access to applicants who may become reliant on U.S. public benefits. The State Department says it wants to conduct in-depth training for consular officers. Reports say applicants whose interviews were scheduled were informed that their appointments had been cancelled and that they would be informed of a new date and time. Tola Investments, Velayan Subbiya says he will continue to remain the executive chairman, expects CG Power Semicon unit to generate revenues of around $500 million in a year. That's an exclusive. Average credit card spending across India holds above 2 lakh crore rupees this year as the pace of growth sustains. SBI Card manages to outpace industry growth rate. JSW MG Motor launches the Hector Tomahawk electric car at a starting price of nearly 20 lakh rupees. Parth Jindal expects MG to turn profitable next year but remains tight-lipped on a potential deal to acquire Volkswagen India business. At least 8 people dead in Nepal after a massive flash flood swept through the Bhotekoshi River in a key district bordering Tibet. Settlements and infrastructure along the river suffer extensive damage. Over 100 Indian tourists among those missing. Bill Gates sounds the alarm on the risks stemming from artificial intelligence to jobs, safety and children's well-being, warns the world has no plan for the AI era and calls for some jobs to be reserved only for human beings. And legendary country singer, songwriter and philanthropist Dolly Parton dies at 80 after a brief battle with cancer. An 11-time Grammy winner and one of America's most loved music icons, Parton's career spanned over 5 decades and touched generations of music lovers. Tributes poured in from world leaders and musicians across all genres. All right, the top story this evening, Iran and Oman are set to reach a temporary understanding on the Strait of Hormuz. This comes a day after the US ramped up pressure on Iran's trading partners. Here are the latest developments. Well, the alliance between Iran and Oman over the Strait of Hormuz is taking shape. Foreign ministers of both countries met in Tehran overnight to discuss a new maritime route. Hours after the meeting, Iran's deputy foreign minister confirmed that both countries have reached an understanding on a temporary route for transit through the waterway. All this comes as Washington continues to claim control over the strait. In a social media post overnight, US President Donald Trump claimed that all mines in the waterway have either detonated or removed, and that Iran has been told that any vessel or boat placing new mines in the strait will be destroyed. However, the US President did not make any comment on Iran and Oman reaching a deal. In the oil market, Brent crude prices continue to decline and is now closer to $85 per barrel. According to ship traffic data from Kepler, 5 vessels transited through the Strait of Hormuz, below the 10-day average of 15. Gulf nations like Oman, Qatar and Pakistan have all urged for a diplomatic solution for reopening the strait. Qatari officials have also said that efforts are underway to bring US and Iran back to the negotiations. Here's officials from the US and Iran on the state of conflict and reopening of the Strait of Hormuz.
Is it fair to say kinetic strikes are on a pause right now, or do you?
No. If we need to use kinetic strikes, we'll use them. If Iran is foolish enough to overplay their hand or mess with the American military, we'll do what we need to do. But economic pressure, we know, hurts them the most right now. But by no means are we foreclosing using kinetic strikes anywhere in the Strait of Hormuz or around Iran.
What we have now almost reached an understanding on is that the inbound route into the Persian Gulf from the Gulf of Oman will lie entirely within the territorial waters of the Islamic Republic of Iran. The outbound route, meaning from the Persian Gulf toward the Gulf of Oman, will also pass partly through Iranian territorial waters, with the remainder in Omani territorial waters. This is a completely fundamental change compared with the past.
The U.S. Central Intelligence Agency Director John Ratcliffe is in Russia for unannounced meetings, according to reports. This is the first publicly known visit to Moscow by a serving CIA chief since William Burns traveled there in November 2021. The purpose of Ratcliffe's visit and the details of his meetings remain unclear. The CIA has declined to comment, while the Kremlin says no meeting with Putin had been planned. The Trump administration has halted immigrant visa processing worldwide, citing in-depth training for consular officers and a push to limit access for applicants who may rely on U.S. public benefits. Scheduled interviews have been cancelled and will be rescheduled. The move follows a federal judge blocking Trump's plan to bar immigrant visa applicants from 75 mostly lower-income countries. Canada has hit back at the U.S. with tariffs of up to 50% on more than 700 products. The retaliation from Ottawa comes days after Washington levied 50% on Canadian imports worth $20 billion. Canadian tariffs ranging between 15% and 50% will take effect from September 8th and cover products including steel, aluminum, dairy products, electronics and furniture. Canada is a key export market for several American states which are headed to the midterm elections.
Canada must respond, and today we are, in a proportionate, targeted, and strategic way. Today I'm announcing that Canada will match the United States tariffs dollar for dollar, rate for rate. Effective September 8th, Canada will impose counter tariffs of up to 15, 25, or 50% on $27.6 billion in imports from the United States of America.
With regards to Canada, the president has been very clear for the last year and a half that the way they treat our dairy farmers in America is just not, it is not going to continue any longer, that the intent of the USMCA and other deals that went on was that our American dairy farmers would be treated as they deserve to be treated. And in fact, what has happened with the way that Canada is applying is sometimes a 200, 300% extra tariff on milk and dairy products going into Canada.
Right on to the markets now. Dalal Street started the new series on a mixed note, with the Nifty and Sensex giving up early gains to end the day in the red. The Nifty closed below the 24,300 mark, led lower by IT and FMCG stocks. Financials outperformed, with the Nifty Bank gaining 0.5%. Midcaps outperformed the blue chips, but still ended marginally lower. The equity market is seeing a fresh flurry of block deals. Shares worth 6,900 crore rupees changed hands across Grow, Physicswala and 3 other companies. So far this year, existing investors have offloaded shares worth over 3.6 lakh crore rupees through more than 9,600 block deals. Vivek Iyer is here with all the action. Vivek.
So which are the stocks that have seen majority of the stake sales come about? Just talking about today, you've seen 4, you've seen VS Scientific, Welspun Corp, Grow, you've seen Misho as well. Most of these anywhere between 1,000 to 3,000 crore. Most of the sellers here are actually early stage promoters, early stage investors, as well as private equities like Carlyle. You saw a very large block deal take place in K-Fintech, where General Atlantic sold close to 1,400 crore. Aster DM, TPG sold close to 5,000 crore in that particular name. Another large block deal that we saw was in Paytm, where the eventual owner of the stake was Anne Fink, again closed a little over 4,900 crores. These are very large block deals that we're talking about, and in most of the cases, they got absorbed quite easily. A couple of names too, you saw Tenneco Clean Air, where the parent entity paid close to 2,000 crore, Misho to 1,200 crore, and what we understand from our investment banking sources that there are still quite a few large block deals in the offing. So it'll be interesting to see what is the kind of equity supply and how it gets absorbed as far as the market is concerned.
Right, thank you Vivek for that. Hindustan Copper gained over 4% as retail bidding for the government's offer for sale opened today. The OFS with a floor price of 514 rupees has seen strong institutional demand, with the non-retail portion subscribed 3.41 times on day one. That prompted the government to exercise the full green shoe option, taking the potential stake sale to 6%. Now, DCB Bank gained nearly 3% after sources told cnbc TV 18 that the bank is in talks with private equity firms for a potential fundraise. Yash Jain is here with the details. Yash, what are you picking up?
Well, that's exactly what we're given to understand from our sources. DCB Bank is currently in conversations with various private equity players, and this is for the purpose of raising funds into the bank from these private equity players. According to our sources, as far as these private equity players are concerned, Chris Capital is the one leading this group of private equity players when it comes to showing its interest when it comes to infusing funds into DCB Bank. Now, DCB Bank very recently had approval for about 2,000 crore of fundraising, out of which 1,500 crore was through equity issuance, and the balance about 500 crore was through debt issuance. We've written to both DCB Bank as well as Chris Capital. A response from both companies still remains awaited. But as far as the regulations are concerned, private equity players are only allowed to acquire about 9.99% stake in any bank, and that also happens with prior RBI approval. For DCB Bank, according to our sources, the funds raised from this private equity infusion is likely to be used towards as growth capital into the bank. The company has a stated ambition to double its balance sheet every 3 to 4 years, and that's exactly where the funds are expected to be used. We had written to DCB Bank on this particular query. The bank has responded to cnbc TV 18 saying that they keep evaluating various strategic opportunities from time to time.
All right, thank you Yash for that. Moving on, credit card spending remains resilient, with Indians spending over 2 lakh crore rupees for the third straight month in July. But while spending has held steady, the number of credit card transactions is growing much faster, pointing to a shift in consumer spending patterns. Let's go across to Ritu for more details. Ritu.
Well, credit card spends are holding up remarkably well. So in July, we spent about 2.08 lakh crore rupees through credit cards, which is up 3.4% from June and about 7.4% from a year ago. But importantly, this is now the third straight month where credit card spends have remained above that 2 lakh crore rupee mark. So the average monthly spend in the first 7 months of the year is about 2 lakh crore rupees versus about 1.9 lakh crores for all of 2025. Headline looks good, but the spending is actually growing a whole lot slower. So the overall credit card transactions increased 24.5% year on year in July, but spending, like I said, has risen only by 7.4%. Now that means we are using our cards a lot more often, but for smaller amounts. So the average transaction value has fallen to about 3,440 rupees in July, which is actually a decline of nearly 14% from last year. The card base, though, that's expanding at a very healthy pace. We ended July with 122.86 million credit cards outstanding. That's roughly a 10% year-on-year growth. Now, in the competitive landscape as well, there is a clear shift. Public sector banks are gaining more and more share of the credit card spending, but private banks remain dominant. Their spending, though, has slowed down to just 2.8%, and that's brought their share down to about 72.1%. But the market is very top-heavy. The top 4 players, HDFC, SBI Card, ICICI and Axis, between them, they hold 70% of all the outstanding cards and 76% of all the spending. But at individual bank level, HDFC is firmly in the front, followed by SBI, ICICI and Axis. But the growth numbers are quite interesting. So SBI Card's July spend actually increased the most, while ICICI Bank saw some spending decline. Overall, the credit card story, though, is still very strong. Spending has crossed that 2 lakh crore rupee mark for the third straight month. The card base is at a record high, but the growth pattern is changing, where the number of transactions are rising a whole lot faster than the spends.
All right, thank you, Ritu, for that. Velia Subbiah has confirmed to cnbc TV 18 that he is 100% continuing as executive chairman of Cholamandalam Investment, one of the leading NBFCs in the country. In a conversation with Lata Venkatesh, he also lauded the government for its semiconductor policy. He said that CG Power's chip unit could generate up to $500 million in revenue within a year.
Can Cholamandalam investment investors be sure that you will be in charge of the company in spite of the group realignment?
Yes, definitely, Lata. So I think this has been the discussion that we've had several times.
Yes.
And this question has been asked several times, but definitely the answer is yes.
Okay.
It's something that it's a role that I'm 100% continuing and will continue to do. Revenue from this facility could be, anywhere from, 500 to perhaps 500 to 600 million, depending, right? Currently, I would say 500 million. But it depends on so many factors, and honestly, I think the only way to look at it is that the country is beginning to make the right moves.
JSW MG Motor India has launched the Hector Tomahawk, a new 7-seater SUV in an all-electric version with a plug-in hybrid version to follow. The starting price for the vehicle is just under 20 lakh rupees. Rachna Dhanrajani is here with the details. Rachna.
Launched Hector Tomahawk, and it has done it twice over. The same car comes as full electric as well as plug-in hybrid. The deliveries for the EV1 start in September, whereas the hybrid goes live in November. But this is the first time any Indian car maker has taken this route. Now, why is this launch so important? Well, that's because Parth Jindal told CNBC TV 18 that he expects MG Hector Tomahawk to take MG up to 10,000 units a month, which would make it the 7th car maker of that scale in India. Apart from that, he also expects this car to be sold out within 2 weeks. Now, Parth Jindal also believes that MG will turn profitable in calendar year 2027.
We can expect MG to be above 10,000 units in a month, which will make MG only the 7th auto company in India to cross the 10,000 milestone per month. With that scale and the economies of scale kicking in, I do expect the company to become profitable in calendar 27.
Now, if you remember, earlier this year, we got you a sneak peek inside their Halol plant. That plant had a capacity of about 110,000 units a year. With this one, the capacity is expected to go up to 160,000, eventually to 400,000, and at 300,000, it would reach its capacity. So a second phase of the same Halol plant is expected, is what Parth Jindal told us.
Yeah, so currently the capacity of our Halol facility is about 110,000 units a year. And like I said, with this car, we expect to start crossing 10,000 units a month, which is putting Halol absolutely at capacity. We are augmenting that capacity. By March, our capacity will be about 160,000 units a year. And then within Halol itself, we will be expanding in phases, first to 220,000 units and then eventually to 400,000 units a year.
But here's the catch. This is the last launch from MG for this year. The next nameplate only comes up in the calendar year 2027. So the MG Hector Tomahawk has to carry the company through the festive season and beyond till the next one comes in. We also asked Parth Jindal about the Volkswagen deal. While he didn't confirm anything, there wasn't a denial either. Here's what he said.
Once there is something to disclose, we will disclose it. Right now, we are obviously very excited about this launch. We're very excited about the upcoming festive season. Localization is the mantra if you want to be in our country. So whether it's any brand, even MG, localization is the priority. And whatever steps that the government and the honorable courts take in that direction are welcome.
All right, time for a short break. Coming up next, 33% of international flights are set to shift from Mumbai Airport to the new Navi Mumbai Airport. More details when we return.